Welcome, everyone, to this year's DC FinTech Week. It takes a village to really support this kind of global project. And I want to thank early on, before everything's over, early on, some of the people behind the scenes that have made this amazing event happen. Lauren, Marie, Elaine, Trish Fauché, our wonderful friends at the Visa Institute for Economic Empowerment. There's just been really an army of people who have worked tirelessly to make this kind of service available to everyone, and we hope that you enjoy it. We have 4 wonderful days ahead of us, and I wanted to thank as well the Bank for International Settlements for all they've done to support it. And one of the top people on that list, literally the top person on that list of people to thank, is Augustine Carstens. Now, Mr. Carstens has been a thought leader, quite literally a role model for the international community. And he's really positioned the BIS to tackle a range of 21st century problems in really unique and forward-looking ways. And it's just been a pleasure working with his staff. And so with that, I'd like to welcome him and to let him kick off the conference. Mr. Carstens, thank you so much for joining us.
Thank you, Chris, for your tremendous job in putting all this together. And obviously, thank you very much for your very kind introduction. So let me start by welcoming you all to the DC FinTech Week. It is a great pleasure for me to join you and for the BIS to be co-hosting this conference with Georgetown University Law Center. The themes of the conference, innovation, inclusion, and integrity, resonate with all of us at the BIS. And we should ask why. Well, because they reflect the BIS's own values. We are committed to continuous improvement and innovation. We act with integrity, and we foster a culture of diversity, inclusion, sustainability, and social responsibility. There are powerful reasons why so much innovation is bubbling up in the public and private sectors. Bold steps are being taken and important lessons are being learned. Some of these lessons relate to the feasibility of the technological products that are being developed. Others relate to the innovation process itself. The same is true for the BIS. Through our new Innovation Hub, the BIS is serving as a platform for central bank innovation. We are developing new technological solutions to problems in the financial sector and learning a lot in the process. And on top of that, we are getting an intensive course on the process of innovation itself. Today, I would like to share with you a bit more about this process and what we are learning from it. I will start by giving you some background on the BIS and what it's for. I will then outline the Innovation Hub's main projects and the products we are developing to smooth the cross-border interoperability of digital currencies. Last, I'll say a bit about the lessons learned. So let me start with some background on the BIS. We are an international organization based in Basel, Switzerland. The bank is owned by 63 central banks from around the world, including the US Federal Reserve. For more than 9 decades, the BIS has been the principal forum for collaboration among central banks globally. We collaborate on many activities that contribute to monetary and financial stability, which is essential for sustained economic growth. As the world's oldest international financial organization, innovation has always been part of our DNA. In a world of change, from the Great Depression through Bretton Woods to the Basel Accords on bank regulation, central banking has always been inextricably linked to innovation. New technologies are changing the financial system right now. Just look at today's conference agenda. So that central banks can collaborate better in this space, we have set up the BIS Innovation Hub as a platform for sound innovation. We work together with central banks and other stakeholders to explore practical problems in the financial sector and address them by using new technologies. This is not a think tank. We build things. In the past 2 years, we have done a great deal through our regional centers in Switzerland, Hong Kong, and Singapore. New centers and offices have opened or are opening soon in London, Stockholm, Toronto, Frankfurt, and Paris, and we also have a strategic partnership with the New York Fed. The Hub's work program touches on all of the issues of importance to central banks. We have 12 active projects in areas such as SupTech and RegTech, next generation financial markets infrastructure, central bank digital currencies, and green finance. 2 of our projects will be showcased today. It is no surprise that the most popular topic these days is CBDCs, with half of our projects focusing on them. Let me focus on how our projects are shaping the cross-border aspects of CBDC. Multi-CBDC arrangements are of interest because they could improve cross-border payments. They offer a worthy alternative to privately issued stablecoins or cryptocurrencies. CBDCs are designed with the public interest in mind to deliver the unique advantages of central bank money, that is, settlement finality, liquidity, and integrity. What are multi-CBDCs arrangements? While they encompass different technological and governance models, they provide mechanisms through which different CBDCs can interoperate. In this manner, they can facilitate cross-border settlements. The BIS Innovation Hub is devoting a great deal of attention to multi-CBDC arrangements. They are the focus of projects Enbridge, Dunbar, and Jura. We are collaborating in these projects with 10 central banks around the world. They let central banks explore new ways of making cross-currency settlements safer, more efficient, and more accessible. To do so, we're establishing prototypes and proofs of concept to explore different uses of CBDC in a cross-border context. While the projects all focus on the same basic concept, they follow different technological approaches and use cases. With Project Enbridge in our Hong Kong center, we are testing interoperability between CBDC systems of 4 different jurisdictions on the same DLT platform, as well as the interlinking between retail and wholesale CBDC. In the most recent phase, a proof of concept platform for multiple CBDC settlement was developed. In this manner, the CBDCs can be traded between central banks and large financial institutions to settle cross-border payments without using the correspondent banking system. And it works. The prototype completes international transfers and foreign exchange operations in seconds, as opposed to up to 5 days using correspondent banking, and it can operate 24/7. Moreover, the cost of such operations to users can be reduced by up to half using algorithms and smart contracts to improve liquidity management along the transaction chain. In Singapore, we're working on Project Dunbar, which also uses multiple CBDCs for cross-border payments. Here, we're exploring how central banks can share a common settlement platform on which they can issue multiple wholesale CBDCs for international settlements. Further phases will explore how to enable interoperability and link together several shared platforms in different regions. Our Swiss Center is working with the Bank of France, the Swiss National Bank, and the private sector consortiums on Project Jura. This project explores the potential for multi-CBDC arrangements in settling cross-border payments and transactions with digital financial instruments. It examines cross-border settlement involving 2 wholesale CBDCs and a French financial instrument on a DLT platform. We are also learning how to ensure the necessary central bank controls on such a platform. We're very excited by the progress we're making with these projects, but there is a lot more to be done, in particular the systems within which CBDCs will exist and their governance arrangements are in relative infancy. Systems with multiple CBDCs will need to incorporate the governance requirement of multiple central banks. These issues are also being addressed in our projects. It is not all about CBDCs, though. Enhancements in other areas of the cross-border payments program will be critical for cross-border CBDCs use. We also need to compare what can be achieved by using multi-CBDC arrangements and by linking fast payment systems, which the BIS Innovation Hub is also investigating with Project Nexus. Nexus standardizes the way that fast payment systems connect to each other. Its software, known as Nexus Gateways, manages the difference in data, functionality, and processes between different systems. Payment systems can connect using Nexus and then offer instant cross-border payments to their members, banks, and payment service providers. So this overview reflects what we are learning from the products we are building. But let me share with you what they are teaching us about the innovation process itself. I will lay out 5 important lessons. Number 1, be prepared to fail. Innovation is characterized by uncertainty and complexity. To achieve excellence, you have to be willing to fail. Failure teaches you lessons that lead to better products. Some of you might be surprised to hear this from a central banker like me. This idea is encompassed in the concept of fail forward. This means that you embrace failure as a stepping stone to central bank innovation, as to any other form of innovation, and learn by doing. This represents a cultural change for any central banker, the kind of person who typically aims to behave prudently and strives always to make the right decision informed by a lot of data. This is no simple task, and it's a whole new paradigm. But we're certainly learning to behave like this in the Innovation Hub. Our team has had to foster a sense of openness and a touch of humility in order to learn from experimentations. As we experiment, we start to understand trade-offs that were initially not anticipated. For example, how to balance scale and speed with security in DLT networks. I know these issues of scalability in DLT will be addressed in a session later today. It is only by acknowledging these trade-offs that we could scope out the route to take in some projects, which now differ considerably from the initial thinking around them. Lesson 2, innovation means evolution, not revolution. The products of the future are often built on the lessons of the past. Many of today's technological solutions are building on infrastructure that already forms part of the financial sector. Think about payments. This is an area where we are seeing very rapid change. The improvement started in wholesale payments with the introduction of real-time gross settlement systems in almost every country in the 90s. Then innovation in retail payments emerged in the 2000s. They have made payment systems increasingly convenient, instantaneous, and available 24/7. And of course, more recently, central banks are looking into central bank digital currencies. There are 26 pilots around the world and 2 live CBDCs, according to our most recent database. In our case, the projects evolve following a sequential approach with initial, deepening, and broadening phases. Also, some of them have started from scratch, but a few are building on previous regional initiatives, such as Project Inthanon, Lion Rock between Hong Kong and Thailand, and Ubin in Singapore. This brings me to lesson 3. Innovation is all about collaboration. The raison d'être of the BIS Innovation Hub is international collaboration. The Hub is a global platform where central banks can collaborate with each other and with other stakeholders, regulatory agencies, international financial institutions, academia, and various private sector players. The Hub model recognizes that partnerships are critical. We can accomplish so much more working together than individually. In our 3 cross-border CBDCs projects, Enbridge, Tombar, and Jura, we're working with central banks in Asia, Europe, the Middle East, and Africa, plus 15 private sector companies. Collaboration within multidisciplinary teams is equally essential to create a culture that embraces initiative and broadens perspective, allowing for things to be done differently. Lesson 4. To successfully innovate, use innovation management methodologies. Our projects are developed using the design thinking and agile management methodologies that are widely used by technology firms. Our innovation process has two steps. First, to identify problem statements, problems in the financial sector that need to be addressed. Second, to develop prototypes and proofs of concept in response to the problem statements. We have tools that help us shape these two phases. For example, design thinking methodologies help us understand customers and their real needs. One method we use involves developing personas to represent the eventual users. For example, in Project Rio, which also will be showcased later today, a key member of our project team is Mark, an FX analyst who is a key member in the Project Rio team, except that he does not actually exist. Once the idea has been sharpened, the building phase begins. Here, a proof of concept of prototype is developed. For this purpose, we use the agile working processes. A continuous rethinking and reviewing of plans is embedded in all steps of the process. The fifth and final last lesson that I would like to share with you today is that there are different ways of achieving the same end. Comparing different approaches and solutions is key to making progress and discovering what works best. You have just heard how we are applying this approach in our experiments related to the cross-border use dimension of CBDCs. Let me close by saying that innovation is a fascinating journey. It cuts across time, geography, subjects, and partnerships. We need new tools, processes, and ways of collaborating to ensure that innovation is a force for good in the financial sector. Whether in the area of digital currencies, green finance, or regulation, we have a duty to make the financial system work better. This is very much a global collaborative journey, and the BIS is proud to help map out the path. DC FinTech Week let us explore technological innovation, including central bank innovation, in many important areas of the financial sector. We at the BIS are delighted to be co-hosting this event and look forward to the many insightful sessions that will follow. Excellent speakers from around the world will offer insights into how FinTech applications can best support financial inclusion, competition, and privacy issues raised by digital platforms, and how to price risks and opportunities. We will hear from central bank governors, academics, senior policymakers, private sector CEOs, and members of the public. The agenda and the list of speakers for the conference underscores DC FinTech Week mission, the mission that is to democratize the debate about FinTech. We hope that this conference will foster a productive dialogue between private innovators and public officials. So I wish you all a wonderful DC FinTech Week. Thank you very much.
Thank you so very, very much. That was really interesting, and I'm pleased to carry forward that conversation, the conversation about interoperability, the conversation obviously about innovation and how it works, conversation maybe about failing and can you fail forward. With really some of the foremost experts, we want to go around the world to get the latest insights, and we're going to start off with perhaps the hotbed of FinTech innovation in Asia. And I am just delighted to have an all-star panel for that conversation with Sapnenu Mohanty, the Chief FinTech Officer of the Monetary Authority of Singapore, Val Yap, the founder of PolicyPal, an insurance FinTech in Singapore, Douglas Arner, the Carey Holdings Professor in Law and veteran of DC FinTech Week, and Quan Yu of the Ant Group. Thank you all for coming. Your insight is really very welcome. Let's just maybe transition then from the general manager's conversation about the BIS really as a kind of node of international coordination to, again, this question of Asia. Douglas, let's kick things off with you. How would you view sort of Asia's innovation path, and does it look as a region differently or different from the rest of the world, and if so, how? Sort of the broad strokes.
Thanks a lot for that, Chris, and great to be here again. You know, it's always nice with this time zone to have the opportunity to kick off the week, and really big thanks for having us back, and congratulations again. You know, I think the challenge with talking about Asia is it's a big place. Lots of different countries, very diverse experiences, but I think we can kind of pick up a few things. The first is you can kind of break it down into developed Asia, Japan, Singapore, South Korea, Australia, Hong Kong. And if we think about developed Asia, probably the experiences against the rest of the world aren't necessarily that different. Where the differences come in is what you can think of as emerging Asia, the big emerging markets. And I think if we look at China, we look at India, we look at ASEAN, this is where some of the big differences are. And I think if we look at China, of course, China has had the most rapid and most comprehensive digital financial transformation, probably of any economy and society in history. If we look at India, big catch-up story, big strategy in India stack, lots of infrastructure designed to enable not only digital financial transformation, but to support development more broadly. Much of ASEAN, the developing members of ASEAN, in some ways catching up, looking at the experiences of China, looking at India, looking at developed Asia, and moving a bit slower. So if I wanted to pick up, I would say the first is catch up. In other words, you've got places that are trying to catch up. They're trying to catch up because systems haven't worked as well as maybe they have elsewhere. So you've had a real opportunity for leapfrogging in the context of development. And I think that finally takes us to scale. And of course, if we're thinking about China or India, we're often talking about hundreds of millions, billions. And that's something very different than most other places. And the final thing that I'll leave you with is much of Asia has been powered by the widespread availability of smartphones. And I think this is something that's differentiated it from a lot of developing markets elsewhere. Quick tour.
No. That was a quick and very useful tour, you know, and really thinking through, I guess, the heterogeneity of the region, both in terms of development, but also in terms of the existing and even sort of legacy financial infrastructure. Val, I mean, are you also seeing this? I mean, obviously you're a startup, but you know, when you think about the different regions of the world, and we'll obviously get to something to momentarily to talk a little bit more about Singapore itself. But were there certain kinds of drivers that sort of, or local drivers that influenced how you thought about fintech and financial technology?
Hi, thanks for having me, Chris. So I'm Val Yap, CEO and founder of Policy Pal. It's an insurtech based out of Singapore. We actually been talking to like insurtechs, fintech companies across the world, as well as with the financial institutions. So we have seen like differences in terms of innovation and also specifically in fintech field. So if I talk about innovation, we can see that in the US and Europe, a lot of innovation actually tend to be new to the world. So I guess like in terms of the culture aspect is that like just take the risk and work on something that is out of the norm. While in Asia, a lot of focus on innovation is actually new to the firm, what the firm is actually working on, and then how like the Asia innovation and also like startups are actually improving internally to help the firm itself. But specifically, if we talk about like fintech itself, I think fintech industry within Asia is a lot more matured, in my own personal opinion, as compared to the US, because Asia, as of now, like including like China, Indonesia, India, is kind of like say the hub for fintech, right? And of course, Hong Kong and Singapore itself, we have a lot of regulations that are very supportive for like fintech startups like ourselves. I think to top up is basically like the high consumer demand. Asian population are primarily quite young and appeals to them. So like just like what Douglas says, like it offers the opportunity to leapfrog, like instead of having like credit card, where I guess like in the US and Europe itself, people are very comfortable with the credit card, but like in emerging countries, big population like China and Indonesia, people basically skip the whole like credit card generation, and they're so comfortable going out of like their home with just like the mobile phones, where everywhere is accepted for like mobile payments. And of course, with the pandemic, COVID, it changes the way that people think about like payments and fintech solution. The supportive like regulation, where of course we have like Mohanty, Chief FinTech Officer, to share more, is that it definitely helped the FinTech companies to kickstart. Could it be grants, support system, the ecosystem support, be it like working together with financial institutions, understanding the key problems that like they face, and how FinTech companies, be it like they are emerging out there trying to solve a problem, they can actually see that how they can like tackle it instead of like trial and error, trying to figure out like what the financial institutions are looking to solve. Other than that is the whole like internet infrastructure in Asia. It makes it a lot easier for like the consumers to adopt fintech companies. So that covers the whole fintech, and of course in the insurtech space, it's still relatively young. Like in Asia, it's still very, very young. Not many startups as compared to the US and UK. UK actually was the first, like I would say, the countries to spearhead like the whole insurtech ecosystem. US dominate the whole market like for now, but like in China itself, I guess like maybe Kwan later can share more, is that there are a lot more opportunities because of like the country, the population, and also the demand itself.
So I will say that because most of my formative experience was using credit cards, I feel dramatically older after just listening to that conversation, because I understand that my equivalent is being leapfrogged over in Asia. But I think that's really important, to talk about. Well, it's not just a question of infrastructure, but the secret sauce, if one will, of what's happening in Asia involves both cultural differences, youth, infrastructure, and different kinds of relationships, apparently with maybe regulatory authorities and market participants, which obviously then does bring up something new. When you think about the particular confluence of different actors, and again, it's a big space with lots of extraordinarily different countries. How do you view sort of the regional differences? I mean, really the inter-regional differences, when you think about those very different factors that make Asia's fintech scene even generically very different from the rest of the world.
Hi, Chris. Good to be back to talk to you again.
Absolutely.
Well, I'm going to give some structural representation of what Douglas and Val spoke about the market, and my own definition of how there are three big giants in Asia, and they're very different in many sense. There's the China market, where it was private sector led, big tech, big picture, rapid expansion, massive transformation. India was a miraculously very different. It is a public sector led, where government put an infrastructure to lead a much more inclusive, well distributed, with the financial inclusion as the big agenda. In a strange way, China is looking at financial inclusion now, but that's a bit of a different discussion now. And then come the rest of Asia, which is ASEAN, where the genesis is a mixture of both. Because the ASEAN story against the big India-China story is quite different. In ASEAN, somehow strangely, it was the banks who were small size and mid size. They had a far more strong desire to rapidly digitize, especially the country banks, whether it's DBS and in Singapore, whether it is a bank in Indonesia or a bank in or a bank in Thailand. They had the strong desire to be fintech themselves, So the ASEAN story was more collaborative. So the fintechs in Singapore, if I look at them, they go to China to work with big tech. They go to India to work on a public infrastructure rails to deliver financial services. The fintechs go to ASEAN, not go to directly to consumer. They want to work with a bank and collaborate and offer the services. That actually reflects the differences and the opportunity for the market. Because most fintech, if you ask the founder, the dream is large market. And they want to see they want to go to market where the friction is maximum. So they can make money by arbitraging the friction in the system. And that's essentially what happens in Asian market. So when you come to ASEAN market, it's Hong Kong, Singapore, you can't arbitrage much. This is a highly efficient regulatory public infrastructure running. So the only hope you have is to work with the bank and help them to digitize. That's the reason why the ASEAN growth was B2B, the India-China growth was B2C, and India-China within themselves was quite distinct because China was big tech, big tech, big tech. India was public infrastructure, Aadhaar, UPI, India stack. And that's the key construct difference between the three markets. From policy standpoint, there's a quick summary there. I think each of the three buckets pursued different policy stance. In the China, it's almost like policies were coming rapidly. Now it's coming more rapidly, how to manage the sector. In India, it was more around policies around getting the infrastructure right. Then came the fintech policy. In Singapore and now in many ASEAN countries, the policy and infrastructure are happening almost same time. Almost same time they're happening. As you're building infrastructure, policies are coming in place. So that's the macro differences in the three market.
Yeah, super useful. And just for one little point of clarification there on the ASEAN market, and given the fact that, it sounds like, banks are these central sort of nodal points. And was there any story of disintermediate? So it sounds like the story of disintermediation in the ASEAN region was less of an issue perhaps than in other parts of Asia. Is that correct?
Chris, you just Google yourself. Look at the fintech story in ASEAN. It will be bank-led, most likely. It will be a very bank-led. Some mid-tier bank suddenly woke up and, I want to digitize. Union Bank in Philippines, I want to be the best bank. DBS, I want to be the most digital bank. That's the story in ASEAN. You don't see the bank-led story in China and India.
Well, this is a great setup for you. I mean, is that really I won't have you grade Sapnindo on his categorization, but is that what you're seeing? And then, just to take the conversation a step further, if it is what you're seeing, how does that sort of translate into the technology? I mean, we're talking about whether or not it's a bank-led process in some parts of the world, or maybe it's a big tech project in other parts of Asia. If that's really the categorization, where's technology coming into the picture, and are there variations in terms of the actual product that's being pursued?
Sure. Chris, thanks for having me here. I'm happy to share some of my experiences. So I worked in the States for 14 years at Capital One for offering credit card to a broader population. Then I joined Ants in 2016 and leading the credit team for consumer products and also SME lending. So I'm not an expert in comparing like cross-regional or inter-regional difference, but I can really, kind of practitioner in this field. I want to speak to, what's really happened at private sector and what's the technology difference between the States and China or Ant. So first, let me speak. Some of the speaker already touched to the differences. I think we need to start from how the markets are different. For example, let me use SME as an example. I think SME lending is kind of a global challenge. It's a challenging question, probably even more than consumer lending, because they're small, they don't have collaterals, their income fluctuates, etc. So but in the meantime, they need credit. They need credit now. They need credit to survive and thrive. So that's really a challenge globally. However, in China and maybe even in emerging Asia, using this term, I think the difference is the market. For example, in China, SME, in terms of the number and their contribution, they're a much bigger section of the economy. They contribute to 80% of the employment and also 60% of the GDP. It's a bigger portion. So how do you make those business successful? As the recent development, especially with the mobile phone availability and also the mobile payment, I think suddenly data are online. You'll have all this data, alternative data, to make credit assessment, to offering credit to those SMEs. For example, and of course, when you set up the credit assessing system, there's something we learned from the States, because Capital One is kind of famous for its information-based strategy, and they also offer different pricing to different customer segmentation. And do some testing. That's a success story. So we have some of the same elements here in China. We do also have some differences here, because the difference lies in the kind of the data. If you use mobile payment, the data is really live. It's dynamic. It's changing all the time. It's really kind of different than how you use the bureau data to assess a credit. For example, for the QR code merchants, you can use some really cool online auto adaptive models to assessing at each transaction whether this is real and that from the real owner of the shop, and also if the transaction is kind of fake transaction or it's real. With this kind of technology, we're able to kind of offer credit to a lot of broad business owners where they cannot have credit from the traditional banks. And I think really what I see, what's different in China versus the States in terms of how we offer credit to the SMEs.
Yeah, that's very helpful. Do you get a sense then that comparing your Capital One experience, and obviously we've done a lot here in the United States on alternative data, but I mean, do you find that the sources and potential either applications for alternative data or just the availability of data and the ability to deploy that, do you see real substantive differences in terms of the degree to which alt data can be employed for varying financial products in China?
I do see some differences. I think in the States, the supply of the credit, I would say, is relatively a mature market. It's more accessible to either a consumer or SME. So the gap is smaller, I would say, in the States. And also the payment approach in the States, you have credit card, you have even checks, you have, different sort of payment out, distributed in different institutions. But in China, it's relative, Alipay, WeChat, and the Bank Indian system, really union system, and really kind of are the big players there. So you really have this, more a complete transaction history and pattern of the SMEs. So with that data, we can really have a good picture of what's happening there. So we actually work with the banks, to give them. Sometimes we provide the credit themselves, or sometimes we work with them to provide supplementary information to them. So I think that's really the difference. And also not only the credit assessment, it's also how people, use the product. It's really at the tip of your, fingertips. You don't need to go to the branches, you can operate everything on your cell phone. So it's really, because SME need their credit now. So it's really, you don't need to go to the bank and wait for 2 weeks to get credit.
So I want to wrap up then this technology point and then go to the obviously interesting regulatory question. But I did want to just go back very quickly to Val. You're in InsurTech. InsurTech is still rather novel here in the United States. I mean, we're really just now seeing a lot of interesting developments here. But in terms of the pursuit of technology and the product and the technology products, do you have anything to sort of add in terms of that and in terms of what you've seen and what you've been able to build?
I think in the US, like a lot of InsurTech actually focus on like helping in terms of like the whole customer experience, innovating, focusing mostly on like P&C, property and casualty. So 80% of like the startups focus on that. And we're seeing quite a few like IPOs recently, Hippo, Lemonade, Root. I was just at the InsurTech Connect at Vegas like about 2 weeks ago. So like it was massive with like 2,000 over like attendees, where I can see that many InsurTechs have aspired to become like one of the top InsurTech companies out there. But like say what we see in Asia is quite different, probably because InsurTech is still at its infancy stage. The market size kind of smaller. So most of the companies focus on like all-round coverage. So all-round coverage that includes like something like what PolicyPal has been doing, where we cover life and non-life, which is P&C. So depending on the region, specifically, like is it China market, India, the mature like the rest of the Asia, like Singapore, Hong Kong, with Japan, Korea, where do we focus on as compared to like ASEAN market, like Indonesia? So ASEAN market, if you talk about Indonesia itself, like most of the people have the mobile phones where they actually live and breathe with like the mobile app, like their lifestyle apps such as like Grab, Gojek. So InsurTech companies are actually partnering with such tech company to provide embedded insurance. So I would say that like this kind of innovation on the embedded insurance all-round coverage actually started by China. So like Indonesia, Malaysia, Thailand, they are actually offering such a solution as compared to the InsurTech companies that I've seen in the US. They tend to focus on specific like segment, and they actually boil down to even like professions or like the age group. So the market is very big. They choose to actually focus on that and provide a differentiated like customer experience, looking into the data underwriting. So there's a difference specifically on the InsurTech segment. But I would say that InsurTech have a lot more room for growth for the next 5 to 10 years because it's always like the slower cousin of like FinTech.
Right, it is. So I want to now, just sort of do an important kind of transition to the policy, because right now, as a U.S. person listening to this conversation, as I'm sure many people in who are awake right now in the US are listening, and they're thinking, okay, it's interesting, both the relationship between the amount of coordination between these fintechs and their supervisors. What's really interesting in terms of data is potentially very interesting. And then obviously the fact that you're starting off with sort of, it sounds like, everything from mobile phone technologies and sort of building up from there in many parts of the world. Is in and of itself interesting, given again in the States sometimes we're having social media sort of as initial building blocks and the like, and it raises all kinds of interesting regulatory questions. Douglas, even though you see these sort of potential divergences, you do see in different parts of the world and even in Asia sort of an increasing concern. Even in China, when you think about big tech regulation, cryptocurrency, skepticism, where at least there have been some really interesting lines of convergence, say with the United States. Where do you see policy diverging the most, if one would, with the United States? And are there any areas where you're seeing a potential conversion?
Yeah, thanks for that, Chris. And I think if we're thinking about sort of one of the areas where we're seeing a convergence in terms of everyone's trying to deal with the same issues, it is this question of data aggregation. In other words, we want to figure out how to get the benefits of data aggregation. Quan was talking about it in the context of SME lending, for instance, or AI trading, et cetera. But at the same time, what we're seeing are risks from the standpoint of the existing data aggregation models. In other words, if we think about network effects, we think about economies of scope and scale, we think about winner takes all models, we're seeing some outcomes that I think almost every society around the world is actually finding undesirable. And so what we're now seeing in terms of divergence are a number of different models of trying to address these. And if you look at the US, the approach has been largely a property-based approach to data, which has resulted in private sector concentration. China's model has been similar, but we're now seeing a switch to a much more sort of state focus on data aggregation and use. At the same time, if we look at the EU, which is very influential in this area, a sort of rights-based approach, and you can think about open banking and how that may work. And finally, Sop had mentioned India earlier, and we're seeing a very interesting data aggregators model spread across the different forms of infrastructure. And so I think we're seeing some common areas of concern, but quite different approaches in different markets all over the world.
That's so true, and we're going to have some great open banking conversations later in the week. Something new. I want to throw that same question your way. Do you see any sort of points of divergence or convergence? And you're also a diplomat, a financial regulatory diplomat. What are the kinds of tools that are used to bridge those kinds of differences?
Sure, Chris. Before I go to this answers question, one data point I missed to share. During COVID-19 pandemic period, ASEAN market alone issued 20 plus new digital bank licenses. It speaks to the model difference between the three buckets. Now to your question, convergence, data protection, privacy, KYC, money laundering, consumer protection, convergence. Every regulators have come to a conclusion that that's something they got to protect. When it comes to business model risk, you have to realize Asia's needs are quite different. This is a market where, as Kwan says, SMEs are looking for more digital transformation. There are many people who are excluded from financial services. So there is the need to expand that business model to take a little bit of a thoughtful risk to expand the credit to a lot of financial inclusion segment. In terms of, I would say, priority differences, I think the Asian focus is more infrastructure driven, so that they put the right infrastructure, the digital infrastructure, digital identity, payment of interoperable payment systems, and put the regulation around it. I think the US still talks about the more on the policy side, less about infrastructure for now. But I think that's where the priorities are different. But and just to quickly end the last interesting point on the digital currency side, as you can see, the Asian model is more of experiments, put the experiments out there, ensure there's a real use case driving those utilization of possible value of digital currencies, which I think we don't see much experiment in the US when it comes to public-private sector partnership. But broadly speaking, we are seeing a convergence on many macro subjects, but different market, different need, and different speed.
I was struck even from the introductory remarks from Augustine Carson's about the experimental sort of emphasis, even from a regulatory standpoint, that you're seeing over at the BIS, and that's obviously a theme that you're emphasizing as a kind of a cultural or policy difference. Thank you so much. We're going to continue this conversation, but just by queuing up our conversation on innovation and in Asia, it's going to be of enormous use for us. And thank you so much for joining us. So we are up for another very highly anticipated session. But before we get into it, I wanted to introduce and thank John Frost, who has been the laboring power behind DC FinTech this week or this year with the BIS. John Frost is a senior economist with the BIS, and I will give him the honors of kicking off this next panel.
Thanks a lot, Chris. It's been great working with you, and we're very pleased with the great program that we put together. So I'm especially glad that we have Mu Changchun here. Mu Changchun is the Director General of the Digital Currency Institute at the People's Bank of China, and he can share the perspective of a central bank that's actively piloting a CBDC, the so-called eCNY. Changchun has been very active in the global policy discussion on these issues, also with other central banks. And we're very glad that he's now willing to share those insights with the general public and with the wider audience here through DC FinTech Week.
This is great, fantastic, and it is just an honor to have you, sir. Thanks so much for joining us. Perhaps you can I saw that you sort of listened in a bit, Mu, on the earlier conversation on Asia's innovation path. So maybe it's just worthwhile maybe continuing the theme and asking you, when you look at China's innovation path, how do you see it as being different from that of the United States or the rest of the world?
Thank you, Chris. Thank you, John. And it's my pleasure to be here. It's my honor. For this innovation path, unfortunately, I couldn't make it for the last session, but I believe the most different approach actually adopted by the US and China is the wait and see policy. In China, we actually adopting a pilot or a sandbox. It sounds suitable by most of the audience. It's a sandbox approach. That is to put to build up a trial environment, to have a pilot program to run it, and after some time, if we can reach a desirable result, then we can roll it out to the whole nation. That's the most frequently adopted approach in China. I think that will be different from U.S. situation. We call it a wait and see policy. So that's why we have Alipay and Tenpay. We have so many big techs in China, which is all actually which are all raised up by this wait and see policy. So that wait and see policy give a very friendly environment for the big techs to grow. But of course, from the regulatory part, after the wait, we have to review all the consequences, the pros and cons of those big techs. So now we have wait enough. And then recently with the regulatory agencies, including the People's Bank of China, the CBRC and CSRC, they have already taken a lot of measures to actually to deal with those consequences of this development of these big techs. Of course, the big techs actually contribute a lot in terms of financial inclusion, in terms of financial innovation, but there are some negatives influence or negative impacts. For those negative aspects, we have to make it better to lead them to a right way. So that's why we have so many monopoly measures in place to make those big techs better, make the whole market better, and we'll give a level playing field to the market. So I think that's the biggest difference between U.S. innovation path and Chinese innovation path.
Yeah, that was very much sort of a theme in the earlier panels, particularly the sort of experimentation. That theme was actually introduced with Augustine Karstens at the very outset of sort of the experimentation with fintech more generally, which is perhaps a little bit less the defining characteristic in the United States. But you've introduced the second aspect that we haven't talked about, but I know we will later, the sort of antitrust question. I think that really what the audience is very interested in hearing from you about is a little bit more about the ECNY, the so-called digital yuan, and really what would be the core features of a sort of a digital currency, and what have you been able to? What is it that you'd be able to tell us about its likely operation?
Well, this design of ECNY actually it shares both the features of physical RMB, which is the physical banknotes, such as settle upon payment, anonymity, and the features of electronic payment instruments, which are the less costly, highly portable, high efficiency, and hard to counterfeit. So the design of ECNY mainly considered the following features. For example, the identifiable both as account-based and value-based, and also quasi-account-based system. ECNY is account-based, and in terms of account system actually is the most valuable asset of the commercial banks. So it's important for the commercial banks not to abandon their most valuable assets. So that's why, firstly, the ECNY system, ECNY is an account-based system, and also a quasi-account-based system. And at the same time, we had to take advantage of the recent technology development, which is a token-based or value-based system. So it has a variable face value and also enable value transfer via token. So we took all the advantage of the incumbent, or we call traditional payment system, and also the incoming in forthcoming new technology. So that's why the ECNY is a hybrid system, both featured with account-based, quasi-account-based, and value-based. And second feature is the non-interest payment. The ECNY is mainly produced as M0, so it treated the same as the physical RMB under M0, which carries and pay no interest. And thirdly, the cost is very low. Consistent with the management of physical RMB, the PBC does not charge any fees from the authorized arbiters and also the end users for exchange and circulation services. And of course, the authorized operators do not charge any fees from the individual users for the ECNY related services either. And of course, there's other features such as settlements upon payment, since it's token-based or value-based. According to the settlement finality, the ECNY is loosely coupled with banking account. So the payment through ECNY wallet are settled upon payment, the action of payment. And also we provide anonymity, or we call it a managed anonymity function. The ECNY follow the principle of anonymity for small value and traceable for high value. And we attach great importance to protecting the personal information and privacy. So it aims to balance or strike a balance between combating the illicit transactions, for example, the money laundering and tax financing, and also to protect the privacy or personal information of the general public. of course, we adopted a variety of technology to protect or safeguard the safety, including the digital certificate system, digital signature, and encrypted storage to prevent double spending, illegal duplication, and counterfeit, and also to achieve irreversible transactions. So a multiple layer security system have been initially established to mitigate the potential risks. Of course, the ECNY is a smart money. It has programmability capability. So it could be realized by deploying smart contracts without impeding its legal tender functions. Under the premise of security and compliance, the feature enable self-executing payment according to predefined conditions of terms agreed between two parties so as to facilitate the business model and innovation. Those are the basic features of the ECNY. With those basic features, we could provide a wider access to the central bank money, and it could provide a level playing field to the market participants. And also, we could reduce the competition with bank deposits. So we could mitigate the risks of disintermediation. So those are the basic features. Thank you. Back to you.
Thanks, Changchun. So, countries we've noticed are thinking about CBDCs for many different reasons. The motivations differ according to the characteristics of the countries. And we're wondering if you could tell the audience a little bit about what the problems are that the ECNY plans to solve. Is it primarily a response to market developments like the dominance of the big techs that you talked about before? Or are there specific opportunities that you see in the Chinese context?
Well, this question is related to the drivers about the development of ECNY. Firstly, the reason or the drivers behind the ECNY is to firstly to improve the financial inclusion. Secondly, is to improve the efficiency of the central bank payment system with wider access and stronger capacity. And thirdly, is to provide a backup or redundancy for the retail payment system. And the first, of course, is to improve the financial inclusion, is to diversify the forms of cash provided to the general public by the central bank, to satisfy the general public's demand for digital cash and support the financial inclusion. The ECNY system will make financial services more accessible, providing fiat currency for a large population in various scenarios. Those without bank accounts could enjoy basic financial services provided by ECNY wallets. For example, for those population in remote areas and poor areas, they could open a digital wallet without the support of a traditional bank account. And of course, the foreign residents temporarily traveling to China, they can open a digital wallet to meet the daily payment needs without opening a domestic bank account. So in addition, the ECNY, as I mentioned, is settled upon payment. The small business and related parties can improve their liquidity management while enjoying more convenient payment services. Of course, the second reason is to improve the efficiency of the central bank payment system. And in recent years, there is a trend that the central banks are improving their central bank payment system by including more participants and prolong the service hours and also improve the efficiency. Some of the central banks actually are trying to do that by building up a fast payment system, while the Chinese, our People's Bank China, are trying to make those improvements by introduce the CBDC in China. And thirdly, to provide a backup or redundancy for the retail payment system. As you may know, we have two big giants that already dominate the whole retail market. But problem is, if there is something bad happen to them, either financially or technically, definitely we are going to have a significant impact, negative impact on the retail payment service market, which will actually significantly impact the daily life of general public. So that's why we should have a backup system to guarantee there's no financial disability risks if there's something goes wrong. Thank you.
Thank you. You know, it was important and interesting, obviously, that you again really confirmed, you know, like an account-based system, and then walking through just sort of your logic with redundancies and the larger role for the ECNY. Here in the States, the project has attracted some skepticism as to the ultimate intention and aims of a digital yuan. And you had mentioned the managed anonymity. Maybe you could go a step further and just sort of explain to us what that concept means, and are the privacy measures that are taken, are they any different from how it would operate internationally versus domestically?
Well, that's actually the question is about two parts. One is the managed anonymity. The other one is internationalization of RMB. So I will answer the first part firstly. The privacy actually is one of the core issues in our mind, which is concern us ourselves a lot when we design the ECNY. So as I mentioned, we have to strike a balance between protecting the privacy of the general public and combating those illegal transactions. Both aspects are same important to a CBDC. We cannot ignore any one of them. So finally, we come up with the idea that is a principle actually is a managed anonymity. That is to be specific, that is anonymity for small value and traceable for high value. Firstly, the least privileged wallet, we call it the fourth category of the wallet, can be opened merely with a phone number, either a domestic phone number or foreign phone number. While as you may know, for the electronic payment system, the Chinese commercial banks and the PSPs, they are required to collect and process area of personal data on the individuals during the onboarding process or before engaging any certain business transactions with them. But we only collect a phone number only for these least privileged wallet. So that's the fourth category of the digital wallet is anonymous, even to the PBC under the current legal system. Because, we recently introduced, the Chinese government introduced enforced the personal information protection law. Under that law, the telecom companies cannot release any information, any identity information to any third parties, including the central bank. So the central bank, the PBC, cannot access, including the authorized operators, which is the second tier organizations. They cannot retrieve or access to the ID information behind that phone number. So the PBC can only access the ECNY transactions across the institutions because we are taking care of all the across institutions transactions. And given any transaction is illicit, in which case the law agency, the law enforcement agency could retrieve data with legal warrant from the telecom companies. So that's for the anonymous digital wallets. And secondly, the function for pushing sub-wallet to the authorized online merchants will ensure the safety of customers' personal information by encryption and tokenization. That's to say, the ECNY system collects the least transaction information comparing with traditional electronic payment system. So that will actually apply to all the users. So the concern actually personally I have actually is how to effectively prevent and combat money laundering, terror financing, and tax evasion under the effective anonymous ECNY system. So this actually, there's a big misunderstanding about the anonymity issue of the ECNY system. So that's the first part of your question. The second part is about internationalization.
Great. And Changchun, I think unfortunately we're coming to the end of our time. I know that there's a lot to be said about internationalization, and I think we should definitely have a further conversation on this. But just to say thank you very much. We've really appreciated all of your insights. And I know that one of the aspects that's being thought about in internationalization is cooperation between central banks. PBC, of course, is cooperating with other central banks from the region and also the BIS Innovation Hub. And so actually the next presentation we're going to hear is from Benedict Nolans, who is the head of the BIS Innovation Hub Hong Kong Center. And she'll talk about a project that the PBC is actually participating in together with other central banks. So we'll turn now to Benedict. Thanks a lot to Changchun. Thanks, Chris.
Thank you.
So hello, everyone. My name is Benedict Nolans, and I'm the head of the Hong Kong Center of the BIS Innovation Hub. So I'm based in Hong Kong. On this slide, you can see our global team. We have people based in Switzerland, in Singapore, and also most recently in the Fed. The BIS is a bank for international settlements, and as such, we work extensively with central banks from around the world. So for this presentation, I was asked to present to you a very recent paper we put out just a few weeks ago in September, which is called Indian Online Rock to mBridge, Building a Multi-CBDC Platform for International Payments. I will set out for you very briefly the key points of this paper. First of all, it is a technology prototype development to investigate whether a new shared multi-party DLT-based cross-border payment network, whether it can reduce the cost and increase the speed of cross-border payment while being subject to the principles of compliance, interoperability, and do no harm. To achieve this goal, we have engaged in experimentation in an agile fashion through collaboration with several central banks, vendors, and banks. The vendors help design the blockchain architecture. The banks who want to transfer funds to a participating market in an atomic and real-time fashion can do so via the platform. And to achieve the transfer, the central banks issue and redeem CBDC on the platform. This project has at this stage reached stage 2 or phase 2, and it achieved the following outcomes. First of all, we developed, as was anticipated, a prototype that enables the participating central banks to control the flow of their CBDC and to monitor transactions and balances of their issued CBDC with programmable levels of transaction privacy and aspects of automated compliance. The prototype demonstrates a substantial increase in cross-border transfer speed from currently days to seconds. It also demonstrates the potential to reduce several of the core costs, core components of correspondent banking cost by up to half. And thirdly, the benefits would be further increased for jurisdictions that do not benefit from a vibrant correspondent banking network. To this effect, I want to point to the charts on the left. As you can see, the colors red and a little bit of orange. The red is actually a decrease of active correspondent banks. The orange is an increase of active correspondent banks. This picture was prepared by the BIS Research Department, and we've reproduced it in this report. The dial on the red shows the cost split within a cross-border transfer, currently through the correspondent banking network, where such network exists. And as you can notice, the core costs are nostro-vostro liquidity, treasury operations, FX cost, and compliance. And so, as I had explained, the prototype demonstrates that transactions not only can be sped up to seconds, but in addition to that, that several of these core costs can be decreased up to half. I now want to point to the images on the right-hand side of the screen. As you can see, you see one bridge, and then you see a crossroad of bridges. The crossroad represents the prototype. The one bridge represents the correspondent banking model. So as you can see, the first prototype involved Thailand and Hong Kong, and you see the presence of the correspondent banks. In sum, there is one correspondent on each side of that bridge. If you move to the crossroad picture, you see that these correspondent banks are actually not on the picture, and instead there is a network in the middle. This network, facilitated by DLT, or distributed ledger technology, involving a multi-party system with participants as shown from Thailand, the PRC, Hong Kong, and the UAE, and in particular, participants that are both the central banks as well as the banks, can speed up these transfers. So as you can see below the picture, it leads to simpler operations, less fees, no FX settlement risk, higher transparency, and lower reporting burdens. And just to finish up, we are now moving into phase 3 of this project, where we are investigating further development of this prototype. The project is subject to the following current governance. The governance is defined in a charter, and the charter sets out the scope of the steering committee. The steering committee is chaired by the BIS, and it is supported by 4 subcommittees. The subcommittees cover business use cases, technology, policy, and legal matters. Our future roadmap includes a whole list of technology aspects that we believe can be further improved for the prototype to have long-term viability, including other approaches to data privacy, FX liquidity, interoperability, and furthermore, also some other aspects of gridlock resolution and technical platform governance. Our future policy, legal, and business roadmap includes system requirements necessary to safeguard monetary and financial stability, features to achieve compliance with jurisdiction-specific regulations and reporting requirements, legal governance of the platform and designing contractual arrangements, participation models and onboarding criteria for new central banks and participants, inclusion of non-bank players, associated roles in the scope of permissible activities, and finally, trials of business use cases with participating central banks. This finishes my presentation. I hope it was informative. The report is published, and as such, feel free to access it, and feel free to send me any questions via LinkedIn. Thank you.
Thank you so much, Benedict, for the interesting flash presentation on the MCDBC Bridge project. I'm Andrew McCormick, Center Head of the BIS Innovation Hub in Singapore, and it's my honor and privilege to be hosting this session today with Godfried Liebrand, the former SWIFT CEO and current non-executive director at CLS. Vachira Aramdi, Deputy Governor of the Central Bank of Thailand, Herco Stein, the Acting Divisional Head and FinTech Executive Management Department of the Reserve Bank of South Africa. In this session, we will examine the potential for central bank digital currencies, or CBDCs, to make cross-border payments and transfers faster, cheaper, and more efficient. Over the next 30 minutes or so, we'll identify the pain points, explain how incumbents, challengers, and the international community are working to resolve these frictions, and spend some time discussing the opportunity for multilateral platforms using wholesale CBDC. Unlike domestic payments, where banks can pay each other directly on a single national payments platform, there really is no real-time multi-currency platform for cross-border payments and settlements. Improving cross-border payments is a key focus area of the BIS, and that's why the BIS Innovation Hub is working with member central banks across a variety of projects from our Swiss, Hong Kong, and Singapore centers to explore the use of central bank digital currencies in cross-border payments. Benedict described some of the work coming from the Hong Kong Center in the previous flash presentation. Here in Singapore, we're working on Project Dunbar, which is focused on developing a shared CDBC platform and working with central banks and commercial banks, asking such questions as how would we get multiple central banks to share a common platform, who would own and operate that platform, and how do non-local banks access and make payments with CDBCs. We're very fortunate to have central banks who are participants in both of these projects described on this call here, with the Bank of Thailand participating in the MCDBC project in Hong Kong, and the South African Reserve Bank who's actively participating in Project Dunbar. So with that, there is a ton of innovation in payments generally, and cross-border most definitely. The bottom line is that, cross-border payments are inherently more complex than domestic payments. And so I'd like to start this discussion by asking my panelists their views on what are the most serious pain points for the current framework for cross-border payments. And I'll start with you, Gottfried.
Well, I can, of course, list the pain points that everybody always mentions, which is that it's not real time, it takes time, and the sort of transparency of information, where's the money and how much of the money will arrive in the other account. But I think there's some more inherent pain points that any solution will have to address. One is obviously the fact that you're dealing with multiple currencies. So you're dealing with different units of account, and inherently you have to make a translation between one unit of account and another, and therefore one currency and another. And the other one that should not be overlooked is addressability. Addresses are not standardized globally. They can be in local languages, they can be in local character sets, etc. And that's actually one of the pain points that a lot of the current solutions struggle with. If you have to send money, say, from Europe to China, you're dealing with a counterparty that may have a Chinese address that is not standardized, that is written in Chinese characters, but there's no obvious one-to-one translation to Western characters. Many account number systems aren't standardized. The IBAN is used in Europe, but there are many parts of the world that have not standardized on IBANs. So the account numbering systems aren't standardized and interoperable. So I would say that the two inherent pain points that I would like to highlight are the transfer of FX, so currency transfer, and the other one is addressability. And maybe a third one, which is compliance, which I'm sure will come up with others as well. Cross-border payments are subject to much more scrutiny when it comes to KYC, money laundering, and sanctions than our domestic payments. So that would be the third one.
That's great, Gottfried. I think there's some really interesting insights there, and I really only a few of them relate to settlements, actually. So when we think about CDBCs throughout the course of this conversation, actually, it's not necessarily a slam dunk that a new CDBC, a new method of payment, would in fact solve any of those issues. So great points. Vachira, maybe I'll go to you next.
Yeah, if I just add to Godfrey, in addition to cost, in addition to time, and in addition to compliance, in case of Thailand, we have FX regulation also. It's more compliance than just only KYC and AML/CFT, but it's compliance. So we have some rules that, for example, when you send transfer money, you have some underlying. You have to, sometimes the corporate has to submit the document. So you have to check all the documents. And then also we have some limitation. We have some outstanding limits. So it's quite burdensome, and then it's quite costly for banks and for corporates also to comply with the rules. I think that's the pain point of the participant in Thai financial system. But of course, we have some regulation that they have to comply. But if we have something that is easier for them to comply with, I think that will help a lot.
Those are great points. Currency controls and obviously documentation for trade and corporate use cases are extremely relevant. I might point out though, sitting here in Singapore, I do recognize that Singapore and Thailand were actually able to successfully connect their instant payment systems. So, perhaps those fly under the radar of some of those issues, but it does seem like there's some pretty interesting developments happening, perhaps at the lower end of the value spectrum anyway.
Yes,
so with
yes.
That, yeah, please.
Yeah, just to say that is the starting point, and that's why we Bank of Thailand and MBS just starting doing the PromptPay and Pay Now. So it's a money transfer, just retail transfer. It's about remittance, but we still have some limits how much that they can do the transfer.
Yeah, for sure. Herko, over to you to opine on the pain points from the South African perspective.
Yeah, excellent. Thanks so much, Andrew, and a very good afternoon here from sunny South Africa. So perhaps, firstly, from an almost philosophical perspective, I think the most serious pain point is how do we reconcile legacy legal and regulatory frameworks that develop firstly around the existence of some type of central intermediary with innovative concepts such as decentralization and disintermediation. And then secondly, how do we think about the very concepts of cross-border and jurisdiction in the digital age, perhaps again considering the broader context of legacy legal and regulatory frameworks that have evolved to a large extent around physical money moving across physical borders, especially in countries like South Africa, who like Thailand, they also have some remaining exchange controls in place. And then secondly, I think it has been well recorded that when it comes to cross-border payments, the technology is actually not one of the main stumbling blocks or hurdles, as it essentially does what we want it to do, so to speak. Although, of course, the technology plays an integral part in operationalizing the selected design. So I think synthesizing bilateral jurisdictional approaches to effect cross-border payments therefore becomes increasingly complicated as more jurisdictions are involved, with the BIS's Project Nexus usefully demonstrating how these bilateral agreements may be rolled up into a multilateral context or platform. And that is essentially, in short, why I think Project Dunmore in particular is incredibly exciting at the current conjuncture. Thanks, Andrew.
Great. Thank you so much, Herko. There's lots going on for sure in the Innovation Hub, but we will steer this conversation a little bit towards the topic of the day, which is central bank digital currencies. And with that, the Bank of Thailand, as my colleague Benedict Nolans pointed out in the previous session, is involved in the MCDBC Bridge project. Maybe you could tell us from a Bank of Thailand perspective what your journey has looked like over the past few years on CDBC. What's your vision for wholesale and retail CDBCs to address current problems in cross-border payments? And what lessons have you learned over the past few years in this exploration that you might be able to share? Oh, sorry, Vichira, I guess you're on mute.
Unmute, okay. Yeah,
Perfect.
Thank you. So we start from 2018, we start from the wholesale CBDC. We try to use the distributed ledger technology and then try to replicate the payment system just to understand how it works. And then we would enhance payment efficiency. And then after that, we know that the pain point is about cross-border, and then that's why we would like to lay out the infrastructure. So we try to do the domestic payment system first, and then we later coordinate with HKMA, Hong Kong Monetary Authority, try to do the cross-border. We try to explore the possibility of how this can help cut some cost or time that fund transfer, and then we come up with some solution that we have a corridor network. Similar to what Benedict has mentioned in the last session, that we try to see whether we can reduce a corresponding bank and cut the corresponding bank. So it's bank A from Thailand, and then can can submit or can send transfer money to Bank B in Hong Kong directly without corresponding bank. So it shows that this work well, but there is, of course, there will have some implication on some policy that during that time we just only doing the technical one, and now we are lucky to join with the BIS and then PBC and HKMA and also UAE to the Enbridge project to see whether how this will work out well in more just more than only 2 countries. 2 countries is easy, but if multiple country, and then as Godfrey has mentioned, it's about the currency, it's about the exchange, it's quite a lot of things. And then so we would like to explore how this will work well. And then hopefully that this can be the example or can be the starting point that either central bank can join, and then we'll see what will look like in the cross-border payment. But of course, for the Bank of Thailand, in addition to the wholesale CBDC and then cross-border, we try to explore some to see how CBDC will work with corporate. And now this year we are start looking at the retail CBDC. And then if we can complete all this 4 jigsaw, and then we can have a map how to connect wholesale, retail, and then cross-border. So I think this is going to be a new foundation for the payment system of the payment landscape. Thank you.
Thank you so much, Ruchira. It's interesting to see that you're covering all these dimensions: retail, corporate use cases, domestically, cross-border, of course. Knowing that Thailand is one of the countries that has an instant payment system in place. There's been definitely some debate around the world as to when you have instant payments infrastructure, do you even need a retail CDBC per se? So I don't want to put you on the spot, but something to think about. In terms of, I'd be curious to know your thoughts on the genuine need for a retail CDBC coming from a country that already has a very vibrant instant payments infrastructure.
We have a lot of questions from our payment people about this, how this compare this, please compare this to PromptPay, what's the difference, and then how this will be better than the existing. We try to do some experiment. We said what we explain is this is the experiment, not just only the experiment, but we think that the technology will come, and then we think that this is going to be a new foundation. We also always compare this when we use the example use case. We use a typing machine and a computer. At the beginning, when you do the report, typing or computer, you can have all the report, but later you found out that computer can do much more than just only doing the report. They can help you calculate things and then quite a lot of things. So hopefully that is going to be the foundation for the future. Great. And for the existing, maybe it's quite a lot of fragmented payment system. So if we can lay out the CBDC, and then we try to make it like a whole system or a platform. So it will help the fragmentation in the payment system, even in the domestic.
Well, interesting. So very foundational and an opportunity to potentially consolidate a little bit domestically. Herko, I'll go to you next. The South African Reserve Bank is one of the, has a unique perspective because, in addition to all of your, roles and responsibilities within South Africa, you also operate the SADC RTGS, so the regional RTGS, which is, I think, quite an interesting perspective that you can bring to this conversation around, cross-border CDBC, et cetera. A multi-central bank, multi-CBC regional settlement system might be a natural next step, perhaps, for the SADC South African region. What do you think are the areas for improvement, and how can we learn from multi-CDBC projects like Project Dunbar, in which you're a participant?
Thanks, Andrew. So I think firstly, just from a regional payments perspective, the South African Reserve Bank operates the real-time gross settlement system for the Southern African Development Community, or SADC RTGS in short. And it was originally established in part to support and facilitate trade in the region among member countries. So in line with this objective of promoting regional trade, cross-border CBC interoperability and usage from a regional perspective may therefore have the potential to increase the velocity of money by speeding up cross-border payments and therefore stimulate trade and economic activity more broadly in the Southern African region. Then just very briefly on some of our, or as the South African Reserve Bank, some of our insights from operating the SADC RTGS. One of the main challenges we faced is around how do we move from a single currency settlement system in Rand or South African Rand to an actual multi-currency settlement system. I think that's probably the pertinent question, right? So what currently makes operating the SADC RTGS relatively straightforward is the fact that participating central banks have settlement accounts in South African Rand with the South African Reserve Bank, meaning that settlement takes place in Rand. So accordingly, in our experience, the two main challenges in migrating to a true multi-currency regional settlement system, as kind of also highlighted by Gottfried, is firstly around ensuring and maintaining adequate liquidity in several currencies across several borders, with the problem being exacerbated as the number of currencies and jurisdictions involved increases. And then secondly, answering the key question of how do we create a system or solution that does not simply replicate the challenges experienced in the existing correspondent banking model, for example, by positioning central banks as the intermediary. So I think with reference to my earlier comment around the technology not necessarily always being an insurmountable stumbling block, the most pertinent challenges are often not technical, but potentially more operational and even political. For example, reaching agreement on what would constitute eligible collateral for all the parties involved, agreeing on governance requirements, synthesizing legal definitions of settlement, etc. Then I think with regard to areas for improvement, I think because technical capability is not the main stumbling block in the current cross-border payments framework, MCBDC will similarly not be a silver bullet that simply solves all of the existing frictions, as you've also alluded to. And then this, I think, leads to an interesting question as to what is the innovation with CBDC specifically, and how may or can this innovation be applied or leveraged to address the existing pain points that Vakila and Gottfried have so eloquently highlighted. So I think in my view, there are two main value propositions enabled by CBDC in the cross-border context, which should be explored. So firstly, through tokenization, a token-based CBDC allows digital and then crucially cross-border portability of a sovereign currency. And then secondly, smart contract functionality allows for the programmability of central bank money, thus enabling certain requirements to be baked into the CBDC, so to speak. And then just lastly, I think through experimental projects such as Project Dunbar and the BIS has recently concluded Project Nexus, the ability to issue tokenized, digitally portable and programmable central bank money may hold the potential to address some of the existing pain points in cross-border payments. And I think the insights gained from Project Dunbar will be absolutely invaluable in progressing our collective understanding of both the opportunities and indeed also the limitations of MCBDC in terms of the problems it may and can solve and those that it cannot. So in my view, MCBDC will likely over time not only drive closer central bank to central bank cooperation and collaboration, but potentially also closer central bank to private sector cooperation in pursuit of a common goal. And let me then perhaps just conclude by adding that we are very much aligned to the BIS view that money remains a public good, which should continue to be provided by public rather than private sector or private entities, and that CBDC generally and MCBDC specifically may therefore allow central banks to retain and potentially even strengthen their monetary sovereignty in the digital age, especially from a cross-border perspective. But let me stop there. Thanks so much, Andy.
Oh, thank you so much, Rico. There's a lot there to digest. Obviously, the regional potential of these platforms is one thing that comes to mind, but obviously the programmability money and the promise of programmability is also one that might help address some of those frictions that were identified earlier. Gottfried, you've been very patient. Thank you. We've heard from a couple central bankers now. I would love to pick your brain. You as former CEO of SWIFT, now representing CLS as a board director, and of course a recent author in the realm of payments. I would really love to hear your thoughts on the conversation thus far. Do you think CBDC is really a solution?
I think it's a fascinating one to look at. I would like to make a few points though. I think we all focus here on the use of CBDCs for cross-border, but I would think that the main use case of CBDCs is of course domestic usage, and it has to be domestically adopted, I think, before you start using it for cross-border. it feels a little bit that if cross-border is the real reason for introducing a CBDC, that's almost the tail wagging the dog, right? A CBDC should be focused on domestic use cases, of which there may be quite a few. For cross-border, one thing to also keep in mind is that cross-border is a moving target. It's a moving target in two ways. One is it's growing very fast. So in terms of cross-border use cases, I think both the number of cross-border transactions is going up fast, volumes are going up fast. What people use it for is going up fast, especially in the online world. Online commerce, by definition, is more cross-border than domestic commerce. So there's a huge demand there, I think, for good cross-border solutions. But it's also a moving target in terms of current solutions being offered. And the current players are not sitting still. And I'd like to mention a few that will find themselves competing with the CBDC use cases. First of all, there's cards and credit cards, which are proving to be quite a good solution for cross-border commerce. And I think added to that are almost interlinking domestic systems that is now being done by acquirers. And I'll explain what I mean. But if I now buy something as a Dutchman, I buy something on an American website, some of the acquirers will allow me to pay with my domestic scheme, right? They will allow me to pay in using the domestic real-time scheme in Holland, which is called Ideal. And at the back end, they will just make it work. And there are a number of service providers that have popped up, FinTechs that provide the technology for that, basically by maintaining lags in all the different systems. But they are de facto providing interconnectivity of domestic real-time systems, invisible to the customer, but the effect is the same. You're able to pay for US transaction using your domestic system in your own country. So I would say that that's one, and that's facilitated by indeed the acquirers that are popping up, the Adyen's, the PayPal's, and all of those type of players of this world. A second one that is also stringing together cross-border domestic systems are players like Wise. Wise similarly allows you to transfer money cross-border, but in many cases you're allowed to do the pay-in using a domestic system. Sometimes it requires a bank transfer, but in many cases you can use the domestic real-time system to pay in. Wise will inject it in the real-time system in the country of the destination. So de facto too are stringing together these national systems. The next one to mention here is the BIS's own Nexus project that is aiming to almost provide a set of standards and governance frameworks, etc., to industrialize that interconnection of domestic real-time payments. So that would be a third type of contender. And then, of course, there is cross-border banking itself, correspondent banking itself, right? SWIFT and the banks that make it work. That too is not sitting still. I should mention first the GPI project that SWIFT launched, I think 5 years ago now. A couple of remarks on that. One is that has greatly sped up correspondent banking. But it also made visible that for many of the transactions, the chains aren't that long. In many cases, it only involves two correspondent banks, namely the sending bank and the receiving bank. And in many cases, they have a direct relationship. So we always talk of these long chains in correspondent banking, but I think the average chain is either two banks, just the sending and the receiving bank, or a third bank in the middle. And that covers the vast majority of chains. And then, yes, there are cases where it's much longer. So correspondent banking itself launched GPI. SWIFT recently joined SWIFT Go, specifically aimed at smaller transactions, making them cheaper, making them faster yet again. So that would be another one. So we should not expect banks and correspondent banking to sit still either. So in that sense, I think it will be a very interesting race. The pain points are being addressed by others than CBDC. And then we'll have to see whether CBDC does a better job than all those alternatives in addressing these pain points. And we'll get traction with customers, business and consumer in the end. So that would be a bit my view.
That's great. Thank you so much, Gottfried. And Project Nexus is one near and dear to my heart, having come out of my shop here in Singapore, but very familiar with all of the services you mentioned. And I do believe that there's a ton of innovation happening in those more traditional realms by all kind of stakeholders in the ecosystem. So couldn't agree more on that frontier. We are just coming up on about 5-6 minutes left. So maybe I'll just issue the last kind of all play question here. Basically, the conversation, the BIS has been obviously focused heavily on CDBC. Most of the central banks, the 80+% are researching, and over 60% are actively experimenting. And many for many years now. I know for sure South Africa, has been in this CDBC research mode for quite a number of years. I used to work in Canada and worked heavily with the research program in the Bank of Canada. So I think one question I often ask myself is, are we moving fast enough? There's certainly a lot of other innovations happening even beyond what have been mentioned on the call, and so I would put that out there as the first part of the question. And secondly, how can we be more effective, certainly as a central banking community, but even more broadly to you, Godfried, in kind of accelerating the pace of innovation? So maybe I'll start with you, Vachira.
Thank you. So the question is, are we moving fast enough? I think the central bank moving is maybe a little bit slower than the private sector. But of course, we have quite a lot of concern, and then we have quite a lot of challenge. For example, on the cross-border payment, the issue, especially for the small open economy like Thailand, the implication of capital flow management is quite very important for us. And then how we deal with this kind of the issue, in addition to monetary policy transmission, financial stability, and financial landscape. If CBDC happen, I think this is going to change quite a whole new landscape. So these are kind of things that central banks are concerning, and then that's why maybe we move a little bit slower than the private sector. And one thing I would like to respond to Godfrey is about CBDC. One thing that is more efficient than the bank, I don't know, but it can do P2P. It means that we can sometimes that we can transfer money without having banks. I can transfer money to you directly. So I think that is one thing that I don't know how commercial banks or how private sector thinking about this and then compete with this. I'll stop here because you have only 4 minutes left. Thank you.
Great. Herko, over to you next.
Sure. Thanks very much, Andrew. Maybe just like I think Godfried also raised an interesting point as kind of MCBDC not being the main use case for CBDC. I think it's interesting, and it's an iterative process around how kind of CBDC or the CBDC dialogue is evolving. So I think initially starting with domestic wholesale kind of CBDC, then moving to domestic retail, then I think kind of cross-border wholesale, and potentially then over time again very much potentially kind of retail in CBDC across borders. So I think CBDC exploration therefore kind of remains a very iterative process, and I think we almost have no choice as central banks but to move slower rather than faster, and to essentially just keep dialoguing, keep an open mind, and walk before we run. And again, I think if we don't kind of take a gradual approach, it's unlikely that central banks and all the other role players and stakeholders involved in kind of CBDC, whether it's retail, wholesale, multi-currency, will be ready for multi-currency CBDC in 5 years or 10 years' time. If we don't start with kind of realistic and smaller milestones in the interim, and maybe just in concluding, I think your boss at the BIS Innovation Hub, Andrew, his sentiments around how do we as central banks move fast without breaking things very much remains the pertinent question. Thanks very much.
Thanks, Herko. And last but not least, Godfried, I'll let you close out the session here.
So are central banks moving fast enough? Well, I mean, since central banks are about money and stuff that when you get it wrong tends to blow up spectacularly, they tend to be conservative, and maybe we should want our central banks to be conservative given the stakes that they are. And the private sector, I think, is moving quite fast. Where maybe I would want the central banks to move a bit faster is on the policy side, in providing frameworks for all that private innovation that is going on. There's a whole lot of players out there that are reinventing what banks have been doing traditionally, that are transporting money in a new way. And I think that does require some form of regulation. And of course, you don't want to regulate it to death, but you also don't want to allow for massive regulatory arbitrage where people use sort of these new forms of money to escape the regulations that were put on banks for good reasons. And I sometimes feel that central banks, and understandably so, are a bit wrestling with how to regulate all that innovation that is coming out there. But that is perhaps an area where I would want to see them move in pace with the market that is innovating at breakneck speed, indeed.
Yeah, some great insights there, and very much agree on kind of the regulatory perimeter issues, and frankly, I do believe that regulation is something that's it's mandatory for all of these new forms of innovation eventually, and ultimately a barrier to even those things becoming mainstream, because certainly the vast majority of people don't want things to blow up and want their funds to be held in good stead and to have some assurances. So. Definitely, that is a key focus of the BIS in certainly other areas other than the BIS Innovation Hub, but we're very cognizant of that as we explore our work. So thank you all so much for your time. I really appreciate your participation on the session this morning in DC, this afternoon in South Africa and Europe, and this evening in Thailand and Singapore. It's been an absolute pleasure. Really hope the audience enjoyed the session, and with that, I will move us on to our next flash presentation.
I am Stephen Schwartz. I'm a professor at Duke University School of Law, and my topic is regulating digital currencies. Digital currencies are monetary currencies that are evidenced electronically, and they're not in physically tangible form. Large so-called wholesale payments among businesses and financial institutions already occur digitally, and Bitcoin has been with us for more than a decade. But several recent events have catapulted the prospect of a retail consumer-used digital currency. For example, the People's Bank of China has been working on a retail digital currency for years, and now has trial runs ongoing in 4 cities. In response to these events, governments and multinational organizations have begun exploring the feasibility of developing retail currencies for both domestic and global payments. There are 2 categories being considered. One is so-called digital currencies sponsored by government central banks. That's referred to as CBDC, central bank digital currency. Another is privately issued digital currencies, and these are basically secured by cryptography, and for that reason, they're known as cryptocurrencies. These cryptocurrencies can be divided into 2 portions. One would be those like Bitcoin that are not backed by assets having intrinsic value. The other is privately issued digital currencies that are backed by assets having intrinsic value, such as the US dollar or other, fiat currencies. Privately issued digital currencies that are not backed by assets having intrinsic value basically have an unpredictably floating market value, and they can't really successfully be used for retail currencies for that reason. So for the private cryptocurrencies, I will focus on so-called stable currencies, those that are backed by fiat currencies or other assets having intrinsic value. Consider now how to develop these types of digital currencies. For CBDC, central bank digital currencies, governments are considering 2 types. One would be account-based, and the other would be so-called token-based or secured by cryptography. And different jurisdictions are taking different approaches. The European Central Bank is considering a token-based CBDC, and their goal is to preserve cash-like privacy for their currency. In the United States, we're considering both, but I think the emphasis will be on more of an account-based central bank digital currency. And the main reason is that we already have a very robust system, as I mentioned, of a wholesale account-based digital currency. Now, in terms of regulation, regulation raises both innovative legal issues that deal with the digital currencies and the types of issues normally associated with currencies and payment systems. An account-based CBDC could operate, as I mentioned, through the electronic fund technologies already in place at commercial banks for wholesale funds transfers. And the system is simple, and let me illustrate by a diagram here. So this illustrates it, since we focus. You would have, for example, a customer, Joe, right now would be a bank in wholesale, but for retail, it'd be like a individual. And Joe would give a payment order to his bank to make a payment to Sally's bank. And Sally's bank, upon receiving the payment from Joe's bank, would then put the funds into Sally's bank. It's extremely simple. It's already covered by commercial banks, and there is no change in technology that would be needed. Okay. Regulation of the central bank digital currencies, account-based, would cover, as I mentioned, a range of typical issues that are currently covered: risk of loss, counterfeiting. In the United States, Article 4A of the Uniform Commercial Code, UCC, already covers these risks for wholesale currency transfers, digital currency transfers, and there would be very little that would need to be done to basically have that adapt to retail currency transfers. Regulation also should cover privacy, money laundering, and consumer protection. And for a retail central bank digital currency, regulation would have to innovate to address those issues. Let's now turn to stable coins. Again, these are privately sponsored and issued digital currencies. And the main issues with stable coins, in one sense, parallel those with a central bank digital currency, with one major difference, and that is that the value of a stable coin is critically dependent upon the ability of holders of the stable coins to redeem their stable coins for the reference assets at a set exchange rate and on demand. And the failure of an issuer of the stable coin to basically redeem those stable coins, or even the perception that it can't redeem those stable coins, could cause the equivalent of a bank run. And so any basic regulatory framework, essentially for stable coins, needs to critically address this redemption issue. And there are various ways that can be done. Facebook is considering a stable coin, originally called Libra, now called Diem. And this would be, the redemption obligation would be backed by a managed reserve of the underlying reference asset, US dollars. But all these ways of assuring redemption would be very expensive. And I've basically posited that where the reference asset is an underlying, is the fiat currency of a government, where the sponsor is located, there could be a strategic public-private relationship between the issuer, i.e. sponsor of the stablecoin, and the government, where effectively the stable coins are protected by the government, the redemption, like an insured deposit in a bank, for which the sponsor would pay the government a fee. And also, in order to reduce some of the financial instability risks I'll mention, give the government some control over the issuance of the stable coin, so the government has policy protection of its money supply. Turning now to cross-border stablecoin payments and CBDC payments. From a CBDC standpoint, I don't think there would be any major issues. Central banks throughout the world traditionally worked together. And the Basel Capital Accords show how well that works. From the standpoint, however, of privately issued stablecoins, you have two issues with cross-border payments. One is that ordinarily each government will have its own law, and that would create a multiplicity of laws, which can be very confusing and costly. And for this reason, I'm advocating that there be a uniform model law that sets forth the overall rules that all nations could abide by. And uniform model laws are very typical for cross-border transactions. Indeed, the Uniform Commercial Code in the United States, the UCC, is a uniform model law that's intended to unify or make parallel the laws of each state of the United States. Another significant challenge, of course, is you have the redemption risk on a cross-border basis. How do you try to protect against that? And the type of public-private partnerships I've discussed could begin to protect against that. But there are other issues I don't have the time to develop. There's also the interconnectedness of the financial system that could create financial instability if a large sponsor of the stablecoin were to become insolvent or collapse. And that parallels what happened during the 2007-08 financial crisis when Lehman Brothers went into bankruptcy. And the article I've written goes through ways to protect against that. Finally, question of supervision. In a cross-border, in a CBDC with the central banks, they logically would come up with some central bank supervisor. But for global stablecoins, again, private issuers, it's more complex. And I argue that there should be at least an international body to supervise cross-border stablecoin payments. Such a body might be modeled, for example, on the Financial Action Task Force, the FATF, the intergovernmental body that produces best practice recommendations for combating money laundering and terrorist financing, both domestically and across borders. Thank you very much.
Well, that was a very interesting conversation. Stable coins, Bitcoins, FATF, international regulators, and the like. We are delighted to transition to that conversation to one with one of the leading figures in the world of digital asset infrastructures globally, Joe Lubin. Thank you so much for joining us again as now, I guess, a veteran for DC FinTech Week.
Thanks for having me, Chris.
So as we heard in that last presentation, there are lots of different issues. We began the conference with General Manager Augustine Carsons talking about CBDCs and the work that the BIS is putting with CBDCs. As those projects are unfolding, there are a number of important projects unfolding on the Ethereum network. But how do you sort of bridge those two developments? I mean, what does Ethereum look like in a world of maturing CBDCs?
Well, Ethereum is doing beautifully to this point, and the future of Ethereum remains enormously bright, either in conjunction with CBDCs or if some bizarro world happens and CBDC networks are not connected to public mainnet networks. Essentially, nation states have the opportunity right now to build CBDCs as pure monetary systems, or more ambitiously, they can take the opportunity to consider them the foundation of many elements of the next generation digital economy. To build more powerful systems, it makes sense to build CBDCs on a smart contracts capable platform like like the Ethereum technology. So you can either do that in a more controlled nation state implementation of the technology, or you could potentially even, as the technology matures, you could potentially even build on public mainnet. Ethereum is achieving scalability pretty rapidly, and there's a good reason to believe that we'll be at hundreds of thousands of transactions per second and eventually millions of transactions per second if you consider the whole decentralized protocol ecosystem and how it'll be modular and many different elements will connect into one another via bridges. So in my opinion, interoperation of CBDCs with public chains, whether the CBDCs are smart contract capable or not, seems inevitable, and it would certainly be most valuable for all concerned if CBDCs were able to move across bridges to different networks. We do a lot of bridging in our own ecosystem where tokens can move from one blockchain system to another and participate in different activities on the different networks. And I expect that that will be very fluid and standard in the future. But ultimately, dependent on what happens with CBDCs and public blockchains, the value proposition of Ethereum is to be one of the main elements of a new trust foundation for the planet. So we are in need of moving from subjective trust infrastructures, more centralized trust infrastructures, to automated objective trust as a foundation. Automated objective trust is enabling the development of decentralized finance. And those two platforms are really going to be able to serve as a foundation for re-architecting lots of systems that run society on that sturdier set of foundations. Your question also assumes that that a U.S. dollar.
Right. I mean, I think part of that question and is how do you sort of bridge, which is really interesting. I mean, just in your answer right there, you're talking about, on the one hand, the very important role that the Ethereum network is playing in the DeFi system, but then you're also having one eye sort of looking at the development of CBDCs, and one of those. Obviously being here in the United States with the digital dollar, potentially, I guess really two sort of follow-up questions to your initial response. Number one, just leading consensus, is that even at times a bit of an interesting balancing act, sort of looking at what the government infrastructure rollout looks like on the one hand, and then looking at all these other private projects. And then when you look at those private projects, whether or not they be in DeFi or other sort of areas of the ecosystem, do you have to also judge their ability to survive a future in which either a digital dollar or other CBDCs become much more important or mainstream?
Well, Consensus has worked on multiple CBDC projects around the world, so we do have some insight into that world. A lot of that world is moving slowly, prudently. There are some projects that are moving a little faster in some parts of the world, but it makes sense to be really careful. These are big, important systems. Societies, economies are based on them, and it's not super urgent, I think, for, let's say, the United States to move extremely quickly, although developing expertise immediately is really important. So there will be, and there are interesting private implementations of stablecoins. Some of these are backed by dollars in a bank account or other kinds of assets. Some of the really interesting ones are are algorithmic or are over collateralized systems that are entirely resident on the blockchain. So I'm in favor of regulating the use of a new technology when it is effectively a next generation implementation of the US dollar. But it'll be interesting to engage regulators in the debate about whether something like MakerDAO's DAI, which is entirely resident on Ethereum, should be under their jurisdiction or regulated at all. And your question does presume that a US dollar stable, US dollar CBDC is the holy grail. Nation states are printing a lot of money right now. These systems are pretty challenged, and there are many who think that that we might need a new monetary regime at some point as inflation potentially kicks in very, very heavily. We are at in years 70 something or 80 something of a debt super cycle, and monetary systems shift. The blockchain ecosystem thinks of Bitcoin as a digitally sound money, similar to how the world thinks of gold as sound money, because there's a limited supply. And Ether is moving from a regime in which it is disinflationary currency to one in which it will be deflationary. And some people are calling that ultrasound money. And Ether is a utility token, so we don't intend to use it so much as a currency, but there are stable currencies being built on that are better for day-to-day transactions. And it may be the case that over the next few years, as these systems get bigger and more liquid and a ton of value moves into them, that they do present a viable alternative as stores of value and as currency systems that are built on top of those two tokens, Ether and Bitcoin.
Well, for sure, Ether has also, or has entered into the parlance from time to time, just like Bitcoin, as a kind of store of value. But certainly the Ethereum ecosystem is changing a lot. One of the most notable and obvious changes, especially this gets back to your original sort of comment in terms of transaction volume and speed, has to do with the transition to a proof of stake system. It's something that we had talked about last year. Maybe could you just sort of provide the audience with a bit of an update as to where that currently stands in terms of that shift? What have been the lessons sort of learned and what you've seen as you've undertaken this transition? And also, is it something that you think other kinds of public blockchains might want to consider?
Yeah. Ethereum is currently a proof of work chain. We wanted to implement a scheme called proof of stake early on, but realized that there were some complicated edge cases in the known implementations, and we knew we could implement proof of work well and eventually evolve the system to proof of stake. Proof of work has some great characteristics. It also has some issues. One main benefit of proof of work is that the initial distribution of the token is much fairer. You don't have the problem of who decides subjectively how many tokens people get. It's an open competition. In virtually every other way, proof of stake is generally superior. Proof of stake famously is far more energy efficient and economically efficient. You're not buying manufacturing expensive custom hardware. You're not burning a ton of electricity. Proof of stake is orders of magnitude more energy efficient. There's a low barrier to entry to becoming a validator. You don't have to set up a big hardware rig. Instead, you can just run it on a service on the internet, or just run some software on your laptop. It does not benefit from the efficiencies of scale, and that's a good thing. That means that the larger, wealthier validators do not have an advantage over a small hobby validator. And therefore, it enables greater decentralization. We've seen this recognized on Ethereum 2, where there are about 80 million Ether staked, close to $30 billion staked in this system. Ethereum 2 represents an element of the future of Ethereum. Ethereum 1 and Ethereum 2 are going to be merging pretty soon, probably in Q1 or Q2, effectively leaving proof of work behind. Also, it's a more secure system, proof of stake. It is prohibitively expensive to attack the system, as you need to acquire enormous amounts of the native token instead of just figuring out ways to acquire access to lots of hardware, possibly for just a short period of time. So yeah, as you indicated, proof of stake or proof of work chains, and there are other proof of stake chains out extant that are operating well. Proof of work chains are facing criticism by many for excessive use of energy. There is a drive in the Bitcoin space to use cleaner, more sustainable forms of energy. So we'll see how that works out. Proof of work is a religion in the Bitcoin ecosystem. It'll be hard to get core developers to think past that, and maybe Bitcoin will be a driver for better, cleaner, efficient energy systems. But I do expect there'll be lots of pressure to either prove the use of clean energy or migrate even Bitcoin to becoming a proof of stake chain in the future.
I can hear minds exploding across the internet from the Bitcoin maximalists who are hearing that, and later on in the week we're actually going to have a sort of an ESG and crypto panel.
A lot of energy being burned on Twitter right now.
Sort of to tackle that question. And I think it's really kind of interesting, when you're trying to think through those both the technical trade-offs, the governance trade-offs, because as we'll also hear, later, the preferences with different governance architectures have to deal with predictions, ultimately about how they feel about the control over a system, and proof of stake. They'll say, it leads to more as opposed to less centralization. It doesn't really matter because, or it matters dramatically, but from a regulatory standpoint, and we do have lots of regulators, they ultimately are thinking about, centralization not as a structural issue per se, but as a larger governance question. The governance questions and issues, just like the architecture, are a moving target, and they're constantly evolving. And so the regulators are trying to figure out exactly how do they position their own posture towards any particular tokens and token projects and ecosystems. I was struck because you did sort of mention MakerDAO, and obviously you're a kind of you're helping to work on a system that is a base layer infrastructure that supports all kinds of different projects. Some of those projects themselves may not necessarily have regulatory clarity and are facing varying levels of scrutiny. What does that actually mean, either business-wise or regulatorily, for Ethereum, given the fact that whether or not you're talking about the DeFi space, which is the most obvious space, but other kinds of applications where there may not necessarily be clarity, and how does that, or does that sort of trickle down to you?
Yeah. So First, should be clear that we in our ecosystem consider decentralization to be good. More decentralization is better. And we recognize that this decentralized protocol technology is incredibly powerful, but we need to have discussions with regulators to appropriately situate it in different nation states with different political philosophies. And I think it's, I think the principles of free market capitalism, liberal democracies map incredibly well onto the technology. Regulatory clarity is extremely important to us, and we're going to work hard to help regulators and society understand the benefits of the technology. You want the rules to be reasonably clear, so we can all know what to do. If there isn't regulatory clarity in a particular country, as we've seen, actually, you'll see projects, companies, or non-companies that are actually companies, but sort of refuse to admit that they are companies, essentially gravitate to other jurisdictions, and the regulatory arbitrage game is being used in our ecosystem. We're engaged with regulators. We have been since, in many ways, we both share similar goals, like protecting market integrity, building market confidence, and certainly minimization of illicit transactions and harm. And to be clear, most regulators that we've spoken with are interested in threading the needle, not trying to squelch innovation. And industry leaders, we all need to continue to educate, to engage with regulators, because the right rules can accelerate the development of digital assets, not just reduction of uncertainty.
Do you have a sense? I mean, you know, because your vantage point is kind of unique. I mean, you know, precisely because you're dealing with, or you're seeing projects that are evolving at the base layer. You have layer 2 questions. You have the transition. You know, do you feel that the overall velocity of clarity? I mean, do you feel like that there are some places that are moving faster than others? Do you think that this is about what you would expect, given the fact that these are complex issues? I mean, when you look at the law from a technologist standpoint, you know, and now that you've had a long time to sort of think about it, and to see law in action or regulation in action, I mean, are there any surprises to you even today, or now do you feel more or less comfortable with the pace and what you've seen?
So it's moved slowly in this country, but there hasn't been much harm done. We feel that the SEC has done what it needs to do to take down some bad projects, but it's also, it seemed to operate with a cadence of stop this fraudulent thing from happening, say something positive about Bitcoin, stop this other fraudulent thing from happening, and also indicate that it believes that Ether is sufficiently decentralized and therefore an economy. The most important thing for the US to do right now is to not engage in knee-jerk reactions. They can make for bad policy. We need to act and not react. And the people in our ecosystem are organizing increasingly to help educate and to collaborate.
Well, thank you so much again, Joe, for joining us. It's a pleasure every year to get an update as to what's going on in your neck of the woods and in the Ethereum ecosystem. We always appreciate your time.
Thanks, Chris. Have a good.
Hi, my name is Carmel Cadet. I am the founder and CEO of FinTech. We are building for modern central banking because we see the opportunity to solve for the financial inclusion problem. Central bank digital cash, also known as central bank digital currency, is a very popular topic today. But let's talk about how it can become a catalyst for inclusion, stability, and resilience. There's a shift happening today. Regulatory innovation is needed because central banks' public policy have not changed for over 100 years. The innovation that's happening in the retail financial market has not yet been really understood when it comes to consumer protection, when it comes to money laundering, and when it comes to solving key challenges in the economy. There are three key pillars that we think are very important for every central bank, and as central banks look to issue central bank digital currencies. There is an amazing opportunity to solve for financial inclusion. It's not just about the unbanked, but it is a big need, a big unmet need by people who are looking for new financial services, for people who are looking for digital financial services, and the billions of people who are still unbanked and underbanked. The demand for financial services has exploded, and that has led to the emergence of financial technology and financial technology innovators. CBDC should not just be a software application, should not be done just for the purpose of installing new technology. It is about building a modern infrastructure. Introducing cash in a natively digital way can not only bring financial inclusion by design, but drive to stability if it is well designed and integrated into trade policies, and also be very cost effective for users. The third leg of the pillars is regulatory frameworks. It is absolutely paramount for the ecosystem and the broader financial sector to understand the risks, understand the innovation, and understand how to protect consumers. And as regulators, the importance of regulatory clarity to provide the strength, the protection for users, and the resilience that the overall market needs. So let's talk about what true inclusion really means. It's not just about the users, but it starts there. The users are asking for more financial services. We're moving into a digitally connected world. Digital assets are becoming more the norm. And therefore, users are asking for how can they pay and how can they engage in modern ecosystems with money? What does money look like in a globally, digitally connected way? It is not just about the unbanked. It is about the demand. It is about the need. It is about the change. And therefore, there's an emerging ecosystem that is driving and servicing this new need. It's not just the banks, and the banks can't do it alone. And we've seen the emergence of FinTechs and now digital asset banks and neobanks that are servicing new markets and new users and addressing their unique needs better than the traditional bank can. There are also new services emerging. When you think about access to credit in the US, it can be very different from access to credit in other regions, like where I'm from in Haiti, or in Asia, or in Europe, or in Africa. Therefore, services that address key problems and key needs and the demographics and the technological advancements in those regions are driving more services. And what does financial services look like in the 21st century? So when we think about regulatory reform, when we think about infrastructure, understanding the need of the users, understanding the new ecosystem that's servicing them, understanding the services that are addressing their needs is paramount. So the technology for a central bank digital cash, it's also very important to think about. Given the user's needs, given the ecosystem, given the services are emerging, central banks, as they think about issuing central bank digital currencies, are looking at technologies like blockchain. Because the emergence of Bitcoin and cryptocurrencies, it's very important for a central bank to think about how to issue their digital cash. We think tokenization and trusted governance are paramount. Blockchain technology is emerging and it's new, but it is absolutely worth studying and understanding and testing, because it allows a central bank to not only issue their cash instead of printing it digitally, but it allows them to have trusted mechanisms that offer proper accounting, trust in the system, and efficiency and privacy for users. And those are absolutely key benefits into introducing any CBDC. But now we're also seeing an emergence, a priority and a focus on energy efficiency. We know that traditionally Bitcoin has been highlighted for their high energy usage, but it's not the only option. But it should be a key pillar in any technology that a central bank looks at when it comes to introducing their CBDC. We saw a comment from the G7 central bank governors and ministers from the meetings last week, and we agree. Any technology and CBDC that is deployed by a central bank should take into consideration and have as key performance indicators their energy efficiency. And we like the idea of a green CBDC. Also, an API first model. In order to service the users and the broader ecosystem and the new services that are emerging, central banks can find a lot of synergy and around introducing and allowing more partners in the broader ecosystem to connect directly to this infrastructure that we're talking about. And that can reduce risk, that can give more visibility, that can provide resilience, and that can drive more stability in the market. By having fintechs and more players connecting directly with central banks, we think an API first model is a key design feature and how to scale and how to do it cost effectively and how to be future proof. But the third leg is also very important. Last but not least, the regulatory innovation space is absolutely needed in order to foster the results that we are anticipating. It's important to prioritize the outcomes. It's important to keep an open mind and understand that innovation and financial services and technologies are evolving much faster than we can keep up and understand at a time. And that's why we see the power of regulatory sandboxes around the world that really emerging. That allows a central bank and regulators to collaborate with the broader ecosystem to understand the emergence of those new technologies and the problems that they can solve. There's a win-win here. And being able to provide safe and drive safe innovation into the market, but also collaborate with partners, collaborate with the innovators, and provide guidance on how to protect consumers and how to maintain stability in the market. Ecosystem access, regulatory frameworks will need to be updated and revised, and we're seeing that happening in the US already with the emergence of cryptocurrency exchanges, of stablecoin issuers and digital banks. We are seeing an emergence of having more access to the ecosystem and providing more access to the ecosystem, where now fintechs say they want to connect to central banks directly. And we think there's a lot of value in doing that. Regulatory frameworks, being able to provide clarity to the market. As regulators, as operators, central banks are in the center of providing that clarity and being able to nurture that innovation in the technology and the challenges that innovation can solve. You know, we see the central banks as catalysts, but they can't do it alone. Therefore, enabling the ecosystem to help them better deliver on their mandates, solve problems that they can't, address certain key risks more efficiently and more cost effectively is a major opportunities for central banks and the broader ecosystem at large when it comes to solving the problem of financial inclusion. It is time for true inclusion. Thank you.
Welcome everyone to this session on central bank innovation, making the financial system safer with technology. My name is Carolyn Rogers. I'm the Secretary General of the Basel Committee, and I have the great pleasure today to be your moderator. We're privileged to be joined by three great speakers who will share their perspective on technological innovation in financial supervision. Let me introduce them. Helen Picard is a Senior Manager at the Bank of England and the European Chair of the BIS Innovation Network SupTech and RegTech Working Group. Lucas Kubicki is the head of SupTech and Innovation at the European Central Bank. And Per van Zelewitz is a director at the Innovation Center of the Federal Reserve Bank of New York. Welcome, all three of you. It's clear we've got great experience for our panel today. So certainly I can say from my vantage point that the promise of technology to improve both the efficiency and the effectiveness of financial supervision is a hot topic that's gaining attention at the Basel Committee and with supervisors around the world. The constantly increasing complexity and the speed of change in financial markets and banking really necessitates some innovation in how we go about the job of supervision. So in our session today, we'll examine some of those innovations. In particular, we'll look at how technology is being harnessed for financial supervision, the tools that are being developed, and the opportunities and challenges that supervisors are encountering. Without further delay, let's hear from our speakers. Helen, I'd like to start with you. Supervision is a job, in my mind, that requires both good information or data, as well as sound judgment. And I'm interested if you see SupTech as a solution for both of these things. So does it enhance both the information available to supervisors and also improve their judgment? Or is it more about adding to the quantity and quality of information? Over to you.
That's a great question. Thank you. I think SupTech is at the heart of the modern supervisor. In the PRA in the UK, we are seeing our growth of information, both in complexity and volume, change massively. We receive more than 1 billion rows of data every month. And we apparently receive the equivalent of the entire works of Shakespeare twice every week. So the need to evolve from Excel into modern technology and SupTech is absolutely at the paramount of what we do, because we have to evolve both our skill set and our technology. So I don't think that is one without the other. I think as a modern supervisor, you need your judgment, you need content knowledge and experience, as well as modern technologies. But SupTech is a growing area and a changing area. So it's quite hard, actually, as somebody who's trying to set out the plan for the PRA, is to say what the technologies will be precisely and how they will resolve precise problems both today and in the future, because it is changing rapidly. So I think this is where we focus more on the human element, the judgment. The judgment is always going to be there and constantly be at the core of what we do, and just enabled and empowered by technologies, and SupTech is the key for us. However, I think that the human intervention is always going to be key, but we just need to kind of keep enabling our supervisors with more and more SupTech so they can get more real-time, more relevant information to make their supervisory judgments based on a growing and complex world of data.
Thanks, Helen. So basically, if we can use SupTech to navigate, as you say, the volumes and volumes of data that supervisors get, we can make more time and more room for them to exercise that judgment that's so important to supervision.
Absolutely. I think there is a growth of opportunity for efficiency and effectiveness in our supervisory judgment. We spend a lot of our time manually getting Excel spreadsheets and trying to do analysis. There is more modern ways to cut and slice the data and visualize it, and therefore get a greater idea of what's going on with the firm, the issue, and the global position than ever before. So it's just refreshing and empowering ourselves to deal with the digital economy.
Super. So let's move to Per now. Per, can you give us a couple of examples of specific types of technology that are being used by financial supervisors? Perhaps some data analytic tools, that type of thing, things that are being used in the field right now.
Great, thanks, Carolyn. And before I go into any details, I just have to start with a disclaimer that the views that I express are my own and do not necessarily represent those of the Federal Reserve Bank of New York or the Federal Reserve System. Before I dive into some details on the tools and technologies, as you referenced, the supervision landscape has never been as dynamic as it is today. So scale, speed, and complexity of related challenges and opportunities are all increasing. And this is really what's influencing the types of technologies and tools that are being used today. So a couple of the trends that are key influencers in this area are the supervision of non-legacy financial institutions, including digital banks, non-bank financial institutions, which is a significant new influence, but also emerging risks such as climate risks, crypto assets, tokenized assets, and other areas that are of importance to supervision. And there are new technologies and tools that are helping supervisors advance both from a hygiene standpoint, so basic improvements relative to efficiency and those kinds of performance characteristics, but also more advanced capabilities. And if you distill the supervision function down, it's really one that relies on ultimately effective access and use of data to perform its core functions. So a lot of the technologies and tools just relate to that. So one area that I think supervisors are using, starting to use more and more, and will be an area where they continue in the future, is to deploy elements of a data fabric. So a data fabric is generally a single environment that consists of a unified architecture and services or technologies running on that architecture to help the supervisor manage their data ultimately. So the goal of the data fabric is to maximize the value of the data and ultimately accelerate digital transformation across the organization. Another area is relative to robotic process automation. So supervisors are using RPA to introduce efficiencies into existing processes that ultimately save time, enable supervisors to allocate their precious time more towards high value activities as opposed to manual processes. The third area is related to natural language processing, or NLP. NLP is a branch of artificial intelligence, AI, that enables machines to understand the human language. So its goal is ultimately to build systems that can make sense of text, automatically perform certain tasks like translation or topic classification. And NLP will help with the extraction of data and insight from existing data sets, but also data that can be accessed in different formats. And a final area is related to machine learning. Machine learning is another type of artificial intelligence, so it falls within that category as well, and is used to process large quantities of data very quickly. So it also uses algorithms which will change and learn over time. So when we're thinking about the analysis and the insight that supervisors need to generate, machine learning can be used to improve the quality of that insight over time and really convert manual processes to automatic. So these types of technologies are focused on lowering cost for supervisors, increasing the consistency of the work of the supervision function, but also increasing the speed and fidelity of insight that's being generated.
It's great. Thanks, Per. Lucas, let's come to you now. European supervisors have launched something called the digitalization blueprint, which I understand is meant to sort of lay out a strategy or a roadmap for the use of technology in financial supervision. Can you maybe tell us a bit more about this initiative, how it came about, what are the lessons you've learned, and what insights you might be able to give to supervisors, other supervisors who might be contemplating something similar?
Yep. So when we started to work on digital innovation here in the European Central Bank and the European supervision landscape, we saw that there were many initiatives already ongoing. Many colleagues across Europe working on different supervisory technology projects with similar challenges and often with similar scopes. And what was very important to us was to connect the dots, to make sure that we don't duplicate the efforts, but we reach the synergies. And to address this, we have established a dedicated supervisory technologies hub that bring together the supervision and IT experts, both from the ECB and the national competent authorities, so national supervisors across the Europe. And second step was to define the way how we are going to work. And this is exactly included in the digitalization blueprint. On one hand, it covers our vision, what we would like to achieve, and on the other hand, also answer the questions how we are going to do that. So the concrete action plan to realize. And I would like to emphasize two aspects. So on one hand, the digitalization blueprint includes the entire portfolio of different subtech use cases that we see are fundamental to be implemented. And I'm not going to go into the details because when Per, I think, covered that very well, the use cases are very similar. They start with robotic process automation, textual analytics, building state-of-the-art data infrastructure. But what is, I think, very important in the blueprint is not only that portfolio, but also all what we call the enablers. So here, what we consider very crucial was, first of all, training, making sure that we as the organizations are ready to embrace the technologies. So supervisors understand them and they don't see the subtech does not scare them, but see them as they see subtech as a helping factor. Second is that we are also capable of working with the industry, with startups. We connect with the wider innovation ecosystem. And finally, is that we have a very good model to make sure that within the European banking supervision, this hub and spoke innovation model is well implemented. So there is a good innovation funnel, making sure that the ideas that are pursued further are the ones that bring most of the values. So to conclude, as you see, we have taken a number of actions, very ambitious actions to bring the European banking supervision to the next level in the area of digitalization. And I think this is the way, as I see, can benefit not only us at the ECB, but can also have a positive spillover effect across other supervisory authorities.
Thank Lucas. Helen, I'm going to come back to you on a point that Lucas mentioned in his remarks just now, and that's enablers. So to regulate an industry that's increasingly driven by technology and innovation, supervisors are going to have to build different skill sets. And I'm wondering if you could maybe comment a little bit on your perspective there, and maybe just also on how we go about recruiting and developing skills within our existing staff supervisors.
I think the need to evolve our skills is at the core of what we do. It's not just about implementing new technologies, it's also about the skills that we have. And in the PRA, we've got a real focus on this. We need to consider how to upskill and reskill people in an appropriate way for a prudential regulator. You know, we're not going to be Facebook, but it's how to sort of consider what skills do we need today, what skills do we need in the future, and you know, not everyone's going to be a data scientist. So what's the proportionate way? So for the last year, we've been really contemplating this with our HR colleagues about how to do this and talking to other people like Lucas on the phone about, you know, how we engage on this journey, which is not unique. You know, everybody is going through a digital skills journey. So, you know, what do we think we need in particular to a normal organization that is also going through the same journey? And the main thing that we felt is it's about being complementary and modern. So understanding numbers, capital, and liquidity continues, you know, but it's also about putting it in a way that is a modern lens. So that means that can people code in R, you know, Python? Can they produce an app in Shiny? You know, or do they understand how to do digital reporting? Do we always need it in PowerPoint, which is 2 weeks out of date? Why not have a real-time feed with a link? You know, it's that sort of thing. So there's a cultural element. And I think this is part of what we need to do is to make sure that the skills that we have in the organization, understanding need to evolve and understand how they evolve with relevance to their grade and what they do and be supported for that journey. But then how to bring in people that have got these skills. And that's one of the things that we've done a couple of years ago, where we made sure that all of our graduates now are asked digital skills questions, and the same for our experienced hires as well. So they need to demonstrate what do they understand by digital skills, how have they applied it, and maybe they have learned code, or they can understand, you know, how to use a analytical tool. But that's now part of our entry criteria, and I think that's really important because this isn't a side of job activity or an optional thing. We have to evolve our skill sets so that complementary, the technology and the skills come together, that we can sort of ensure that we continue for financial stability, that we've got that whole skill set there ready to go.
Super, thank you. Lucas, I'm going to come back to you and just another remark that you made in your previous intervention. You talked about working with the private sector in developing supervisory tools and using new technology. Can you maybe elaborate for us a bit on how you're working with the private sector?
Yep. So of course, as regulators or supervisors, let's say we are not the digital native institutions. And still we need to develop and adapt the advanced technologies to keep the pace and to remain relevant for the banks that we are supervising. So in view of that, I think that we really need to engage with the wider ecosystem and with the private sector and also other institutions. So first of all, I would say that it's really worth exploring collaboration with startups. So they will bring fresh ideas, specialized tools, and knowledge that I think we wouldn't be able to develop and grow internally in the house. And we have discovered that working with startups could be challenging. For example, taking into account our procurement rules, and we have to see how these procurement rules could be adapted to allow them really engage with us. Second, I think that goes without saying that we need to also work with the technologies companies that give us access to a set of resources. So let's take the example of the cloud. And here again, we have to also find the good ways to work with them, respecting the standards on confidentiality, data protection, and so on. And finally, we need to also collaborate with the banks, yes, that we supervise, and to ensure that as supervisors, we also facilitate the implementation of various RegTech solutions that reduce the burden on both, on us, but also on the banks. And here, for example, at the European Central Bank, we have just successfully introduced the digital portal where banks could submit the information for the related supervisory processes.
Thank you. Per, a long-range question for you. I'm wondering, as you work with some of these new tools and these new processes, if you were to look out 5 years from now, how do you see a different world for financial supervisors? What does it look like?
Well, 5 years is a really long time, and I don't pretend that my crystal ball is any clearer than anyone else's crystal ball. But if you look at some of the trends that we've all talked about so far, it is clear that there are really some arrows of progress that are pointing in a certain direction, both for the entities that we supervise, but also for the supervisors. And there are a few areas that I think we'll see supervisors move towards over the next 5 years or so. So one really relates to efficiency, effectiveness, but also agility of supervision. So that supervisors can improve not only their response times to market trends that we mentioned earlier, but also can be much more proactive in their ability to identify risks that are taking place more in real time. So supervisors will have new capabilities to access and evaluate new kinds of structured and unstructured data. It'll be more in real time, so as opposed again to being reactive and backward looking relative to data analytics, I think we'll be much more proactive and forward looking, but also the ability to understand the evolving risk landscape more effectively. And that's the agility that supervisors will need to deploy over time. A second area is related to the global nature of many of the risks that exist today, but are also evolving over time. So I think supervisors will start to design models where cross-border collaboration becomes much more effective and important. So the sharing of data, sharing of analytics across different countries, across different supervisors. As I mentioned earlier, deployments of things like data fabrics will enable these kinds of capabilities in more secure and efficient ways. And then finally, I would say, and Helen mentioned really the importance of the human capital component. And I think this is one area where you will see supervisors change quite a bit. So the capabilities that we're talking about and the capabilities that supervisors will deploy in the future will start to resemble much more what we're seeing in the private sector, in certain areas in the private sector today, where they'll be supported by teams of upskilled subject matter experts, but tailored specifically for the supervision use cases and needs. This will include much faster testing and experimentation of new types of capabilities, new analytics, new tools, the ability to ingest and analyze larger and more complex data, generate faster insight, and continue to be agile relative to the evolving risk landscape. An additional component of that, this was mentioned, I think Helen mentioned this earlier also, is regardless of what's happening with technology, there's always the importance of the human element. So the insight from the human being in the supervision context. And I think what we'll see more and more is the power of the combination of human intelligence together with artificial intelligence. And I think that'll be one of the dynamics that really pushes supervisors into the future over the next 5 years.
That's a great vision, very optimistic. I like the combination of artificial intelligence and human intelligence. That's a good combo. I also like your vision for more forward-looking supervisors based on real-time data. I know we just went through a process at the Basel Committee of looking at collection of data, and it still feels very cumbersome and very sort of historical or backward-looking. So we've got a few minutes left, and so on that last question, Lucas or Helen, I wondered, do you want to maybe look into your crystal ball and tell us what you see in a few years?
Sure. I think like the technology is clearly, impacting our lives. We see impacting the organizations across the world, and will definitely have a major impact on the way how we supervise the banks. So on one hand, I see that the technology would allow us to be much more efficient, and free up our human capacity to more intelligent tasks and to ensure proper supervisory judgment. But at the same time, the technology would allow us to be more effective. So we would be able to analyze the data in a much and draw insights based on what we already have it, which I think was not always the case before. On top of that, we will be able also to connect different data sets that were maybe not always connected, and both quantitative and qualitative information, and draw new insights on this. So I think these are the great challenges which are ahead of us. But when I listen to the discussion today and observe the trends across the supervisory authorities in the world, I think we are on the right path to really embrace the new technologies and make the best use of them.
Thanks, Lucas. Last word to you, Helen. What's in your crystal ball?
I think for my crystal ball, I think we do need to just consider how technology can enable us without kind of overtaking us, if you know what I mean. So it's really important that we invest in technology and we invest in skills, because the world is changing, but we must remember that the human judgment is at the core of what we do, and the technology can enable us for better insights and more sentiment analysis, more trend analysis, all of those wonderful things, but it's complementary to that human element.
Thanks, Helen. So thanks to all of our speakers. Thanks, Per. Thanks, Lucas. Thanks, Helen. It was a great conversation. Thanks for sharing your insights and your experience on this important topic. And thank you for joining us for DC FinTech Week.
Hi, my name is Jan Kroons. I'm an advisor at the Bank for International Settlements Innovation Hub, and it is my pleasure to present you Project Rio, one of the projects of the Hub's Swiss Center. But first, a quick word on the BIS Innovation Hub, the youngest member to the BIS family. In barely 2 years since its inception, the hub has already accomplished a lot, tapping the talent and enthusiasm of its multidisciplinary team of regulators, economists, market practitioners, and technology experts. The BIS Innovation Hub's mandate is to identify and develop insights into critical trends in financial technology of relevance to central banks, to explore the development of public goods to enhance the functioning of the global financial system, and to serve as focal point for a network of central bank experts on innovation. The Hub's Swiss Center is currently involved in 4 projects. 3 out of these 4 projects are exploring topics related to central bank digital currencies and DLT technologies. The 4th project, which I am presenting today, is Project Rio and addresses the rise in requirements placed on central banks to be able to effectively track and monitor fast-paced electronic markets. Project Rio is one of the Innovation Hub's inaugural projects. We started working on it in February 2020 with the goal of presenting a prototype by autumn this year, a goal which we have achieved. But let's not get ahead of ourselves. Before discussing the prototype, I want to show you a short video explaining the motivation behind Project Rio.
Innovation and advances in technology have been revolutionizing financial markets. Today's faster, fragmented, and more interconnected markets are driven by electronic and automated trading, generating millions of transactions every second. The BIS Markets Committee has said that monitoring this activity and seeing behind it to implement policy, manage foreign exchange reserves, and assess financial stability risks is a key challenge for central banks. Data volume, velocity, and complexity created by fast-paced markets needs technology that masters the dynamic data streams and provides insights at the same rate at which data arrives. Technology can help central banks broaden their perspective and develop deeper and faster analysis. The technical innovations have implications for IT, data processing, and data storage at central banks. The Innovation Hub's response is the Rio project. Spanish for river, because it uses data streaming technology. It can smoothly handle millions of messages and analyze these accurately in real time. The Rio project team builds on open source code to develop a monitoring tool for central banks. It's a tool that will pull millions of messages from multiple trading venues and can also scale to higher speeds to handle a huge diversity of different types of data and analysis. The monitoring tool will provide central banks with an overview of market quality and conditions via customized dashboards. Dashboard alerts, emails, or text messages inform users about unusual market dislocations, liquidity shortage, and volatility spikes. To build the prototype, the daily $2 trillion foreign exchange spot market was chosen. Significant volumes of electronic trading, ever faster speeds, and its critical importance to central banks makes it an obvious choice. The prototype ingests real-time financial data from the foreign exchange primary trading venues. Processing and analyzing this vast amount of data in real time is an event platform that houses stream processing engines. These engines prepare and clean the raw data before reconstructing it into limit order books and running liquidity and risk analysis. The platform is built for speed, but also for flexibility. The modular design allows new functionality to be easily added through additional processing engines, meaning that new markets, new data types, and different use cases are simple to trial. This is all performed in real time, and the customized dashboards allow central banks to be aware of unusual or deteriorating conditions as they occur and see trading activity as it takes place. For deeper, longer-term analysis, a structured data warehouse is available. Project Rio is advancing central bank monitoring and an important experiment using new technologies for broader data analytics. As our lives become increasingly digital, central banks are increasingly experimenting with new types of data in ever larger quantities. New tools to consume and analyze diverse data in search of answers to complex policy questions will be necessary. Project Rio is just the start.
The Rio prototype focuses on the foreign exchange spot market and ingests data from the two primary venues for spot FX trading, EBS and Refinitiv, as well as from the continuous linked settlement system for FX trades. Data hit the platform every 100 milliseconds, and within about a second and a half, Rio synchronizes timestamps, reconstructs limit order books from more than 50 currency pairs, computes risk and liquidity measures for each pair, and displays and contextualizes the information on interactive dashboards. In terms of core technologies, the platform is built in the BIS Innovation Hub's Microsoft Azure cloud environment and mainly uses serviced versions of open source software such as Apache Kafka by Confluent and Apache Spark by Databricks. Our unified warehousing approach based on a Delta Lake architecture allows for easy and flexible data access, speeds up the computation of historical measures, and facilitates replay functionalities helpful for ex-post analysis. Within the prototype, visualization is done in Grafana, which queries the data from a timescale DB, but this is about to change over the next few months. The Rio prototype demonstrates that it is feasible for central banks to monitor fast-paced electronic markets in real time using cloud-based open source technologies. Based on interest from the BIS, from the Innovation Hub Swiss Center's host central bank, the Swiss National Bank, and from several other central banks, we recently decided to turn the prototype into a minimum viable product. Work on visualization and UX will be a key part of this wider initiative to turn the Rio prototype into an MVP by the end of next year's first quarter. With the help of an external partner specialized in design and front-end implementation, we aim at adding a professional-grade, customizable user dashboard to the prototype. We are convinced this will help pave the way for a broad central bank adoption of the Rio tool. Project Rio is from central banks for central banks. That's why collaboration within the central bank community has always been a priority for us. So far, our outreach focused on understanding monitoring requirements of market departments around the globe. The next phase of outreach will focus on soliciting input to create great user experience. We created a working group consisting of experienced market monitoring experts of 5 representative central banks around the globe. They will follow work on the dashboard closely and give feedback for every development cycle. Design thinking techniques will play an important part in this. In addition to this hand-picked group of experts, a slightly larger group of central banks will provide periodical high-level feedback as well. Thanks for your interest. I hope you enjoyed this short project overview. For more updates on all BIS Innovation Hub's projects, please visit our website, bisih.org. Thank you.
So it is a real pleasure to have with me now Governor Timothy Antoine from the Eastern Caribbean Central Bank. You know, we've talked a lot over the course of the day about projects, about ideas, planning, and in this conversation, we get to talk a little bit more about execution, because there have been, and there are a couple of cases of CBDCs that are working, that have been implemented, and Governor Antoine has been a leader in making sure that the Eastern Caribbean has been at the forefront of the CBDC conversation. Governor, thank you so much for joining us.
Professor, thanks for having me. It's great to be with you.
All right, I guess, to start off, maybe you can talk to us a little bit about the Eastern Caribbean Currency Union, the ECCU, and it's sort of the member countries, just to set the stage, because we started off talking about Asia, and obviously we started with larger conversations with the BIS. But when you look at the ECCU and its specific countries, what are the unique policy challenges that you face, particularly when looking at your domestic financial system?
Right. So just before I get to that, let me just say at the outset that the Eastern Caribbean Currency Union, our central bank, truly believes that the payment system should work for all, except illicit actors. And so the theme of this year's FinTech, DC FinTech Week, innovation, inclusion, and integrity, that theme is perfectly aligned with our philosophy. The system must work for all except illicit actors. That means it must work for small states. So who are we? We are a monetary union of 8 small island developing states. And we are an archipelago. So interestingly, not only are we small islands, but within countries, you have multiple islands. Why am I making this point? Because our archipelago and the issues that we face with cross-border payments are real, and our geographic endowment presents us with a natural laboratory to run this particular innovation. Now, in terms of our financial system, it is extremely bank-centric. About 85% of assets are controlled by commercial banks. The remainder mainly credit unions. We are very high usage of physical cash. We estimate probably around 80%. And payments are too slow and too expensive.
Yeah, well, that's in and of itself kind of interesting, right? When you think about this, if you have a country made up of archipelagos, and if it is a cash-based system, just literally the physical movement of cash faces a range of frictions that are literally typographical in nature. I mean, like literally the geography and the construction of a country can impact sort of the demand one might face for any kind of central bank digital currency. Now you guys made a lot of history with Dcash in particular, right? And I guess along with the sand dollar in the Bahamas was or is really one of the only 2 live CBDC projects, at least I think according to the BIS. With all that in mind, in terms of enabling inclusion, and inclusion can mean lots of different things depending on where in the world you are, and again, what are the specific challenges that you face. What have been your specific sort of policy goals with regards to Dcash, to your digital cash, and how did you actually end up with this idea that a central bank digital currency would be the right approach?
Right. Well, Professor, I'm glad you picked up quickly on the question of our archipelago and what that presents for us as a challenge, because that goes to the heart of our motivations for CBDC. We have 3 policy goals. The first, payment system efficiency. The second, financial inclusion. There are many people in our region who are unbanked or underbanked. And unfortunately, for various reasons, including the fact that it's more and more difficult to open a bank account, people have been forced out of the financial system. And the third, very important policy objective or goal is increased resilience and competitiveness. And that is so important for small states which are extremely vulnerable to external shocks, whether they're natural disasters, pandemics, or financial crises. Now, I think and all of these goals are aimed really for us at boosting economic growth, but ultimately propelling our agenda of socioeconomic transformation for the shared prosperity of the people of our currency union. And that is always fundamentally what is at stake here. Shared prosperity for the people that we serve. And we believe that to do that, we have to transform the region, and Dcash is an important instrument in really the bigger conversation about the build out of a digital economy for our currency union. I should also add that one of the important benefits of Dcash, digital cash, so short Dcash, is in fact financial integrity. So think about this for a moment and consider the question, which payment channel is better suited for financial integrity? Physical cash or digital cash? And if you think about it, hands down, the answer is digital cash, because in the former, physical cash, there is complete anonymity. In the latter, digital cash, you have managed anonymity. Every person who wants to operate our CBDC or wants to use our CBDC has to be registered. Agents have to be approved by the central bank, and users at the retail level have to obviously be registered by approved agents of the central bank. Having said that, you do have privacy in terms of your actual transactions, but that issue of AML CFT, those protocols are strictly observed. And as a central bank, you would expect us to do no less.
Yeah, we had Mu Chengchun from the People's Bank of China earlier, and it was actually kind of interesting because this idea of how do you draw a balance, and every country has its own sort of different balance about how do you manage anonymity becomes really important for all the different stakeholders. I think that in terms of the inclusion aspect, going digital and that question of digital transformation is kind of interesting, just based off of what is the pre-existing infrastructure and the penetration of all kinds of different devices like mobile devices. Mm-hmm. But I think that the inclusion question is often a cost issue and a question of traditionally high costs and lack of access to financial services. And that's a challenge in the United States as well. I mean, from your perspective, how do you look at the intervention of a CBDC and the ability of the private market to have solved this particular issue? I mean, why do you think that private sector competition hasn't solved this issue on its own, particularly in your neck of the woods?
Small size. Our small size means that we obviously do not enjoy, private sector operators would not enjoy the same scale economies that they would in China or Mexico or Brazil. Mm-hmm. And so typically it means that the payback period is probably going to be longer, or you're going to have to charge even more, which is already an issue in our region. So when motivated by a bottom line, which is what the private sector is motivated by, it is no mystery in our view why we have not seen more innovation. And because our system is particularly bank-centric, what we've seen is these institutions are amortizing the legacy systems. So there's no strong motivation or incentive to innovate faster, because they're going to want to, and they are in fact amortizing. So if you look at some of the same operators in Canada are not bringing those innovations to the Caribbean. The question is why? Scale economies. They don't see the same returns, and certainly they need to be more patient with the return. They're all profitable, but it's going to take longer. And I think that's the reason why we have not seen more private sector innovation in this area to solve these particular frictions that you identified and we've identified.
Well, that's very helpful, right? Because and then you can sort of see at least the cause or the rationale for intervention, by the central bank. When you think about the actual solutions, well, that's an equally kind of interesting question, and I'd be curious to get your thoughts. I mean, there's clearly then this challenge that you've identified in terms of the size and the scale, but there's a whole range, I suppose, of possible policy interventions that obviously we're also thinking about and have been discussed both in the United States, in Europe, and other parts of the world. But here in the United States, we've been talking about a retail fast payment system, something like a FedNow system. The big conversation in Europe and the United States is, is there some way to regulate the cost of payments? Do you mandate basic sort of deposit accounts, or greater bank coverage? But instead you move forward with the CBDC. How did you get to that answer? And how did you think about the other kinds of tools potentially on the table?
I think our lived reality dictated the direction that we take. So here's the thing. We're open to all possibilities. And we've said in our articulation of where we see our payments landscape that all channels can contend. But here's the thing. In our region, many of our small businesses do not use the point of sale machines for, say, credit cards and debit cards. They don't. And the few that do, very often you will go into a business and they will tell you the machine is not working. But you've seen the machine and you're wondering, well, isn't this? And they will tell you it's not working. The real issue is that it is not working for them, because these businesses are required to pay anywhere between 3 to 5% per transaction. Now, Professor, obviously that's driving up the cost of the business and the products that they sell. It's a material number. So when it comes to making a sale, they will always want the cash option to avoid having to make that payment. And frankly spoken, this has gone on for far too long. Small businesses, the bedrock of economy is at least 50% of all jobs. In some cases, a lot higher than that. We recognize that we needed to intervene to do something. Now, having said that, we're also clear that Dcash is one of several payment channels, and the customers must choose their channels based on cost and convenience. So for that reason, we're not advocating the elimination of physical cash. People will decide what they want to do. What we do know is that the current system is not working for most of our people. And remember what I said at the top, the payment system should work for all except illicit actors. And that includes small countries and small businesses.
Did you guys ever consider stablecoins or sort of the penetration of stablecoins, whether or not stablecoins could alternatively provide a solution?
Well, we're open to looking at options. The thing about it is that one of the challenges of building out a digital economy is building digital trust. And stablecoins introduce levels of risk that we're not comfortable with as a central bank. Our single largest asset is trust. And therefore, we believe we have an obligation to leverage that trust to help build out the digital economy. And we locate Dcash as an important advance in the ultimate digitalization of our economy and society. So we have to lead. And I think what you are teasing out, Professor, is the fact that in small states, the role of the state is somewhat redefined. But even in a large state like the United States, the fact of the matter is interventions by the US government, whether it is the internet or the global GPS, global position system, have enabled a lot of what the fintechs, the big techs are now doing. So just imagine in a smaller region, in a small state, a region of small states where that incentive isn't there, the role of the state, including, for example, a role of a central bank like ours, becomes more important. And so we made that decision to proceed, and I'm sure others will want to come on board, and we would look at all the possibilities as we go forward.
Yeah, I mean, I think that's really sort of interesting, and we had earlier the co-founder of Ethereum on, Joe Lubin, and he had made some interesting comments about this isn't a stablecoin architecture, but he's thinking about the Ethereum network and what kind of interoperability private networks and private systems would ultimately have with CBDCs as they come online. But when you look at the existing architecture that you guys have, it appears that you've chosen a kind of a hybrid architecture. One of our flash presentations sort of went through the differences, but a hybrid architecture where you're having a central, where you have the central bank, where you're running the CBDC system, but you have private banks and other intermediaries providing the retail services. what have you, what did you predict to be the business model of these kinds of private intermediaries? And what have you seen? I mean, what would they offer, or why would they offer really Dcash when they can make perhaps even higher returns on deposit-based payment services?
Yeah, that's a good question. So we've seen an interesting response. There are banks which are concerned about the loss of fees and charges. We hear that, but at the same time, we are acting in the public interest. The public is quite concerned about the high costs of current fees and charges, including for payment services. But here's the thing. All of our banks, financial institutions agree that the cost of handling physical cash, that cost is not just, it's insurance, it's security, it's transportation, and so on. That cost needs to come down. And here we are aligned. So because it is physical cash, because we are distributing through these same financial institutions, they recognize that the cost savings, both in terms of time and money, will accrue to those financial institutions that participate in our Dcash pilot. And so we've seen many of them coming on board. And I think there's also a recognition that more wallets will come, and the wallets will contend and customers will choose. And in our environment where you have so many indigenous financial institutions, again, the economies of scale or lack thereof what we've provided enables them to deliver to customers, potentially bring additional customers to their platforms, and at the same time lower those costs. So that is an important value proposition as part of the business model for our participating financial institutions.
To what degree do you look at this kind of project as, let's call it a first generation digital transformation project? The reason why I mention it, and again, this is just going back to a previous conversation with Mr. Lubin, was that he had sort of predicted, well, okay, to the extent to which you have CBDCs, and there will be more CBDC projects, you can imagine a number of evolutionary paths, right? One is which, and I guess, just we're going to think about the CBDC projects on the chalkboard, right? Where we're going to think, well, we could theoretically do this. We'll try to risk assess all the different alternatives and then weigh them against the existing infrastructure, right? And I suppose that's a little bit where the United States is. And then you have others who feel that because of their local demand or challenges, you need to think, or you have a route to introduce a CBDC earlier rather than later. Then there's finally this question, I guess, that Lubin was getting to, which is, okay, even if you have this cash functionality or a cash substitute functionality, and it sounds like this is where you are now with Dcash for sure. It's at least what appears to be the functionality for other CBDC projects in the Bahamas and those that are still being piloted in China. But there's this idea that ultimately you're dealing with smart contracts. Ultimately, you're dealing with blockchain infrastructures. Ultimately, you're dealing with infrastructures where you can build things on top of them, other kinds of functionalities in the future. Which gets to such fascinating questions for development, for all kinds of things. Like to what degree is that interesting to you, and to what degree is this something that crosses your mind now that you're clearly ahead of a lot of others in terms of having introduced a kind of digital cash option?
No, it's certainly it's something that we've considered from the outset of our pilot, so that we believe there's significant potential for cross-border payments. We are already feeling interest, our central bank, from other central banks within the Caribbean, from Africa, and also from FinTechs, payment system providers which operate within our region and outside. In other words, they are looking for opportunities for collaboration. And so as part of our design from the outset, interoperability was built in. Our CBDC, Dcash, can connect with other CBDCs and or wallets. And we anticipate that as this pilot moves forward and as the space evolves, that we will see some interesting connections. So that has very much been our mindset. And that is why we believe interoperability is key in the design of Dcash or any CBDC for that matter. Because the truth is, right now, the payment systems is fragmented, and we need to find a way to resolve that. And clearly, there's some action required at the regional, at the regulators level, at the regulatory level, regionally and globally, to bring us together. So that's why we're a big supporter of the G20 roadmap for payments, cross-border payments, because we believe that that is a way for, bringing us together and sort of ultimately resolving some of the frictions that we have. Even in advanced economies with advanced payment systems, there's still fragmentation. You look at Europe, for example, it's pretty obvious there.
Yeah, I mean, well, that's you're sort of reading my mind, by the way, by talking about sort of fintechs, other countries. There's got to be, and there has to be some kind of first mover advantage, right? When you're early to move and to sort of set the pace, then other people are either going to want to learn from you, or they're going to want to figure out a way to sort of leverage parts of your infrastructure or your strategy. Typically when you think about a currency, the challenge with any new payment system is going to be user adoption, right? We've started this conversation talking about scale issues, but you do have this first mover advantage. I mean, how exactly are you thinking about promoting the adoption of Dcash in the union, and do you have any sort of thoughts about how intentional you want to be about promoting it one day, even beyond? Or at least the infrastructure, even beyond.
So our initial focus has been and continues to be on rollout to all 8 member countries. When we launched at the end of March of this year, 2021, we launched in 4 countries. We've since gone to a 5th, and we're on the cusp of rolling out to the other 3 remaining countries. So we've been doing some low-level marketing, as in sensitizing by country. Once we complete the rollout to all 8 members, we are going to significantly, in fact, boost our marketing. And in terms of to help drive adoption. But we also are being strategic here. We have to look at the merchant network very carefully, which we've done. So, for example, we know supermarkets, pharmacies, gas stations, utility companies, those are our priority partners, merchants, to build out the network. We also in very significant conversation with governments, because while people think of Dcash as people to people, P2P, or people to business, P2B, there is a significant potential in our region for people to government, P2G, and government to people, G2P. And so those various modalities or channels or operators, if you will, we believe will ultimately allow us to drive the adoption strategy and to really create that value, even stronger value proposition for users of our Dcash. And ultimately, as we move forward with that, and we sort of finesse that in the ECCU, our currency union, we will be open then to look at connections within the CARICOM area, the wider Caribbean area, and connection with our diaspora, because there are already opportunities knocking, but we've been trying to make sure that we first and foremost focus on the people that we serve in terms of getting them their hands on Dcash, connecting the dots, creating that merchant network, and that essentially that ecosystem, which is why, for example, we've done an e-commerce portal functionality to allow small businesses to come on top of that. That's the requests that we've heard from small business. We've taken it on board, and we brought that into our Dcash our value proposition. So again, we're listening, we're learning, and we're responding to make sure that it works for everyone.
In striving for that universality in function, right? Do you expect for Dcash to be the predominant means of making payment in the future? Do you think it's going to be something more likely to be deployed by businesses rather than households, or both?
You asked me to look into a crystal ball. What I will
Yes.
say to you, Chris, is that we envisage that Dcash will become a dominant payment channel in our region. Perhaps at least 50% of all payments will be made via Dcash. Right now, 80% are cash and checks. We believe Dcash will ultimately supplant that and flip that script, as it were. But we also recognize that there will always be a demand for physical cash, at least for the foreseeable future. And we're comfortable with that. But we believe that Dcash gives us additional flexibility and builds resilience for regions such as ours. And that's our expectation. Over the next 5 years, we think we will see a shift in that direction.
Yeah, I have two more questions. One a culture question, and the other going back to the PBOC. The culture question is one relating to just the role. Again, here we are, and the ECCU is one of the first out the gate with this particular tool. And the Caribbean just in general has been very much a hotbed of FinTech innovation. I've done a number of events there on digital transformation and financial technology, and people from Africa, from South America, and the like will fly out to join those conversations. I mean, to what degree is that innovation, and it's important because we had this conversation out from the outset in our conversation on Asia. There's a lot of entrepreneurial energy in the Caribbean, right? How does that entrepreneurial energy sort of funnel into how a central banker thinks about something like a digital currency? We've had several conversations throughout the day about experimentation. Some countries are a little bit more comfortable with experimentation. Some countries are quite a lot less comfortable with experimentation. How does that ultimately sort of inform your decision making?
Chris, it's necessity. Necessity is the mother of invention, or shall we say innovation. And for us, that is what it's about. So the Caribbean has a history, notwithstanding our small size, of innovation. I draw your mind back to 2007 when our region launched the first multi-country catastrophic risk insurance pool in the world, CRIF. And that was birthed after the devastation of Hurricane Ivan in 2004 that devastated my home country, Grenada, the country of my birth, but Jamaica and other countries as well. And by the way, that damage was 200% of GDP. So you fast forward now, and the Bahamas gets hit with Hurricane Dorian, and then launches the sand dollar at the end of 2019. And then we, of course, we were already working on our Dcash, but then we get hit with a pandemic. In other words, necessity drives us. The urgency that we feel is to bring real change, positive, impactful change on the people that we serve. And you talk about a central bank. I'm a development practitioner at heart, so let's be clear. It's always going to be about the people we serve, with respecting, of course, the laws that govern the central bank and working within that framework. So that's our motivation. And that is what drives us. And that is why we're moving faster than, say, some other countries that do not have the same vulnerabilities and do not have the slow payment systems that we do. And so that always has to be remembered. We may be small, but innovation is being driven by our necessities, our lived realities.
Yeah, with that, one then last question on the comparison point, right? So again, when Mu Ching-Chun came on to talk about the ECNY, he had described certain kinds of features. The starting places are very, very different. But you see some certainly certain areas in which inclusion is being sort of emphasized. Very, very, very different starting points. Also some important endpoints. But maybe you could just let the audience know, because what kinds of commonalities do you see when you think about that kind of project, and what kinds of differences are there?
Well, I think both China and our currency union, we are working on improving our domestic payment system. Obviously, China is a vast country, a large economy, but a large domestic economy as well. And so they have their own motivations to address payments within China. And of course, in a period where consumption is becoming an even larger component, if you will, of China's GDP. In our case, we're small, but we're working on the same thing, addressing frictions within our payment system, within our currency union, to not only address the needs of our people, but position our region to be able to compete in the digital economy. Chris, one of the things I repeatedly say about building out a digital economy in our region is that we must be not mere consumers, we have to be producers. That means we have to build an appropriate ecosystem. That's part of what Dcash is in respect of digital payments ecosystem. And of course, we have to also bring skills. And I mean, that's a different project, but we're also working on that with partners. So that is a commonality. I think the other commonality is a recognition that large or small, we have to work together. And I go back to mentioning the G20 roadmap for cross-border payments. So whether it is a China or our currency union or the United States or Europe or anybody in Africa, we need a coming together to create a financial system that works for all except illicit actors. That requires global cooperation. And in that sense, I think that we can find common cause. Big China and little Eastern Caribbean currency union.
Well, this was a fantastic conversation. Thank you so much, Governor. We're about to transition to our next panel, to Benoit Cœuré, and I wanted to say before I even sort of pass the baton to Benoit, to say he has been also one of our instrumental sort of actors and forces behind DC FinTech Week. And we are eternally grateful for him and also the BIS to help us out with conversations with leaders like you, Governor, and Antoine. So thank you very much. I know our audience has enjoyed it very, very much. And we will now transition to Benoit.
Best to you, Chris. Hope to see you in our region soon.
Absolutely.
Good morning in Washington, good morning in Ottawa, good afternoon in Basel, and good evening in Moscow and Manila. It's my great pleasure to welcome you to a new session of the DC FinTech Week on harnessing innovation for the public interest. My name is Benoit Cœuré, and I'm the head of the BIS Innovation Hub, and I will be your moderator today. And so what's the plan for this session? The plan is to maybe take a little bit of height and distance from all the fascinating and very exciting corners of digital innovation which are being explored in this conference. And the DC FinTech Week does a great job at going into all corners and turning all stones of digital innovation. But now we're going to discuss consequences for the public interest, and we have the privilege to welcome several very distinguished and senior policymakers who have really one thing in common. They both, in their central banks, in their institutions, they both went into the nitty-gritty of, and they've been at the frontier of digital innovation for their own institutions. And at the same time, as policymakers, they have a view of what's useful or what could be harmful for society, and what are the consequences for monetary policy and for financial stability. So we are very fortunate to have with us today Elvira Nabiullina, the governor of the Bank of Russia, Benjamin Jokno, the governor of the Central Bank of the Philippines, and Tim Lane, deputy governor at the Bank of Canada. Thank you very much for joining us and taking the time. I think that all of us here know very well how much innovation is shaping our financial systems, how important is it to ensure that innovation is a force for good, but we have you all three of you have different experiences, and which we are very impatient to share. So let me start with you, Tim, if you agree. And let me start with what's probably the easiest for central bankers to address, which is payments, because that's very close to what we do, to the heart of what we do. And we know that COVID has been a catalyst of change in payments. We know that this is only a new step in a series of innovations which have radically changed the face of the payment world. And we also know that Bank of Canada has been at the frontier of experimentation with payments. Project Jasper is a household name in our community. And you've been doing very advanced work on central bank digital currency, and also you've been part of this group of 7 central banks, which together with the BIS has issued a report on CBDC only a few weeks ago, and also the G7, which issued another report on CBDC. So, Tim, can you tell us more about how technological innovation are transforming the world of money and payments in Canada, and more specifically, can you tell us more about the work you're doing on CBDC? And of course, we all want to hear the answer to one question, which is, what are the scenarios under which the Bank of Canada would consider issuing CBDC?
Okay, well, thank you very much, Benoit, and it's a great pleasure to be on this panel, and especially with such a distinguished set of other panelists. And so certainly your question touches on quite a number of topics that we're interested in. And in Canada, we have a major project to modernize our payment system. One milestone, which is a very important one, we passed successfully at the end of August with the introduction of a new real-time gross settlement system for wholesale payments. Another aspect of that, which we're currently embarked on, is the development of a real-time rail for payments. And the idea there is that it would be not just faster and cheaper and more transparent, but also would be more open, so that it would be available to other payments providers other than the banks, and that would provide a platform on which you could have more innovation and competition in the private sector. I mean, clearly, to make that work, you need to combine it with another initiative we have going on, which is a stronger supervision of retail payments providers that are not banks, and we've currently got legislation in place, and we're developing a framework for that for that regulation. And another aspect, of course, is the whole open banking, which means that customers would have more ownership and control of their own data, and would be able to transfer it to other providers if they wanted to access payment services from companies other than banks. So all of that is going on currently. Now, as you mentioned, of course, we've also been looking ahead to some of the more frontier kind of projects, and that includes the work we've been doing on central bank digital currency. And there, we've been doing research on CBDC, as you alluded to, for quite a number of years now, and some of that that work has been exploring the different features of CBDC, the implications for the efficiency of the system, for how the economy would function, how information would be used, and so forth. And so that research program has been underway for quite some time. But we're now actually moving from something that's more like a research project to something where we're actually building the capability to issue a CBDC. We haven't made a decision to issue one yet, because we basically don't see a compelling need under current circumstances to add a CBDC to the array of payments vehicles that are available, and particularly when once our real-time rail that I mentioned is in place, and we've got more private sector solutions, that will of course even further enhance the set of options available. But we have, as you mentioned, been recognizing that there are some scenarios under which there could be a stronger case for introducing a central bank digital currency in Canada. And one of them is really associated with the diminishing use of physical cash in the Canadian economy, and the fact that although that's been diminishing over time, we've still not seen we haven't seen any serious reduction in households' ability to use cash if they want to. But one could imagine a situation where and we've seen this in some other countries where it's harder for households even that want to use cash to use cash for payments. We've seen a bit of a taste of this in the context of COVID, and the fact that a lot of businesses have been more reluctant to accept cash and have been relying more on contactless payments. And that's something that, if it were to continue and persist beyond the pandemic, could leave some households out in the cold, in effect, impair their ability to participate fully in the economy. And one would have to think seriously about whether a digital equivalent to cash would perform a valuable role in financial inclusion, in fulfilling some of the needs, and those include the universality of cash, the privacy that it involves, and the confidence that the public has in cash, and taking those over to a digital space. Now, probably another set of developments which are much more complex are the developments of a whole array of digital methods of payment, including digital currencies, or aspiring digital currencies in the private sector, and we've seen particularly the emergence of stable coins, which are intended to be more stable in value vis-a-vis fiat money, and that. Those developments, of course, are quite complex, and they could, under some circumstances, reduce the ability of central banks to fulfill their mandates without a central bank variant of a digital currency being made available. And also, of course, I think more generally, what we're seeing is the digital economy is expanding and becoming more complex, and in that context. There are new needs that are emerging, and for example, you think of smart contracts and the fact that does involve the need to be able to program payments in some kind of a tokenized form of currency, and that could be something that potentially could be a need for a central bank digital currency. So certainly a lot we're thinking about, and as I said, we've been doing research for a long time, but there are a lot of questions we still have to explore, and it's a very exciting agenda going forward.
Thank you, Tim. You've covered a lot of ground. I think we have food for 5 hours of discussions with all the issues you've just raised. But I'm sure there will be commonalities with the experience in Russia and in the Philippines. So let's move to Elvira before maybe we can come back to some of these questions you raised. And thank you very much, Elvira, for joining us. We are very eager to learn from the Russian experience. And Russia is a place where digital transformation has been really reshaping the way financial services are being provided. Bank of Russia has a unique perspective on the role of platforms in financial services. So can you tell us more about this experience and the lessons you might have so far from the others, and also maybe the risks, the possible risks, as well as the opportunities?
Thank you, Benoit, and it's a great pleasure to be here and to discuss important issues. Many regulators are now concerned with the desire of big techs to move in the financial services sector. In Russia, we face the opposite problem. Our largest banks, which have well-developed digital payment systems and large network of branches, started to create financial and non-financial platforms or ecosystems of such platforms, converting themselves into multi-sector big techs. The sectors where they go to include apps for taxi services, food and goods delivery apps, medical and streaming services, and so on. You may remember the movie Back to the Future. It is for real. Our experience may serve as an example of issues which regulators may face if big techs move to financial sector on a large scale. We need to address in this situation two types of issues. First, competition issues, both in the financial sector and other sectors. And the second, management of risks for banks, creditors, and depositors. Let me start with competition. There is a substantial antitrust researches on the effect of platforms on competition. And all of the conclusions are applied to the platforms and ecosystems built by financial companies. There are special angles though. First, we all know that banks issue money. Banks with ecosystems around their platforms issue money, which are bundled with goods and services provided by their own ecosystems. As a result, demand for current accounts in such banks can be higher, costs of finance cheaper, and liquidity position stronger than in other banks. Second, we all know that the main value in all platforms and ecosystems is data. Ecosystems have more transaction data, so they can assess credit quality of their borrowers better. Therefore, they attract better borrowers and increase their margins. To address such problems, I think countries can strengthen antitrust policies and also build national financial infrastructures, which restore level playing fields in payments. Fast payment systems of the central banks are a powerful tool, which we can use in this case. Open banking and open finance, financial services marketplaces are other types of infrastructures which help to restore a level playing field. As far as management of risks for banks, creditors, and depositors is concerned, this is the matter for strengthening banking regulation, in my view. I have just described why platforms may increase profitability of banks, but risks are growing as well. Banks enter new sectors, even buy businesses in these sectors, and therefore bear new business risks. Their share in such sectors can be quite high. So unexpected business losses with high probability will have to be covered by banks, creditors, and depositors. I know that for these reasons, in some countries, banks are fully prohibited from entering such types of activities, or the investments are strictly regulated. In Russia, we believe that it may slow down innovations. Therefore, Bank of Russia plans to address this issue by strengthening capital requirements for banks which build platforms and ecosystems. And the higher capital requirements should cover not only investments in the ecosystems, but also their potential business risks. To sum up, I should say that our experience provides an example for a broader conclusion that financial regulators in the current environment face a problem of finding a right balance between, on the one hand, stimulating innovations, and on the other, regulating new risks, including competition risks and risk of regulatory arbitrage. Our own central bank's innovations in the area of FinTech infrastructure, including fast payment, can be a part of solution which both foster innovations and improve competition. I will stop here.
Thank you very much, Elvira. Can I ask you a follow-up question on an issue which Tim already raised, which is financial inclusion, and a common feature of Russia and Canada is that both countries are very large, with many areas that may not well be served by traditional financial institutions. So, do you see a role for FinTech to help solve that?
Surely, I see. Russia indeed is a vast country that is stretched through 11 time zones, and there are enough areas that are difficult to reach and where the population is small and scattered in small villages. They are not the most attractive ones for financial institutions. And we did a lot to increase financial inclusion there. 3 years ago, we started a big project on financial inclusion. Of course, this project is based on financial technologies, but I should underline it's not new fintech companies that enter these areas, but traditional banks that changed their business models in these regions, thanks to new technologies, to make business there at least not unprofitable. So how it works? For example, big banks keep their branches. Some of them use mobile offices, namely a truck with cash withdrawal machine and an employee who helps customers to make some other operations. And this truck gets to a small village on certain days of the week. In these areas, banks also cooperate with retail stores for cash withdrawal operations. It helps to provide basic financial services. But the main emphasis we do, not on the physical, but on digital financial services. The huge aid for that is a governmental program on development of high-speed internet anywhere in the country. Over 80% of Russian consumers have access to the internet and can perform most financial transactions using a mobile application. It eliminates geographical barriers, simplify access to the financial services, and make it easier to switch between different service providers. Of course, we develop fast payment system and biometrical identification system, as well as we encourage financial institutions to create marketplaces. All this helps people to use as much financial services online as possible and feel safe about it. The good thing is that Russians love new technologies and easily move to online financial services. So now even people in remote towns can be clients of financial institutions that have no physical offices there. And our data shows that a significant share of key financial services is already provided remotely. 87% of banking customers in Russia use digital channels. And 30% of Russians plan to reduce the number of visits to bank branches or stop visiting them altogether after the COVID-19 pandemic ends. In addition, the share of non-cash payments in total retail turnover in Russia reached more than 70%. A few years ago, the share was only 30%. And we see that the number of people switched to digital channels for financial operations is increasing, also in hard-to-reach areas as well. And we will continue to follow this path of increasing financial inclusion using all these new financial technologies.
Thank you very much, Elvira. That's fascinating, and I'm glad that we can spend a little bit of time on financial inclusion, because that's an absolutely key and somehow underdeveloped dimension of the digital finance discussion, and including the CBDC discussion. So Benjamin, thank you very much. I would like to thank you particularly for joining us, given the very late hour in Manila. Thank you for that. And let's follow up on the same discussion in a way. I mean, financial inclusion certainly is very important for the Central Bank of the Philippines, and I know it's a key dimension of the digital payment transformation roadmap that you've developed. But can you share with us how you see the role of the central bank in developing the digital payment transformation? What can you do about financial inclusion in the Philippines? And maybe that's also an opportunity to hear from your CBDC projects.
Okay. First, thank you for this opportunity to be part of this panel and share the Philippine experience in pursuit of innovation in the digital age. When I assumed the governorship of the central bank 2.5 years ago, I made clear my vision of the future. I want to shift from a cash-heavy to a cash-light society. Now, in order to build an inclusive,
Thank you very much. That's very comprehensive, and again, I mean, there are many I guess common issues across your jurisdictions. I mean, offline capability, for instance, is a key dimension of retail CBDC, and we could have another seminar on it. There's a lot to say, but not today. But Benjamin, I wanted to ask you maybe to expand a little bit more on the cross-border dimension. Remittances are an important source of income for many families in the Philippines. We have this G20 action plan on cross-border payments to make them faster and cheaper. So how does this fit into your digital transformation strategy?
You're right. Given the critical role of remittances in the Philippine economy, industry players offering digital payments and remittance service dominate the fintech landscape, representing about 1/3 of fintech startup companies. Now, given the slow pace by which the traditional financial institutions assimilate technologies to digitalize their business platforms, fintech solutions support faster and cheaper means for remitting funds from abroad. So the country's major fintechs offer digital commerce and electronic payment services that allow overseas Filipino workers and Filipino migrants residing abroad to send remittances, make online purchases, load mobile phones, and pay bills. Some of them have partnered with blockchain startups, with certain players introducing so-called remittance services that employ crypto assets to provide faster and more efficient remittance services. These developments are complemented by initiatives of the large domestic banks to boost their remittance networks by launching numerous cash-out remittance centers across the archipelago, including rural and remote areas. These centers provide physical points of contact for these banks' remittance and other financial services to reach the unserved and underserved segments of the population.
Thank you very much. Tim, may I come back to you and ask you a question about the risks? Because we've been discussing a lot the opportunities, which is the right approach. I guess we're all here to reap the benefits, to harness the benefits of innovation and make it a positive force. But we also know that there are risks coming with it. And Tim, you are chairing the Financial Stability Board on working group on the regulatory issues of stablecoins. And so you're very well placed also to see some of the risks coming with these new payment instruments and new technologies. Could you share a little bit of that with us?
Yes, and certainly this is a very large set of issues that, and as you said, I mean, it is really the challenge that we know that innovation has some benefits, but at the same time, the risks have to be well managed. Otherwise, we've certainly seen experience with financial innovations that went wrong, and one of the challenges here is the fact that many of the financial innovations we've been talking about also involve undertaking very similar transactions from an economic point of view, but doing them in ways that have different forms with regard to the technology. And so, I mean, a broad principle I think that everybody can agree on is, same business, same activities, same risk, same rules. That you should be able to undertake activities that are that do the same things in innovative ways, but only provided the risks are also managed in an equivalent way. And I mean, we've seen this particularly with regard to stablecoins, where we have various functions associated with the issuance, the transfer, and then the customer's holdings of stablecoins, and those are in many ways equivalent to the risks associated respectively with the issuance and the issuance and transfer and the issuance and redemption of stable coins in some ways is equivalent to what banks do in creating deposits. In other ways, it's equivalent to what ETFs or money market funds do, and then the question is, well, which regulatory lens should you bring to that function of a stablecoin? Typically, stablecoins have some option with regard to how they're set up, and there's a concern that you can end up with arbitrage across different different legal forms, so that not only can stablecoin promoters choose what jurisdiction to issue in, but they can also configure the way that they organize it in a way that may lead them to be treated as either equivalent to a bank or equivalent to an investment fund, or neither of the above. And it's very important that whatever framework is brought to bear on these things, that it's regulated in an equivalent way. And so this both means decisions about the degree to which different ways that these things are regulated would be aligned depending on how they're configured, but also calls for some degree of collaboration across regulators, and not just across regulators in different jurisdictions, again, but across different functional regulators. So to some extent, it means that securities regulators in one jurisdiction may need to talk to banking regulators in a different jurisdiction, and that's really a whole new set of regulatory challenges. So a lot of interesting issues, and we're sort of moving forward in the FSB to look at them.
So securities regulators talking to bank regulators, you're setting the bar very high, Tim. Elvira and Benjamin, is there anything you would like to add on this issue of risks, and how regulators and how central bankers should address the risks? No. So let me ask the three of you one last question. You as governors, you're leading change in your jurisdictions, but you're also at the helm of institutions, central banks. And central bankers are very often perceived to be bastions of conservatism. So how do you engineer cultural change in your own institutions to make them more agile, to make them able to fail forward, to make them able to depart from the zero risk culture, which is very often the central banking culture? What's your experience with that kind of change? Elvira, please.
Yeah, I can start. It's a very good question, because really we need now different skills, different people, as well as always we need risk aversive people to work in regulation and in supervision, as well as flexible risk-taking new generation of employees with top expertise in FinTech, information technologies, to work on new fields. And the issue is not just to pick the right people, but as you've said, to create the culture in which people can be productive in the long run with these new challenges. And the Bank of Russia seriously changed its structure. We digitalized lots of processes and had to reallocate some people and hire employees with advanced expertise from the market. Most of the newcomers come from private banks, private financial institutions, and IT sector. And we are working on creating comfortable and inclusive work environment. And we have introduced lots of training programs to teach newcomers to adopt rules and principles of working in the central bank. It's special, and to give new skills to current employees. I think we should move in both directions. Thank you.
Thank you, Elvira. Benjamin, do you want to say a word about this?
Fortunately or unfortunately for me, I'm not the traditional central banker. I am more like a fiscal guy, but as you know, we have
nobody's perfect. It's okay.
I assume office. There were a lot of new laws passed by Congress, and which I'm now responsible for implementing. For example, we designed. For example, Congress now has authorized us to come up with a national payment system. That's new. In addition, we have issued 2 recent regulations on digital banking frameworks. So we have now 6 digital banks on top of our traditional banks, and we have open finance framework also, where we promote the consent-driven data portability. And then there are lots of things that I am now responsible for implementing. Now we have, for example, as I mentioned earlier, my goal is to have a cash-light society. And I made my vision very clear. At least 50% of all financial transactions should be in digital form by 2023. That's the end of my term. And that at least 70% of Filipinos should have their own bank account or financial account. That's the financial inclusion aspect. So I'm not the traditional central banker.
So thank you very much. So you might be ideally placed to do exactly that. I mean, leading change also in your institution. So I guess we've reached the end of our session. Please bear with us. I will leave you in the very safe hands of Hyun Shin, my colleague Hyun Shin, who will now moderate a session on servicing CBDC architectures. This was a great conversation, and thank you very much for joining us for DC FinTech Week.
Greetings, everyone. My name is Hyun Shin. I am the BIS Economic Advisor, and it's really my pleasure to moderate this panel on servicing CBDC infrastructures. This session really follows very naturally on from the one that Benoit moderated just now. Central bank digital currencies, or CBDCs, have been seen as the natural evolution of money in the digital age, and they serve as a tangible marker of the trust in money and of the social contract, if you like, between the central bank and the population at large. Now, there are good arguments aired in the previous panel that CBDCs perform best as part of a 2-tier system, where the central bank provides the base layer of digital money, and the user-facing roles are taken on by the private sector service providers who can draw on their ingenuity and creativity to serve customers better. And our panel today explores this interaction between the central bank and the private sector. Now, at the BIS, we've talked about a triple imperative in this context, and it lays out 3 broad objectives. One is about competition and openness, which means guarding against the emergence of closed networks, or so-called walled gardens. And the key concept here is interoperability, ensured by data ownership and consent, and effective competition through application programming interfaces, or APIs. The second imperative is to maintain the integrity of the payment system as a public good. And this means, among other things, guarding against money laundering, ransomware attacks, and other illicit activities. And the Pandora Papers have highlighted some of the scale of the problem. And I think all this means some type of KYC, or know your customer, or AML based on digital IDs. But the data privacy is a key imperative also, which takes on the attribute of a basic right. And if you like, this is the third imperative in this triple imperative. Now, of course, there is a debate on whether CBDCs or other initiatives like retail fast payment systems can best perform these functions. But for this panel, we'll take it as given that CBDCs are there. And given that starting point, we'll ask, what role can the private sector play? Now, we have a great panel to discuss these issues. Dante Disparte is the Chief Strategy Officer and Head of Global Policy at Circle, and was previously Executive Vice President at DM. Jose Fernandez de Ponta is a Senior Vice President at PayPal, where he leads the blockchain, crypto, and digital currencies business unit. And Tony McLaughlin is Managing Director of Transactions Banking at Citi. And last but not least, Nathan McCauley is co-founder and CEO of Anchorage. Welcome to you all. So Dante, if I may start with you, you have suggested that in the digital in the digital money space race, private innovators may be the equivalent of SpaceX or Blue Origin, with both firms, serving as vendors to NASA. So tell us about the services that Circle would offer as a vendor in the CBDC ecosystem.
Well, thank you, Hyun. It's really an honor to be with you, the Bank for International Settlements, and of course our good friend Chris Brummer, who's like a force of nature in putting on this conference in a virtual environment. So yesterday I shared an analogy that I think maybe borrows for this conversation some good visuals. That the FAA, the Federal Aviation Authority, is charged with keeping the skies safe, but the FAA is not in the business necessarily of manufacturing jet engines or flying planes directly. And so this is one of those balancing acts in the central bank digital currency conversation. So the advent of privately issued digital currencies that are increasingly starting to address the threshold policy matters that central banks want to see around prudential standards, around financial integrity, around promoting competition, which candidly so much of the public financial infrastructure supported by public blockchains is increasingly becoming that standard, is in my view, the best way to digitize the dollar and other trusted currencies and ensure that they have that direct match between public and private, public oversight, private sector, free market innovation. I think that's the important piece of the puzzle. The second important piece of the puzzle is obviously the design principle of having an air gap between central banks, the two-tiered banking system from which monetary policy is conveyed, and ultimately payment systems operators and the rest is a feature, not a bug. And so as central banks contemplate moving from abstraction to operation with central bank digital currencies, I think some of this preservation of that air gap is really critical. And to that end, the role of the private sector, and candidly, potentially the future role of a company like Circle, would be to plug in very directly into the central banking system. As you know, we have announced our intention of becoming a full reserve digital commercial bank in the United States. In the process of licensing our company, the bank regulators in the public sector will create an examination manual for these novel companies. At the same time, it has a chance of importing the trust and the fundamental underpinnings of the US dollar and US financial policy on these open payment networks. In the interim, the proxy is, of course, privately issued digital currencies like USDC, which are supporting more than $1 trillion of on-chain transactions and also spurring a wave of competition and responsible innovation.
Thank you, Dante. Nathan, can we move to you next? Anchorage was one of the first crypto firms to receive a federal charter for banking. Now, what does that kind of charter allow you to do, and what do you plan to do with it, and how easily adaptable would those services be with the introduction of a CBDC?
Thanks, Yoon. Yes, we were honored and privileged, frankly, to be granted the first national bank charter from the Office of the Comptroller of the Currency here in the United States, and we're fully operational as a digital bank. We provide custody, settlement, staking, and governance services for decentralized crypto assets and for centralized crypto assets. So you look at something like a Bitcoin, Ethereum. We hold those assets and allow our clients to hold those assets with them. And just as much, we support stablecoins, say like USDC. We're able to support USDC and allow people to hold deposits in USDC and use that as a way to meet really the infrastructural needs in order to grow the whole industry. So the way that we look at this is that regulation is incredibly helpful and bullish for the entire crypto space. Having things be more regulated and more trusted can only serve to help the cause of whether it's blockchain, decentralized assets, or even looking forward to CBDCs. All of this financial innovation that is going on is extremely helpful, and we'll need a whole host of federal banks, prudential banks, and international banks in order to solve the overall needs that are going forward. So we are the first right now, but we hope we are joined over time by many, many other banks that want to get into the space, many other banks that want to provide services around cryptos, services around blockchain assets, and services around CBDCs. So in that vein, we believe that one of our enduring offerings to the industry is infrastructure for other banks. As other banks look to come in and provide custody services for Bitcoin, Ethereum, or other assets, as other banks come in and say, hey, we want to develop a strategy around, say, stablecoins like USDC, or banks come in and say, hey, we want to develop a strategy around central bank digital currencies. We want to be able to hold this. We want to be able to settle this, move these around. We want to provide an infrastructural layer to all of them. And so in many ways, we think that one of our enduring contributions to this whole space will be to be as a sub-custodian to enable this whole industry to move forward.
Thanks, Nathan. That's I think there's a lot to chew on there, and hopefully we can circle back to some of these points. But let's first hear from Jose. Jose, so Dan Schulman has recently said that CBDC services will be the main course for your firm's digital currency and blockchain unit. So tell us more about the business model that you have in mind, and what services would you like to provide, and how will you make money on this?
Yep, thank you so much, Hyun. That's a really good question. And if we take a step back to understand what we are doing in the space, the BIS itself has spoken before about central bank public goods and how financial infrastructure has the characteristic of a public good in the economic sense. And we see CBDCs as part of that fabric. They are obviously not a public good in the sense of the monetary value that is, by definition, rivalrous, but it has the trust of the central bank, which is a public good in itself. So we see enormous value in that. We also believe that that base layer of the CBDC will need to be supplemented by services provided by the private sector. As we all know, a payment is much more than a transaction, and it goes beyond just moving value from a wallet to a different wallet. For CBDCs to achieve widestream adoption, there will need to be layers of services like KYC and KYB and dispute resolution and fraud monitoring and settlement and integration with payment ERPs, and a host of services that both consumers and merchants need for that. And we have been in that business for a long while. We have been for over 20 years interacting with digital payments, and we have a ton of experience on e-money that is backed by fiat. The reason that we started the unit that I have the privilege to lead about a year ago is that it's consistent with our mission. We're saying we want to provide access to new payment instruments. We want to make sure that we can enable consumers and merchants to pay and get paid in any way they want. It might be with their bank account, their credit card rewards, or as we have enabled already, crypto in a way that is easy for them to pay with the cryptocurrencies that we support in the system. And we want to add CBDCs to that stack when that is available. Where we think that we can help the ecosystem is by providing a distribution channel and a service layer that can reach more than 400 million accounts in more than 200 markets, and where we have the muscle and the history of providing a compliant and regulated space with more than 3,500 staff dedicated purely to risk and compliance. That's where we think that we can provide the service to the expansion of CBDCs.
Thank you, Jose. Let's come back to some of these points. I think they're very important points. But before we circle back, let's go on to Tony and get the perspective from the banking sector. Tony, you've argued that, and I quote here, a poorly designed CBDC could emerge as a category killer, digital payments method that drives out the private sector entirely, or concentrates financial services unintentionally into big tech platforms. Tell us a bit more about that argument, and what would a well-designed CBDC look like, and how would banks, what kind of role could banks play in this new ecosystem?
Yeah, thanks for the question. Great to be here. Indeed, CBDC becoming too big is one potential outcome, as is a CBDC that is a damp squib and is too small. And therefore, CBDC, in a sense, it needs to be universal if it's going to be a national scheme, promoted by the sovereign state. But it's in this strange position where it's a universal, ubiquitous scheme, that can be neither too big nor too small. If it's too small, it doesn't meet any policy objectives. So this is what I would call the CBDC Goldilocks problem. Is there a zone into which you can launch a universal ubiquitous payment system that you have to make sure is neither too big nor too small? Now, if there's one thing that central bankers are good at, it's calibration. So I'm perfectly sure it's well within the capabilities of the central banks to achieve that Goldilocks zone. But I think it does present a question, and maybe we'll go on to discuss it, but maybe there's a better way forward. Than I'd point out, I'd kind of support something that Dante said, or a suggestion that he made. One way of thinking about CBDC is it's a kind of a government PayPal. And the question is, actually, there are two questions. Number one is, why should the government launch a PayPal service, a PayPal type of service? And the second question is, can the government compete with a magnificent service like PayPal? So I think CBDC will launch, whenever they're launched, into a very competitive digital payments market. And how will the policymakers make sure that they are neither too large nor too small?
So Tony, if we take the current system as a kind of starting point and the two-tier system, and how could we achieve this calibration? What are the kind of indicators we'd be looking for in achieving the Goldilocks scenario?
Well, there's a suggestion that we've put on the table in a completely non-proprietary format in the context of the MES competition for CBDC, that's Monetary Authority of Singapore. We've put forward this concept of the regulated liability network, which might be considered as being a CBDC++. So what we envisage there is a DLT which has got central bank liabilities and commercial bank liabilities and e-money liabilities on the same DLT. And in the future, when stablecoins are brought into the regulatory perimeter, we could have stablecoin liabilities on the same substrate. So this is the type of scheme that we believe you don't need to keep artificially small. It's a true two-tier system. I mean, a two-tier system in CBDC jargon is that the private sector does the distribution. But that kind of misses one of the fundamental points of a true two-tier system, which is the liabilities of the private sector are the second tier. It's not just the customer-facing aspect, it's the balance sheet. And private sector balance sheets are obviously funded by those retail deposits. So a true two-tier system which tokenized the liabilities of the regulated sector in a joined-up way might disarm or circumvent the obvious downside of narrow CBDC while delivering the benefits of tokenization.
Yeah, I think that's I think that does raise some very interesting issues about the architecture, and let's come back to this. Maybe we can also touch on some of the experiences in some of the experiences that you've had during the pandemic. So Jose, I mean, you had some recent experience with distributing, disbursement of government aid during the pandemic. Did you learn some lessons on how the CBDC arrangement could be structured on the basis of your experience? Could there be some kind of lessons we can take on board?
I think they absolutely can. So we were honored, as you were saying, to participate in the effort to disburse relief funds during the pandemic here in the US. And we had the privilege of both serving hundreds of thousands of users that were depositing those funds in their PayPal accounts through cashing checks or direct deposits. But as obviously it was a system-wide effort. And I think that what we all learned is, as a society, we're being increasingly effective in being able to target and identify people in need during catastrophic situations. There's a body of work, among others, with Joshua Blumenstock at Berkeley, who has done very, very relevant work in sub-Saharan Africa, that playing out in the Western markets last year. That ability to identify where those pockets of need are is getting more and more granular, but has not been accompanied by an ability to effectively reach those users. I think that's something that we saw during the pandemic here in the US is that as colossal an effort as it was, it still took weeks to be able to disburse those payments. And for about 35 million users, it took months for them to be able to receive those payments. So certainly we can do better than that. And you could envision how a system where the government is able to reach through a CBDC that has instant settlement and 24/7 availability and can be deposited across a range of digital wallets, money directly to the public. That's something that would represent a vast improvement about cutting a check and putting it on the mail and then having to cash it physically at a bank account. I think that it was a wake-up call for all of us. I was watching the session prior to this one where Governor Diokno of the Philippines were saying that it was stating his goal of 50% digital transactions by 2023. I think that's a laudable effort and something that we should sympathize with, because as a society and as an overall payment system, we can do better, especially in these moments of dire need.
Thanks, Jose. I think the financial inclusion angle is a really good one for us to maybe circle back on and go back to some of the points that Tony was making earlier. So you heard Tony argue for this all-encompassing platform that has CBDCs, commercial bank money, and stable coins, all trading on the same platform. And Jose, I think the issue of financial inclusion is really uppermost in policymakers' minds. One type of one development that has really galvanized discussion has been the advent of these retail fast payment systems, especially in some emerging markets. Think of UPI in India or Pix in Brazil, that have really opened up digital payments to large numbers of people. I think one number that we heard was that 40 million people had made their first digital payments since the advent of Pix, which is less than a year ago. And I guess with that kind of that is very much a two-tier system. The liabilities are, as Tony described, they are private sector liabilities. But if you think about the informational infrastructure there, with digital IDs, with the interoperability that's built in, you could argue that you're a very substantial way towards a CBDC. It's just a matter of then going the one last step of issuing direct liability. So let me turn to Nathan and Dante here. So Dante, maybe I can come back to you with this question. When we think about some of the benefits that a CBDC, especially within an open architecture, could provide, what are some of the if you like, risks that we should be looking out for? One issue would be, as Tony said, CBDC is becoming too big. But you've also mentioned things like about technology obsolescence, intrusions of privacy, and the disruption of free markets. So tell us what the best way of dealing with some of these risks are.
Yeah. Well, and for those who know me, obviously I sound the alarm on the risks with temperament and with maturity, because I think the exploration coming from central banks and public policymakers is important. But I'm also concerned, it gets back to my FAA analogy. The FAA keeps the airwaves, the airspace safe, but doesn't build jet engines. And I think that risk of the central banks of the world fundamentally competing with their two-tiered banking systems and fundamentally competing in not only a domestic setting, but in a very vigorous global private sector sort of competition is perilous, in my humble opinion. I think we have to acknowledge that the vast amount of money that I would classify as value-added money that is in circulation today is privately issued, whether in the form of the fractional reserve banking system, massive companies like PayPal, Citibank, Visa, all of these types of networks. The ones that are inside the regulatory perimeter can continue to thrive and compete, build profit models around serving people and lowering fundamental costs. And I think the public sector, candidly, has a somewhat checkered scorecard when it comes to digital transformation. So it would put pressure on the two-tiered banking system. There's already studies that indicate a potential flight of deposits. It also requires a point-in-time selection of the technology stack for CBDCs. Meanwhile, the tech stack of public infrastructure, financial infrastructure is evolving according to Moore's law. And I think we're now seeing third and fourth generations of these types of public blockchains coming online, to the extent blockchain is even a design principle that central banks want to adhere to. Then there's other risks depending on the country that is the issuer, such as repressive regimes, social credit scoring, deplatforming people from their money, and on and on and on and on. And I think the biggest, most powerful financial inclusion use case in this space presupposes the ability of executing cross-border payments. So therein, a CBDC would also stop at a country's presumptive borders when the real use case for financial inclusion is around lowering the cost of remittances worldwide. So short of vigorous free market competition and public sector oversight, I just don't see CBDCs on their own as a big solution. I really do like the idea, however, of a liability model that Tony outlined, in which you have this equivalent of digital legal tender in circulation, but universally available in multiple different form factors. I think that's a more vigorous and rigorous model for the future, frankly.
Thanks, Dante. Nathan, let me turn to you with the same question. How do we? I mean, you're looking at it very much from the. I mean, you have a banking charter. I think thinking of the low-cost onboarding of new users and the ability to use a diverse set of interfaces, smartphones, but also possibly even cars or offline payments. How would you answer the question of how can we fit CBDCs into this new environment without, while maximizing the benefits and guarding against the risks?
Sure. Yeah. I mean, I think the biggest thing to kind of keep in mind here is that currencies. I mean, there's a reason we have the notion of legal tender. The entire notion of legal tender is to ensure that the particular piece of the financial instrument that you have, whether it's a dollar or a yen or whatever the case may be, is accepted at as many places as possible. And so currencies should be understood to be roughly natural monopolies, in that there is the value of a currency as a unit of account, as a system of record, increases the more that it is widely accepted. And so the more form factors and functional interfaces that you have in order to be able to use and utilize your currency, the better it is. This is why fiat currencies have gotten extremely popular, because they work and are accepted everywhere. And functionally, the interface that consumers want, the interface that businesses want, is to have a value transfer be able to happen. So a very natural evolution of this is that the more interfaces there are, where more currencies are accepted, the better it'll become. So as we look of whether this is going to be privately issued wrappers around central bank currencies or central bank digital currencies themselves, the fundamental thing to keep in mind is that their utility function is directly derived from how useful they are and how broadly they are accepted. And so a right sizing of this is a very tricky question to look at, because it's almost like you can't even test the hypothesis unless you give the thing very, very wide distribution, because wide distribution is naturally what is necessary there. And wide distribution in this day and age absolutely depends on low cost onboarding, easy access. And we should make sure, as we're rolling out new technologies, that we're actually solving some of the existing problems. It's funny. I'm sure Dante and I would share this point of view. We have been on the other side. We have seen the promised land of what is possible in the crypto and blockchain ecosystem. And it's very, very hard to go back and look at how unsophisticated some of the existing banking infrastructure is. When you have touched and felt a globally settled, 24/7 available asset and been able to use that and utilize it in your normal life, it's very hard to go back. And so once you've kind of experienced that, you understand what needs to happen here, and it's very clear the kind of tech build that needs to happen. And it's a real question to ask on what the retooling of the whole economy will look like there. This will not be a simple feat. and it's going to require a whole host of interested parties in order to make sure that it actually happens and rolls out effectively.
Yeah, thanks, Nathan, for that. So, so Tony, let's go back to you and this task, this finding the Goldilocks point where CBDCs are neither too small as to be insignificant, but not too big so as to to crowd out other private sector institutions, to crowd out private sector institutions that actually become too unwieldy and too big to manage. Now, one of the quirks of history in some ways is that bank deposits have played this dual role. On the one hand, it's a payment instrument. You debit the account of the sender, you credit the account of the receiver, but it's also a kind of funding source for lending. And I think this is one of the things that, of course, as central banks, as policymakers, central banks are acutely aware. The other side of the coin, of course, is that we see the new systems that are coming on stream. The retail fast payment systems that have really made a very big mark in a very short space of time, where they are services, basically infrastructure provided by the central bank. So these are publicly provided infrastructure, and this is a point that I would also address to Dante. But it's been designed with this interoperability in mind. So you have competition, which also promotes innovation at the same time. And it's really lowered costs and opened up financial services to previously excluded segments of the population. So Tony, I think one of the questions would be, to what extent can this new model, this new data architecture with digital ID and competitive structures with data ownership and APIs that promote interoperability be simply just taken, and that model is simply taken one step further with the CBDCs, and CBDCs can similarly have a small footprint as cash or very high level money would.
Well, let's journey into Nathan's promised land. And what do we find when we get to that promised land? We do find a different type of payment system. We find a payment system where the value is in the network, right? Sun Microsystems used to say the network is the computer. In Bitcoin, the value is in the network. Any traditional payment system, Visa, MasterCard, SWIFT, etc., there's no money in the network. If you look at it from a topology perspective from above, you see a messaging system, and the money is on the edges. In other words, the money is in the ledgers of the different institutions. Now, the question is, can we go to that promised land and then return back to the world of liability money and take the same infrastructure and apply it to a world of liability money? Because Bitcoin is radical in one very, very strong way. You said at the beginning, the social contract. Public cryptocurrencies are an explicit attempt to sever the link between money and the nation state. That's the project. That's not a by the by. That's on the first page of the Bitcoin white paper. So I think a really interesting question is this: can we, if we were to rewrite the Bitcoin white paper and drop that ideology of severing the link, maintain that social contract, but then say, how can we build a network of value with liability money, where the liability money is in the network and not on the edges? I think you get to a very interesting place. It's actually a place that goes beyond narrow CBDC and beyond bank coins, both of which fragment the regulated market. So frankly, I think that the CBDC place we're in, it's a bit of a dialectic. We had Libra, hence CBDC, and I think the synthesis is beyond where we are just now in the narrow debate about CBDC. So frankly, I think that CBDC is a milestone in a journey, but hopefully what we can do is take Nathan's promised land of the money is in the network and bring it back to the world of sovereign currencies?
That's a great way of posing it, Tony. In fact, the next panel is going to be on exactly how to scale blockchain. But let's stick to our theme. So Dante, do you want to come in and react to what Tony has just said?
Yeah, absolutely. First of all, Tony has given me a couple of analogies that I will aim to use, and maybe add one more, because I think the blend of Nathan's promised land and Tony's visual and the powerful operational experiences that Jose outlined at the outset, the sum of those parts is the desired end game. That, imagine a world in which traditional walled garden payment systems end up looking a lot like monetary airline miles. They're usable, but only if you win the postal code birth lottery and you're so fortunate to be on the inside of those four walls. The power of Tony's promised land and sort of Nathan's promised land and Tony's visual of this universally acceptable form of money that exists in digital form, what I classify as digital legal tender, is a world in which digital financial inclusion actually becomes really possible as a national priority, but it still then needs the extensibility of private sector competition to reach people who are on the margins of your own borders. So the central bank's public policy objective of its domestic monetary system can be held, inclusive of these models. But the second you want to reach the unbanked, the underbanked, cross-border payments, remittances, you do need the extensibility of private value transfer networks. And the power of public blockchain-based systems is that they're allowing that to happen. It's no longer an abstraction, I suppose, is one point I would make, Hyun, is that last week or the last several weeks, MoneyGram announced a partnership with the Stellar blockchain and with USDC Circle to enable fiat to crypto on and off ramps wherever there's a MoneyGram location. Visa similarly has activated settlement using USDC across a merchant pool of more than 70 million merchants. And so I think this idea of an open internet of value existing without really contemplating the tech stack that public blockchains offer, I don't think is really possible. It also then presupposes the existence of reliable low-cost internet. It presupposes the existence of mobile native payment endpoints that are also compliant. And then the third pillar to build this perfect house of digital financial inclusion is, of course, to address the question of self-sovereign identity. The presumption of privacy in financial services and banking is not something we discuss nearly enough, but the same type of tech stack that has ledgered more than $2 trillion of assets also offers opportunities for the preservation of privacy and the presumption of a universally acceptable payment instrument. Public policy is the missing link here.
Thanks, Dante, for that. I don't want to sort of cannibalize the session that follows, but one issue is a scalability issue, which you're very familiar with. But I want to raise another issue, which is something that I alluded to very briefly in the intro, which is KYC and preserving the integrity of the financial system against illicit activities, money laundering, tax evasion, etc. What are some of the answers here? Maybe I can turn to Jose and Nathan on this. How can we address the safeguards to keep the payment system, to keep the integrity of the system against these illicit activities?
Yeah, happy to address that. You were referring earlier to fast retail payment systems, right? And kind of the lingering question there about, in a world where fast retail payment systems are widely adopted, why would we need a CBDC? And I think that part of the answer to that question is in this one. There are two. If you look at fast retail payment systems, traditionally they have been mostly adopted, mostly in emerging economies, and mostly for P2P use cases, for peer-to-peer payments. And that probably, and again, I'm hypothesizing here, but there are two aspects of that. One of them is they are not yet fit for purpose for merchant payments. As we said at the beginning, a payment is more than a transaction. And when you're interacting with a merchant, they will want to have that KYC component. They will want to have the integration with the payment stack and all that, which is something that you could do with a CBDC probably easier than with a fast retail payment system. The other side of it, when you look at the financial inclusion angle, is that in a world where physical cash is withdrawing, if you're left, all transactions move digitally and the standard is a fast retail payment system, that still requires a bank account on the user side. you are aggravating the problem of financial inclusion for those who don't have access to the bank account. So how can you address this through CBDC and the service layer on top of CBDC? I think that a fundamental difference on DLTs versus the traditional payment stack is the programmability, and this ability on preserving the integrity of the system by doing frontier identity. I live in the US. I'm still surprised that in order to get to a location, I need to produce a proof of age that is produced by handing over a document to someone who I don't know, that has my age, but also has my address, my weight, a number of things that the person who's requesting that doesn't need to know. So this idea of being able to have tier identity combined with the programmability of the network, you have the ability on these protocols to trace funds. You have the ability on these protocols to freeze value if you have a valid reason to this. So the technological possibility to maintain the integrity of the system, both from a KYC and an AML perspective, are actually vastly superior than what we have today on the traditional stack.
Thanks, Jose. Nathan, a brief answer. I think we're coming to the end.
Sure. Yeah. I mean, I think we operate Anchorage operates as a national bank, and so we're more than confident that we can meet all KYC requirements that are imaginable and at that same level of sophistication and diligence that is as possible at the national level. And in addition, there's meaningful additions that you can do in terms of anti-money laundering, where you're able to build systems that are far more superior than exist in the traditional stack. So I think there's that.
So I think we've lost Nathan there. But let me thank all the panel. This has been a tremendous discussion. I see the next panel already waiting for us, and I think we can pick up some of these themes there. But thank you all. It's been a great discussion.
Thank you, Hyun.
Thank you.
Well, welcome back, everyone. My name is Hyun-Song Shin. I'm the BI's economic advisor, and it's my pleasure to moderate the second panel, which is on scaling blockchains. Now, the move towards decentralization is all about the benefits in terms of governance, with the checks and balances that maintain the integrity of the system and to disperse that control. But there is an argument that the price to be paid for this governance is the lack of scalability. Now, to be sure, there are proposed solutions, but some of them look like ways of, bringing back intermediaries through the back door in some way and go off-chain. So the question that we could sort of explore here is whether we're trying to bring back intermediaries, but with one hand tied behind our back, and are we trying to have our cake and eat it too? Now, there's also the issue of how much rewards should go to the validators to make the decentralized, really work, to bring about strong governance. And now, for the moment, the rewards that go to validators are quite large. But then the question is, how much are the high rewards a reflection of the inflows of new users at the initial stage? And can we maintain the strong governance when the system actually becomes mature? And we have thinner margins all around. Now we have a great panel to discuss these issues. Laura Lowe is director of blockchain at Temasek. Welcome, Laura. Tim Morton is head of engineering at C Labs. Dan Robinson is head of research at Paradigm, and Silvio Micali is the Ford Professor of Engineering at MIT and the founder of Algorand. So Dan, maybe I can turn to you first to set the stage. Could you walk us through the trade-offs between between scalability on the one hand and decentralization on the other, and where do we see the optimal point on that spectrum?
Sure. So as context, and I'm sure everyone's aware, the way that blockchains traditionally have gotten their level of decentralization and censorship resistance and trustlessness is by having everyone who uses the network validate everything they're seeing. And so Bitcoin, I think most famously, is definitely known for that, where thousands of people are running Bitcoin validators. When we move a little bit toward the scalability end of the spectrum, I think you see something like Ethereum, where it's still possible to run a validator and just to be able to verify everything on your own hardware. But often people don't. I mean, I have to admit, I don't run an Ethereum validator, and I think a lot of people, even who do, run them on in the cloud. It's still possible. I think when you go even further, you get to some of the other systems right now, like Solana, where you need to have very specialized hardware to be able to run it, but it's able to handle much higher throughput. So I think the challenge technologically can actually eliminate some of that trade-off methods of scaling that don't involve having to offload computation to a trusted party, but that allow more throughput on your chain. And so Ethereum, for example, is trying to go toward that with ETH2, which involves a much more complicated way to do consensus rather than having everybody validate every.
Thanks, Dan. That's a great way to kick off. Sylvia, can I turn to you next? And I mean, you're really the expert on this. I mean, what is your view on this? While I mean, I think we know the philosophical push towards decentralization. I think it's economists would call it getting to the equilibrium in this decentralized setting, and it's often claimed to be the highest objective in the crypto ecosystem. And providers are willing to some extent to sacrifice decentralization in order to get some better scaling. So what is your view on this? And I suppose the bigger issue is how important is decentralization really for the future of crypto networks? You're still on mute, Sylvia.
Thank you for the question, Yoon, which is very important. First of all, it is an old narrative, right, that decentralization and scalability have to be at odds with each other. Buterin's trilemma used to say that no blockchain could be simultaneously secure, decentralized, and scalable. And that was empirically true for the first 2,000 blockchains, but is no longer true and never was actually true. At this point, the collision course between scalability and decentralization at this point is the dystopia of the uninformed. There is no need, all you need is actually better technology. So certainly proof of work is very expensive, and when it's so expensive, very few people can participate to consensus. If you look at the proof of stake, delegated proof of stake, well, you put in charge 21 people, say, and ask them to run the consensus on behalf of the entire network. That is centralized by design, et cetera, et cetera, et cetera. So you need to have a little bit more, a bigger and deeper technology to achieve that. But I believe technologies like pure proof of stake actually are perfectly decentralized and perfectly scalable. Now, why is the decentralization important? First of all, as you mentioned initially, for the integrity, in particular for a national state, and now we see national projects. They don't want to go into the hands of a few people who tell them what to do. And never mind national state, but very big financial institutions don't want to fall prey of the few either. So that is really important for the integrity, but it's also for the trust of the participants. So think about it. If you want to run an auction on a planetary level, because you have just built an office building and now you want to auction off, then what a great idea to have the whole world participate and perhaps tokenize the building so everybody can actually has a chance to bid. Well, you need scale, but you also need decentralization, because the moment in which I'm going to inform a club of 10 who was in charge of a blockchain allow my bidding, allow lower bids than mine, but do not allow higher bids, I'm going to get your office building on the cheap. And in such a case, you're better off going to Christie's or Sotheby's and pay an arm and a leg for running the auction, rather than if you have one chance to put something of real value on an auction on a blockchain. So decentralization is really the reason for which is the engine of trust in a blockchain. You take decentralization away, you have nothing.
Let's come back to Silvio. I think there are some very important points that you're making there. But let me, in the first round, let me now move to Laura. So at Temasek, you're considering a range of blockchain applications, at scale, I think. Where do you see the most promising applications of DLT over centralized systems, and what's motivating your thinking there?
Thank you, Hyun. Well, as a long-term investor, Temasek continues to seek new and exciting opportunities that can help us build a better, smarter, and more sustainable world. Now, to answer your question and to understand where I see all this going, we must first look at the evolution of the internet. Initially, the internet was a network that connected research and development labs to increase collaboration. The real value was unlocked when the internet started connecting networks, creating the opportunity to build completely new business models in the likes that we've seen today: Amazon, Google, Alibaba, Tencent. Now, similarly to the internet, which was able to organize networked marketplaces, we see blockchain evolving into a greater ecosystem that will lead to new business models and possibly entirely new industries. And this will help create new value, new capabilities through communities of innovation. Now, on that note, our three focus areas to date have been in digital identity and credentials, programmable money, and digital assets. Now, I won't go into all of them, but specifically on digital identity and credentials, we viewed privacy and data protection as extremely important challenges that need to be tackled. And to that effect, we have founded Affinity, Trustana, and Good Worker. These are companies using decentralized technology to create self-sovereign identity solutions. Now, Affinity empowers individuals and organizations with control of their verifiable data to unlock value across platforms and geographies. Other applications of Affinity's technology are that we've also been working with various partners to conceptualize and build safe travel solutions centering on digital verification of health credentials, such as COVID-19 test results and vaccination status. We also have work being done by AidTech and Women's World Banking to enable insurance solutions for the underserved populations in Africa. Now, what underpins all our work in this area is standardizing data schemas, creating tools to allow the owners of data to issue data in an interoperable and verifiable manner. There are already W3C credentials that are global standards. And we think that these tools will allow you as a customer to own, control, and share data. So all you need is a hash to state where the data has been tampered with. Now, in summary, we think blockchain has the ability to take a decentralized approach to data management, theoretically putting control back in the hands of the user with the help of blockchain technology. It can also be used to break down walled gardens and create an open and interoperable ecosystem that we think will ensure fair distribution of value.
Thanks, Laura, for that. Do you have a view on the question that I asked Silvio earlier about whether the attempts to scale DLT is another way of bringing in intermediaries, that there is a trade-off here? Do you see any trade-off between decentralization and scalability?
So for many businesses or institutions, assessing whether blockchain's disruptive potential, I think it's both a practical challenge and a philosophical one. Now, whether this technology will be used to displace or complement traditional models, it's still an open question, as it really hinges on the ability to deliver transformational changes. Now, I see scaling occurring on multiple fronts, but the two most important ones to me, at least, are the ability of the platform to support increasing loads of transactions, as well as increasing the number of nodes in the network. I won't go into details on this, as I think there are more qualified panelists here who will be able to speak to this in greater detail. But in short, 2 to 3 years ago, the technology was not there. But now we see layer 1 and layer 2 solutions scaling quickly, which makes things more scalable and very much like the early days of the internet. And then there's also scaling from an accessibility and adoption standpoint. If blockchain is to become adopted by the masses, accessibility is a must-have for decentralized applications and blockchain applications that aims to be game changers. So anyone can join whenever they want. So scaling in terms of users and ease of use for consumers and businesses. Now today, there's still many businesses that are still confused about blockchain. While the aim of the technology is to bring trust, simplicity to the transactions, the truth is, the infrastructure itself is still complex. So you have smaller and less savvy businesses, finding the idea of using blockchain daunting, especially if they have to manage the systems themselves. Now, the good news is they don't have to. Today, blockchain as a service already allows customers to leverage, cloud-based solutions to either build, host, and use blockchain applications without having to manage the infrastructure themselves. But what else is driving adoption? How can blockchain be more accessible for our businesses? There are countless positive use cases, for blockchains, aside from what I had spoken earlier, right? Ranging from supply chains to healthcare to digital assets. So as customers demand to know more about products and services they buy, blockchain offers the means to make supply chain more transparent and as a result, more trustworthy. In healthcare, we think that user control will be a key characteristic. And this could be an amazing use case for cross-border use. For example, in a hospital, exposing an API cross-border to another is a complete nightmare for them with health regulations and all. But say, Hyun, if you have a file on your phone and you walk across the border and share that, and that becomes your own personal data that you're sharing, and verifiers can check it to see if it's genuine. So that is one use case that you hold data yourself. I think another major catalyst for blockchain is actually Web3, the next iteration of the internet, right? So while we believe that Web2 will continue to thrive and exist, I think there's a clear shift in trying to create new ecosystems whereby you're not siloed and that you're not creating full stack platforms at the very core. So Web3 is philosophically an interoperability first type of technology. It's more permissionless, it's more collaborative. I build on you, somebody else builds on me. And so as a result, it can innovate at the speed of entire communities rather than keeping everything in silos.
Thanks, Laura. I'd like to bring in Tim. So Tim, Sylvia mentioned proof of stake. I think, and you're the real expert on this. And Celo, where you, which is the new platform that you're working on. It has ambitions to deliver services available to the 6 billion smartphones on Earth. So as well as the technology, I guess my question to you is, how do we actually get the network effects going when it's a kind of separate platform? How do you get the more use begetting more use, and is that the way to address the scaling problem?
Yeah, that's a great question. So yeah, I think there's an interesting distinction between kind of scalability and throughput. I kind of think of scalability as being able to add. First to come back to kind of like some of the points made earlier, some of the scalability is about being able to add more resources to the network and being able to expand to meet demand. What I think we're really talking about with many blockchains is really like throughput. Is there enough throughput? And is there enough throughput for the level of decentralization that we require and need for the use cases that we kind of we as a community of operators and users care about? I think it is clear to everybody that traditional distributed databases can achieve far higher throughputs per se, and that is, but obviously at the cost of like having to be centralized and not having that benefit of distributed ownership. It is interesting to think how you kind of like move from where we are at the moment to a world where you can really kind of deliver services for the 6 billion. First, it's probably worth pointing out that like most centralized services, so, you know, apart from like the very, very largest web properties, do not even attempt to address like user bases or problems that scale into the billions. And there they are made up of like many kind of individual, like a constellation of kind of individual services, right? If you look inside Google, Facebook, Apple, and so on, and, you know, Visa, MasterCard, and other centralized payments networks also would not today like meet that kind of level of scale. So I think as a, you know, broader technology community, we still have a long way to go, whatever the technology looks like, to be able to kind of address this challenge. And that is definitely true for the blockchain. However, it does depend a lot on like what kind of use cases you're looking to tackle. Of course, like payments are like simple transfers are more straightforward than some more of the kind of complex kind of financial services that you can explore with DeFi and so on. And for things like savings use cases, many users can get the benefit of a platform without actually having to make many transactions. If you think how many times you actually like go in and look at your savings balance in your regular like bank account or ever interact with that, it's typically very it's very rare. So yeah, we in the Celo community have like, you know, built out a proof of stake system with like with the Byzantine fault tolerance consensus algorithm underneath, where we are achieving kind of fast finality, like transactions are guaranteed complete within 5 seconds, and the throughput at the moment is like, you know, definitely far short of being able to deliver services for billions of people, but we were able to keep fees low, and we're able to keep you know, growth in the platform is growing rapidly, and we're able to like continue to meet that demand. But it is definitely an ongoing like technological challenge for sure. There's a lot of work underway. We recently announced a partnership with Miston Labs, bringing a number of innovations there that were into the Celo ecosystem, and there is a whole complex strand of research that we are doing as well to like deliver like far higher throughput. But yeah, it's very different for different use cases.
Thanks, Tim. I think that's I think you've laid out the issues very well. You know, maybe I can just, you know, pursue this a bit more. Celo, I gather, is Esperanto for purpose, which is one of the things I sort of picked up today. I just want to go back to this idea that that also Sylvia raised earlier, which is this idea of, you know, the whole philosophy of decentralized governance and the notion of equilibrium, where everyone is doing their bit to reinforce that you know, that governance, and there's no, you know, single party that's conducting this, but you know, everyone's you know, self-interested behavior you know, reinforces that governance. Now, one of the issues is how are the validators who actually enforce that, you know, rewarded? And one way to pose this is, you know, the so-called miner extractable value, sort of the extractable value of the miners themselves. And you know, with network validators, they have privileges. You know, they have perks of you know, being validators. And I guess, you know, my question to you is, you know, and at the moment the rewards are quite large because these, you know, networks are expanding and new users are coming in. You know, there are surpluses to be shared out and so on. But once we sort of reach scale and we reach something like steady state, where will that reward come from? And then, you know, and how can we get the system, you know, to remain in equilibrium by you know, giving enough rewards to the validators while keeping it sort of cost effective and lean and cheap for the users?
Yeah, it's a great question. So Celo takes the interesting design decision to pay out validator rewards in its stablecoin CUSD. So I guess like based on the observation that most of the cost outlays of validators are actually incurred in fiat currency, whether it's like cloud hosting or purchasing a machine and data center and network connectivity and so on. So the idea there is really that both the validators are protected in case volatility falls in the value of the currency, or but they also don't necessarily see all the upside. And this tries to reflect the reality that validators are an important but only one part of the puzzle here, and that the job they're doing is relatively fungible, right? That nevertheless, a lot of these protocols do have real limits on the number of, including Celo, real limits on the number of validators that can effectively participate, and also even the ones that have higher limits on the number of validators are don't scale often in the sense that by becoming a validator and contributing your resource to the network, you're actually adding capacity. It's more like you're repeating work or adding security to the existing kind of system. So onto the kind of point you made about minor extractable value, that is definitely a challenge. And it's grown to become a significant issue in Ethereum, especially where transactions are often waiting for a significant amount of time because the demand far exceeds the capacity at the moment, and because the average value of transactions and the kind of steps that they take because of very high gas fees tends to mean that there is a great incentive for front running and so on. I don't know that so far we haven't seen tons of this on Celo. We've seen some. I think it's a very interesting research area, to consider how you can avoid or minimize the effects of MEV. It's something which I think is very actively kind of worked on.
Yeah, thanks, Tim. I want to bring in Dan and Silvio back to this question as well. So Dan and Silvio, and maybe Dan first here. Just following on what Tim said, there are clearly issues that we can deal with through better technology, just the laws of physics. But then there are these other issues that are more the economics, if you like, the self-reinforcing nature of incentives and essentially the game theory and the economics. How much is the problem more about technology, and how much is it more about the underlying incentives? So Dan, maybe I can start with you first.
So I think there are definitely some fundamental technical limits, but I think we're already hitting the point where people are a little more concerned about the game theory because I think it's a worse failure mode. So we see on Ethereum right now, for example, we're starting to see MEV, it's sort of in not a mature state, but we're in sort of more developed state of sort of a pure financialized MEV market, and it's already starting to get a little worrisome. So what's happening on Ethereum now is basically that they've kind of mechanized the extraction of minor extractable value from blocks, and people compete to submit blocks through this protocol called flashbots. And I think that's better than some of the problems that were happening before, but it leads you down maybe a dangerous path, and one where we'd like to design mechanisms to try to avoid this. The issue, the core economic issue that I think that they're trying to wrestle with is that in a proof of work network, whatever miner has the cheapest cost of mining will win. And so an honest mine, that includes any kind of offsetting revenue you can make by, for example, accepting bribes to include certain transactions or censor others, or by manipulating the order of transactions in a block in order to win some arbitrage. And so even if all the existing miners were really honest, it only takes some miner that's doing that's extracting MEV. They'll have essentially a lower cost of producing blocks, and so those miners will end up outcompeting the honest ones. And so you have to make you have to design the whole system in a way that ideally discourages that kind of race to the bottom. I think Vitalik has recently been proposing some idea. I'm most familiar with this in the context of Ethereum, and has recently been proposing some ideas for how to build in actually MEV extraction, build this into the core protocol, but in a way that makes it relatively fair. So sort of it's a even game. So at least it doesn't exacerbate other problems like having exchanges control it all, or having whoever's running the fastest computers. I do want to one who have this problem. It's not just a problem of decentralized systems. And so you have MEV in traditional systems where, for example, if you're running an order book, whoever's located closest to you has an advantage in terms of being able to get orders to you fastest and see the data fastest. So they end up extracting MEV in the form of co-location fees. And so it's actually pretty hard to get rid of any kind of advantage like this. And the hope is to try to democratize it to some extent and financialize it so at least it's efficiently extracted and in a way that doesn't necessarily hurt users.
Thanks, Dan. Silvio, over to you. How much can we deal with through better technology? How much do we need to take care of the economics and the incentives and the mechanism design?
Listen, I have to be frank with you. Blockchains are a very sophisticated societal goal. And to achieve this goal, you need sophisticated technology, period. Short of technology, sophistication, you are at the whims, at strange minor extraction value. Now we want to make it fair, at least, of a minor extraction value. The whole architecture of incentive comes from the very large cost that traditional blockchains are imposed for you to participate to consensus. So if you go to a blockchain, you should ask yourself the first question. Am I allowed in as part of consensus? If the answer is yes, buy a couple of supercomputers and join us, then you're centralized from the get-go. If the answer is sorry, but we have already a club of 100 who take care, of consensus on behalf of all of us, you realize not everybody can participate to consensus, then you are in the wrong place. But if consensus is so simple that it costs you nothing to participate, then why do you need the incentives at all? So if I'm going to ask, buy a supercomputer, do this and that, refrigerate this computer that generate a lot of heat, then of course I want to be remunerated. Otherwise, I cannot even cover this cost. But if we're going to say, let me ask you the following other question. So how many times have you logged off of Gmail in order to save electricity? My guess is never. Right? So, and the reason is when things are so cheap, you don't even need the rewards. So this whole architecture has been originally, we had to start somewhere, and we started with very clumsy architecture. I think it's time that we move on to a next generation of blockchains that they already exist, and solve at the root this problem of perverse incentives rather than trying to make them fair later. Of course, these incentives, when you have, these incentives, people are not going to, they are going to try to maximize profit, and you are going to have a very strange and unpredictable behavior. So if you can achieve the same benefits of architecture by asking people to sacrifice very little or nothing at all, you are going to find that a lot of people want to participate to consensus just because they can, it doesn't cost, and is for own benefit, even for free.
Yeah, that's a good point, Sylvia. I think the counter argument from the other side is for that validation to have value from a governance perspective, you do need to have people who are serious, and I guess there is a kind of fine balance there in the economics of incentives.
Seriousness doesn't come from the incentives. If I'm paid for doing anything, I'm not serious. Seriousness comes from the fact you are welcome to govern. It costs you nothing or extremely little, and you are welcome and you can contribute. Now, do you want to contribute? If yes, please govern. Join us. If not, fine too. Even if it means because I trust you, because I know that I can participate whenever I change my mind, I can work. So this necessity, that seriousness comes from paying people for doing large investments that they want to be made whole from, is really the root of the incredible problems, and it only can get worse.
Thanks, Silvia. We can take this offline. Okay. I want to go back to Dan and Tim actually on some other issues. I think Dan first. I mean, whether it's by design or by accident, we see these open networks as providing a huge amount of data, and it's hugely beneficial, very transparent. But lack of privacy is going to be one issue, and the security concerns that arise from that. And I want to sort of ask this question to you, Dan, which is, what is that balance between transparency and security that we should be aiming for? And of course, all the while we need to scale these networks as well.
Yeah, so I think for the specific case of privacy for, say, payments, or for ownership of assets, NFTs, whatever, for privacy of a ledger where you're just doing simple stuff like transferring ownership of something to someone else, that's almost a solved problem, at least from a given that we have these generalized zero knowledge proofs. We sort of know how this works, and there's the system called like Zcash, which is live in production. There's ones like Tornado Cash on Ethereum that implemented as smart contracts, and I think eventually that's just going to be solved for privacy for just sort of like ordinary distributed ledger tech. And some of the same technology there, these zero knowledge proofs, we're getting a lot better at them because they're also useful for scaling. I think for other areas, a lot harder. Like it tends to be application specific. Like a lot of what's going on in crypto is like DeFi right now, right? And DeFi does include payments, but it also includes like decentralized exchange. You can't really have an exchange where everything is private. You have to know what the price of something is before you can trade with someone. And so figuring out like, okay, which parts can we hide? Like maybe the identities of the traders, maybe your order, hide your order until someone fills it. I think like there's trade-offs to do that, but it ends up being very application specific. So I think there's going to be a lot of research in the future on figuring out how to do that.
Thanks, Dan. So Tim, can I just go on to another issue, which is which is this apparent irony that in spite of all the ambitions for decentralization, it seems that the applications of DLT, at least in financial services, has so far led to more greater concentration of wealth for a few, and they often turn out to be very some of the key centralized intermediaries. Do you think this is a bug or a feature of the system, and can we actually deal with this as we develop these systems going forward?
That's a great question. I think there are many different layers which you can answer this. So, and part of it comes back to your previous question and Dan's answer. So I think like the permissionless nature of being able to participate in blockchain-based systems just by generating a key pair or being a kind of holding a pseudonymous account kind of makes a bunch of things very difficult. So it makes it difficult to know for sure that two different accounts, it makes it impossible to know that two different accounts relate to two different people. And so we end up with on-chain governance systems which reluctantly embrace token balance based voting. So you end up kind of voting with your wallet, literally voting with your wallet, rather than kind of one user, one vote, which is much more of a kind of model that you would say is fair and that is desirable and that is familiar to all of us in the real world. And that is challenging. That is very challenging to solve. Like from a game theory perspective, it's like very difficult to kind of work around the potential kind of collusion implications and the civil implications of that. But I think that there are, potentially interesting avenues to explore around identity and like creating private but secure attestations to identity. And a number of projects on Ethereum looking at this right now. Celo is also, the Celo community is also like looking at this as well as the kind of decentralized identity protocol that Celo already includes around like phone numbers. So there's that kind of level, and the implications of that are that like you can do more if you have more tokens in the system from a governance perspective. At a higher level, like you can look at the application layer and you can say like, hey, you know, if blockchains are here and allow you to like make money, then obviously if you have more, then a specific percentage yield on that greater amount is going to make you more money. I think that, so obviously that is a lot of the focus of DeFi right now, and DeFi may feel massive, but I think, you know, my hot take is that DeFi is very, very early, as a very early example of how a lot of things in the space are going to transform financial rails. And, you know, for example, like most DeFi, almost all DeFi lending is like over collateralized, right? Like that is, if you think about the lending that you or I would do, where we get a mortgage out, or we get a car loan, or we make we take out a loan where we actually like we are a known entity, and we provide some identity documents and we say, hey, this is us, and you know, if we don't make this repayment, you can come and find us. Like because identity is weak in blockchain systems at the moment, those mechanisms are like less available. But the real market, I think, for collateralized, like, you know, under collateralized or uncollateralized lending, and the opportunity both from a yield perspective for liquidity providers, but also in terms of like the engagement is just like phenomenally, I think outstrips like the size that we're seeing of DeFi right now. We're only seeing like 3 million participants or so in DeFi projects across all protocols at the moment. But you know, Celo has run some very interesting programs in Colombia, where we have seen loans, like Celo blockchain-based like stablecoin loans to individuals, be able to like get repaid at an extremely high rate and be able to like dramatically increase individuals' earning capabilities. At the same time, like it's often, you know, it's often about what you do with it. On Celo, Impact Market is like the largest private universal basic, like non-governmental universal basic income program that I know of. It's distributed funds to, I think, over 20,000 recipients in about 100 different communities. Celo has been used by the Grameen Foundation to deliver humanitarian aid to thousands of micro entrepreneurs during the COVID crisis in the Philippines, and is able to facilitate, like, you know, many blockchains are used to facilitate like remittances and cross-border payments between families and friends. And so, like, in that sense, we're seeing the beginnings of real opportunity to kind of provide lower cost access to many basic kind of financial services for individuals. So it isn't just about like identity, and it isn't just about, you know, like the challenges of pseudonymous accounts. It is really like about what you do with the service.
Well, thanks, Tim, for that. We've run out of time. We've run over, but I think we could easily have, you know, gone for another couple of hours on these very interesting issues. So, you know, let me thank you all for this great discussion. Thank you, Laura, Silvio, Tim, and Dan. I think what I'm taking away from this is that, you know, there are some really deep technological issues, but some also very important you know, issues that come from the incentives and the games theory, because, you know, this is, after all, a social enterprise that we're doing. And as Laura actually you know, outlined, there are some huge you know, prizes we have in front of us. So it's great to have the top team working on these issues. So thanks very much on behalf of the organizers. You know, thank you for joining us. And I think it's still relatively early, although Laura, it's quite late for you. Have a great day wherever you are.
Thank you.
Thanks a lot. Thanks, Hyun, and thanks to the last panel for those great insights. So we've talked today about central bank digital currencies, about different types of innovation. We've talked about blockchain technology and how to scale it. We're now going to change gears a bit and talk about privately issued stablecoins and how to regulate them. So stablecoins are a type of cryptocurrency that aims to maintain a stable value relative to a specific asset or a pool or basket of assets, mostly fiat currencies. And stablecoins can bring a number of benefits for users in the financial system. We've heard a bit about this today, the promise of lowering the cost of payments, providing new functionalities like programmability, various use cases in finance like lending and others. But there are also some inherent risks. For instance, stablecoin issuers may have a strong incentive to invest in risky assets to earn a higher return on client funds. And like other forms of payment, of course, they could be used for money laundering and terrorism financing. And there have to be controls in place to prevent that, of course. But most importantly for this panel, they could become critical financial market infrastructures at the core of our payment systems. And central banks and financial regulators already oversee critical infrastructures like payment systems. They aim to ensure that they work regardless of what's happening in the world, and they aren't the source of major disruptions or financial crises. And there's been a lot of international work on stablecoins in the G7, in the Financial Stability Board, and on the oversight of stablecoin arrangements as financial market infrastructures. There's been work by the Committee on Payments and Market Infrastructures, or CPMI, and the International Organization of Securities Commissions, or IOSCO. We're very privileged to have a panel here that can talk about this international work from a variety of different perspectives. We have Dave Mills at the Federal Reserve Board. Welcome, Dave. We have Cecilia Skingsley from the Sveriges Riksbank, the Swedish central bank, the oldest central bank in the world. Thank you, Cecilia. We have Martin Maloney, who is the new Secretary General of the International Organization of Securities Commissions, IOSCO. And we have my colleague, Tara Rice, who is the head of secretariat at the Committee on Payments and Market Infrastructures at the BIS in Basel. So welcome, everyone, and thanks a lot for joining. So let's jump right in with Dave. Dave, in the United States, of course, there's been a lot of discussion on stablecoins. The White House announced on October 9th that it was coordinating efforts across US agencies to supervise and regulate the growth of cryptocurrencies more broadly. Can you tell us about these efforts and how they apply to stablecoins?
Hi, John, and thanks. Yeah, so I would say the biggest impact in terms of thinking about stablecoins is actually coming from something called the Presidential Working Group on Financial Markets. That is a group that is led by the U.S. Treasury and has membership of our markets regulators, so the Securities and Exchange Commission and the Commodities Futures Trading Commission, as well as the Federal Reserve Board. By invitation, there's also other bank supervisors that are present in this Presidential Working Group, which would include the Office of the Comptroller of the Currency, or the OCC, and the Federal Deposit Insurance Corporation, or FDIC. So the three main federal bank regulators or bank supervisors, plus the markets regulators and the U.S. Treasury, have all been organized to think through ways in which to identify a variety of potential risks to stablecoins to the financial system, as well as identify any gaps that we might have within the U.S. regulatory perimeter, and then finally come up with some potential recommendations on which they could be implemented as ways to mitigate some of the risks and address some of the gaps that have been identified. So that is work that is ongoing. And is really focused a bit on the stablecoins market, and in particular on stablecoins that could be used as a means of payment.
Thanks, Dave. Yeah, and I know that we'll hear later in the week also from Nelly Liang about the President's Working Group and about some of the work there. I think it is really relevant, and people are going to be very curious to see what comes out here. We'll get back to you with a few more questions in just a moment, but let me turn next to Cecilia and just ask Cecilia, if a stablecoin arrangement were to gain traction as a commonly used means of payment, what are some of the design features that you think are important for stablecoin developers like those watching today to consider?
So thank you, John, and hello to you all. Well, we may see a future where stable coins evolve into a kind of money, or at least have some functions that we classically associate with money. And these functions are the three classical criteria as used as a means of payment, that is working as a unit of account, and that is also a trusted and a stable store of value. And from my perspective, a prerequisite for any stable coin should be that is designed in such a way that it properly handles all its risks, whether it be credit risk, liquidity risks, operational risks, cyber risk, anti-money laundering risks, and the list goes on quite long, actually. And it needs to be designed in a way that users of the coins find it transparent. And one example of this is that the composition of the reserve to which the stablecoin is backed needs to be properly reported. The holdings of the reserve should be transparent for the users, because if the stablecoin reserves is not composed of sort of trustworthy liquid assets of high quality, I see it very difficult for a stablecoin to become a commonly used means of payments in the long run. And one interesting case I think we've seen as we see this stablecoin world develop is that some stablecoins have similar functions to money market funds, in that their reserves in large parts consist of commercial papers, but without following the same regulations as these funds. And if a stablecoin is designed in this manner, I think it should be clearly conveyed to any holder of the stablecoin that this is the case, because I think it might affect just how stable the coin actually ends up to be. And so from a public sector perspective, we do not want to end up in a situation where sort of financial agents manage to circumvent existing regulations just by using new, very cool technology. And that is my main key takeaway also for those who are listening into this or are stablecoin developers as well. If the services they offer and the risks of those services are similar to what we already see and know from other financial agents in the sort of more traditional part of the financial system, the stablecoin needs to be arranged in a way that should be in line with the current set of regulatory frameworks for sort of similar functions. Because really, in the end, nobody wins from an unlevel playing field. And although we can be very excited about the new technologies that are being exploited and all the innovation that is happening, we shouldn't allow that to come fully into play at the price of an unlevel playing field or more risks in the financial system. I'll stop there.
Thanks, Cecilia. No, that's very useful. Let me turn back to Dave. You were talking before about the President's Working Group and the different authorities in the US that are looking at this. Can you tell us just some of the primary considerations that authorities have? What are the policy goals that are in scope for these discussions?
Sure. So what's interesting, in the international community, we often refer to stablecoins in a context of stablecoin arrangements. And what's kind of interesting to think about as a stablecoin arrangement is really that you are seeing a multitude of functions similar to financial services functions that are played across a variety of different financial sectors. So what I mean by that, for example, is if you can think somewhat simply of a Venn diagram, there are certain bank-like sort of functions, and then therefore bank-like risks, pretty much tied to the issuance of a stablecoin. So if a stablecoin is going to be used as a general purpose means of payment, be used for remittance payments, there's some expectation that it operates much like either physical currency or bank deposits. So they act a bit like bank deposit substitutes, and therefore, one has to sort of think a bit about the issues associated with bank deposits as well as bank-like risks. So that's one sort of part of the puzzle. The second is that these stablecoin arrangements exist either on their own or broad sets of platforms mostly using blockchains, distributed ledgers, some of which will be permissioned, some of which are permissionless. But regardless, they're basically like payments infrastructures. So they're sort of the second circle on the Venn diagram is sort of these payment system issues and payment system risks that one needs to think a bit about. That kind of gets to some of the things that Cecilia was referencing around, resiliency and operational risk, and areas like that are also going to be important. The third sort of part of the Venn diagram that I would describe is sort of the customer experience or the end user experience, which is a lot like different types of entities that are more like wallet providers than your sort of traditional bank service providers. So here again, you're talking a bit about basic foundational issues around consumer protections and assurances that the funds or stablecoins that may be held are safe and secure and reliably stored, whether they're on a blockchain or stored off the blockchain. So sort of identifying a lot of the parameters around that. And then maybe the final part gets to the markets regulation. So, how are stablecoins used to facilitate markets around broader sets of digital assets and cryptocurrencies? How might they be traded? What sort of secondary markets may or may not arise? Or additional considerations that you would need to think a bit about. And so, indeed, that's why we kind of call them arrangements. They actually have flavors of a lot of different areas of the financial system, where, in many of our jurisdictions, we normally will have a lot of, sort of specific roles and responsibilities, specific types of agencies or authorities. In the case of stablecoin arrangements, we might have to think a bit more holistically about how the stablecoin arrangements might be able to provide a safe, secure, and reliable means of payment in the future.
Thanks, Dave. Yeah, that's really really useful. And indeed, it seems that stablecoins, depending on the use case, depending on the context, do look a lot like other financial products. So at the very least, they're already succeeding in bringing authorities together and talking about how the mandates interact. So I wanted to turn next to Martin. And Martin, you've just started as Secretary General of IOSCO in Madrid. So congratulations.
Thank you.
IOSCO has done a lot of work in this area, for instance, with its report on stablecoins last year. And we wanted to ask if you can share some key takeaways from that work.
Well, actually, it's really interesting listening to both Cecilia and Dave talk about this, because one way I like to think about financial regulation and our regulations and standards that we promote anyway, is it's like our collective memory of things that have gone wrong in the past, and we learned lessons and we made rules in order to deal with things that have gone wrong. But when you come across something new like stablecoin that doesn't fit easily into the established frameworks, you've got to wrestle, as David was doing there with his Venn diagram, to try to fit it in and try to figure out, where the lessons are and where we need to be cautious and where we can be a little bit more liberal. And that's where we came in 2019 and 2020 when we did our initial work on stablecoins. And we used, I think, a slightly interesting way to do this, which is that we invented a concept of a hypothetical stablecoin with a sort of complex design structure. And that allowed us to illustrate a number of linkages between a stablecoin and existing regulatory frameworks and how there might be touch points. And we did that really to inform our members and indeed the legislators that are, in a sense, behind our members from our point of view as to what was going on here and how they might want to think about stablecoins. So if I give you an example, Cecilia spoke earlier about stablecoins being a bit like money market funds. Well, that was actually one of the points that we highlighted in our report, that sometimes they can act like money market funds, and we brought out from our money market fund principles the particular principles that could be relevant to stablecoins. And we did the same thing given the particular design that we gave this hypothetical stablecoin in relation to our principles on ETFs, because we gave the stablecoins of authorized participants, and that allowed us to bring out how that can be relevant to the way in which a stablecoin might deal with variations or fluctuations between its value and its underlying assets. And there were some other aspects of our really very well developed existing standards for securities markets and securities regulators that were really relevant here. And one was the work we've done on crypto asset trading platforms, because it's inevitable with stablecoins that they will be traded on crypto assets trading platforms. And as everybody will know, there are a whole range of issues that have arisen with those trading platforms in recent years. Maybe a more obvious one is to talk about our rules and principles on client assets. And that's another area that's actually relevant to stablecoins if you think about it. And the final one I think that we really highlighted was cyber resilience, which is a really important area. And if you look at some of the issues we tried to bring out, you think of a stablecoin as having an issuer. Well, there are potential conflicts of interest between the issuer of the stablecoin and whatever other aspects of their business model that they might have going on that could create those conflicts of interest. Then you look at the secondary market issues that we always highlight as securities regulators, and lo and behold, lots of them turn out to be very relevant, particularly transparency of markets. And I don't have to cite any examples of stablecoin for people to understand that transparency of markets and transactions in markets has been an issue. But for us, we've always emphasized the importance of the link between transparency of markets and market integrity. If you don't have transparency as to what's going on and how markets are operating, then you are wide open. And we have learned this decade after decade in different markets to market integrity being compromised and there being market abuse in markets. And then there's the question of supervision. As a international standards body, we spend a lot of time working on the really difficult issues of cross-border supervision, for example. And that's got to be a big issue in relation to stablecoins, where it's a huge challenge. I don't claim that we or anyone else has definitively solved that question, but we continue to chip away at it to try to get better coordination between supervisors in relation to cross-border supervision. And then there's an AML-CFT, for example, was another one of the issues that we highlighted. And I heard Tim Morton on the last call talking about the idea that identity is weak in this environment. Well, the obvious connection to AML-CFT concerns is there. And I think the last part of our report that might be worth me mentioning is we actually set out a whole list of areas, an almost agenda of areas that people should look at in relation to investor protection. And that was like pre and post trade, financial promotions that can be used in relation to stablecoin, disclosure requirements around the issuer or the product, and regulatory reporting. You've got to get that clear. And complaint management is a really important part of conventional regulatory frameworks that are really important for investor protection. And then you get to investor protection schemes. And if a jurisdiction, we were trying to advise them, is trying to regulate and legislate for investor protection in this area, these are all areas that we were saying that they should look at. And we have gone on to work with Tara on the question of the principles on financial market infrastructure, and that's another area of work that Tara actually knows better than I do. But that was the next stage of our work after that report, and our work on stablecoin is continuing.
Great, thanks a lot, Martin. Yeah, let's turn then next to Tara. And Tara, the CPMI and IOSCO jointly published this consultative report on October 6th that provides guidance on the application of international standards to stablecoins. So can you tell us a little bit more about that report and about that work with IOSCO?
Thanks very much, John, and it's a pleasure to be here. So yes, we've been working very closely, speaking of international coordination and cooperation, with IOSCO over the last 18 months to assess our core standards. Those are the principles for financial market infrastructures, PFMI, and how they apply to stablecoin arrangements. Now, the PFMI were designed in 2012 and designed for traditional, as we would say, or existing PFMIs. But they were also designed to be technology neutral and designed to sort of, expand or to survive the developments that technology would bring. And in fact, we find that that is the case. So we had, over the course, like I said, about 18 months, we'd really looked at how well stablecoin arrangements would apply or how well the PFMI would apply to stablecoin arrangements, we looked at a number of things. We looked at the basic functions that a stablecoin arrangement would perform, and that is according to the FSB, and we took the same approach, a functional approach, looking at the 3 areas: the issuance, redemption, and stabilization of the value of the coins, the transfer of the coins, and the interaction of those coins with the users. So we focus quite narrowly on the transfer function as a payment function. There is more work to be done on this for sure among standard setting bodies, but we focus really narrowly on that transfer function. And as a result, we concluded that if a stablecoin arrangement performs the transfer function and is considered an FMI for the purpose of applying those standards, and if it was determined to be systemically important by the relevant authorities, then it would be expected to observe all of the PFMI. So that's a mouthful, but it basically says that if a stablecoin arrangement is performing this sort of payments function, then our standards apply quite broadly to that function, that payments function. And so there were 4 principles that we provided some clarity on, some additional information on, and we also then discussed the notable features that are sort of new and novel to stablecoin arrangements, which are not inherent in traditional payment systems. And those are that the fact that the potential use of settlement assets that are neither commercial bank money nor central bank money could carry additional risk. Another one is that there are multiple interdependencies between stablecoin arrangement functions that are not sort of inherent in normal payment systems. There's also a degree of potential decentralization in the operations of the governance function of a stablecoin arrangement. And finally, the DLT technology, distributed ledger technology, offers a number of particularly interesting sort of challenges and perspectives that we should consider. So this report, it's just a consultative report, so we're really looking forward to input from industry, from stakeholders. It's only providing guidance on a subset of principles, but we expect that that systemically important stablecoin arrangements would be able to or expected to observe all of the relevant principles in the PFMI. So that's it's a lot to digest. It's 18 months of work. The report in itself is quite pithy, I would say, in kind of its conclusions, but it actually is quite substantial in its findings. So let me just turn it over. I'll conclude with one final thing, and then I'll turn it over to Martin to see if he has any additional things. As I said, this was just it was the culmination of about 18 months of work of really looking into our standards and seeing how well they could apply to new developments. And we welcome new innovations and new developments, but we also acknowledge that there's simply more work to do on this area. And so with that, let me just see if Martin has anything else to add.
I guess it just struck me, Tara, thank you for passing back to me. It just struck me that you mentioned in passing what might be the most important point for the audience on to this event, which is that it is pithy. This report is short and to the point and asks a set of very clear questions. And given the kind of audience we've got here, it would be really great if people had a look at it, and it won't take long to read it. And it's asking, and it repeats this point a few times, is the guidance that we're issuing, is it clear and is it actionable? And that is really what we want, the kind of feedback we want. Is it clear? Is it actionable, this guidance? So if people get a chance to have a look at it and give us some feedback by the 1st of December, that would be really great.
Right. So for everyone watching, that's the CPMI IOSCO consultative report on applicability of the PFMI, Principles of Financial Market Infrastructures, to stablecoin arrangements. And you can provide input by December 1st, as Martin mentioned. So I wanted to turn back to Cecilia. We've also heard in some of the sessions earlier today, we've heard about stablecoins and how they compare with central bank digital currencies. We've heard a couple of governors and senior central bank officials from different countries that are working on central bank digital currencies. But of course, the Riksbank is a very advanced central bank that's been working on these issues. And I just wanted to ask, how do stablecoin arrangements compare with CBDCs like those that Riksbank is working on with the e-krona? And do you think that CBDCs and stablecoins are complements or substitutes to one another?
Well, I think well-designed stablecoins and central bank digital currencies are definitely complements to one another. And let me elaborate a little bit on this. So public money, also referred to as central bank money, is the only kind of truly risk-free money that we have in society. And it has a value that is guaranteed by the public sector in each jurisdiction that issue them. And today, this kind of public money is only actually available to the general public in the form of cash. But we seem to be living in a time in history where technology is raising the appetite for other forms of holding money. So cash usage is decreasing. And we have seen this in this case of Sweden for a long time. And that opened up a conversation a couple of years ago on how we, as a central bank, provide our offers to society in a more modern and timely way. And I think it's clear that both central banks, public sectors in general, but also the conventional financial system in the world has been sort of lagging behind a bit when it comes to aspects in the payment system. And here I'm thinking about cross-border payments that are still relatively slow and expensive and absolutely not up to the demands I think that people have. And I think also that we definitely see that far too many people in the world does not have access at all to financial services in the way they should be allowed to have. So I do see opportunity for a well-designed global stablecoin could bring some advantages. They could provide cross-border payment services that are quicker, cheaper, and more accessible than the alternatives available today. However, I also believe that they should only be able to do so under the requirement that their service actually does not entail more risks than today's alternatives. We have to keep in mind that the bad learning experience we had with the global financial crisis, that was also preceded by quite a lot of excitement around financial engineering and new ways to do structures, and it really ended in tears and nosebleeds across the globe. So we should keep that in mind. The private sector is brilliant as being innovative, making it able to quickly provide all kinds of needs, meet all kinds of needs in society, but in this case, new financial services and assets. On the other hand, taking public sector objectives into consideration, like maintaining financial stability, is usually not a priority for each and individual companies. And I think this is manifested, for example, by the fact that stablecoin issuers in some cases are not handling possible liquidity mismatches between the reserve assets and the issued stablecoins. Might be okay in benign market conditions, not so okay in more harsh market conditions. So regulations are important to deal with the possible risks of private companies' financial services. And I think also central banks need to realize that we need to provide services in line with our times that fill new and evolving needs of the public, of members of our societies. And it's along these lines, really, that the Riksbank are working on being prepared. We haven't made any decisions, but we think it's a responsibility issue to be prepared for issuing a CBDC and an e-krona, basically for the people living in Sweden. So what is unique with the CBDC? Well, central banks are able to provide the financial sector, but also the public, with basically unlimited amounts of risk-free money, and that is something that has turned out to be very useful, especially in recent crises. That ability.
Cecilia, you're on mute.
I'm sorry. Have I been on mute for a long time?
Just 2 seconds.
All right. Okay. So so by offering a CBDC, there is a default option, a sort of robust, safe alternative that is to the services that are provided by the private sector. You can see it as a sort of just continuation of the historical role that central banks have, providing general public access to risk-free money at all times. If then people want to use another version of money because they find that more suitable to their needs, that's fine, as long as it is safely regulated and safely supervised. So CBDCs in my view, does not exclude any private sector offerings that are meeting public sector objectives and criteria. And instead, I think we could actually be looking into quite an interesting and bright future where the public and the private sector basically continues to complement each other, providing the public with digital financial services that the public request. I'll stop there.
Thanks a lot, Cecilia. This is great, and I think a very fitting way to wrap this up as well. So we've heard about stablecoins, about the principles, the policy objectives that are there, how authorities are working together to regulate them, how they're working together in international bodies like CPMI and IOSCO with one another, and also domestically in places like the President's Working Group in the United States. So we've heard that there is regulatory cooperation. There can be a role for well-designed stablecoins, and they could perhaps even complement central bank digital currencies. So I think that it just leaves me to thank the panelists for their perspectives. Really appreciate it. To everyone listening, again, do check out the CPMI IOSCO consultative report, which is a short and good read, and where your comments are welcome. And it's also my privilege now to wrap up day one of DC FinTech Week. So do join us tomorrow again. Tomorrow we have IMF Managing Director Kristalina Georgieva and Agustin Karstens talking about FinTech as an enabler of financial inclusion. We have Nanda Nilekani, architect of the India Stack. We have Paula Arregui from Mercado Libre, Governor Reza Bakir from the State Bank of Pakistan. And we have dedicated sessions on minority deposit institutions and community development financial institutions in the United States, which are, of course, critical for inclusion in this country. So we look forward to seeing you all at 8:15 Eastern Time. And in the meantime, have a good afternoon, evening, and rest of the day wherever you're based. Thanks a lot.